Доброго дня! Вітаю вас на щорічній дослідницькій конференції Національного банку України та Національного банку Польщі. Сьогодні ця подія особлива. По-перше,
Welcome to the annual research conference
по-друге, вона вперше проводиться виключно онлайн.
of the National Bank of Ukraine and Narodowy Bank Polski. Today's event is special.
Потерпає від коронакризи, ринок праці та монетарна політика.
First, it is the 5th anniversary conference. Second, it is held online for the first time. Third, we will discuss a very sensitive topic that is especially important for the world today as it suffers from the coronavirus crisis, the labor market and monetary policy. Many countries have managed to rein in inflation and maintain low levels of unemployment over past decades. However, economic inequality, population aging, migration, and numerous other aspects continue to threaten economic development and long-term microeconomic stability of the world. Let's look at the key labor market trends that shape the global economy today. Demographic trends go first. The development and the healthcare system allows people to live longer. However, with insufficiently high birth rates, this leads to a gradual population aging. As a result, increased pressure is put on the social security system and on employees and state budgets in case of pension system where mandatory contributions are made to the general pension funds. Another problem is the relatively low female labor force participation. Also, it has been growing over the past 3 decades. According to the International Organization for Migration, there are currently 272 million immigrants in the world, and labor migrants account for 2/3 of this number. On the one hand, the global economy benefits from economic migration. Labor migrants host countries cover their needs in labor force, attract younger workers, and experience an increase in productivity and entrepreneurial spirit, and trade that is more typical for labor migrants than of those who stayed home. In turn, migrants' home countries receive short-term dividends in the form of remittances, which are rather stable compared to other financial inflows. On the other hand, international migration has a flip side. The shortage of labor force in migrants' home countries, opposite pressures on wages in hosting home countries, and increased burden for the social security and healthcare systems, not to mention the social and political consequences. Another upside of international migration is that it helps to reduce global economic inequality. Yet the benefits of economic growth are distributed very unevenly across countries. Since 2008, economic inequality in most of the world has stopped rising due to the fact that in most countries, incomes of the poorest 40% of the population have increased with economic growth, according to World Bank data. However, the 40% still receive less than 25% of total income. And if you look at each country, the level of economic inequality today is worse than 25 years ago. The corona crisis, in most cases, has only made things worse. The Great Lockdown, as some have already named this crisis, will lead to a sharp decline in the economic growth. The global economy will lose 3% of real GDP this year, according to the IMF. A partial recovery will take place next year, but GDP will still be below pre-virus levels. But this is only possible if the pandemic eases and quarantine measures are gradually relaxed this year, which is highly uncertain. The coronavirus has hit the labor market the hardest. The corona crisis could cost the global economy 305 million full-time jobs in the first half year 2020 and could jeopardize another 1.6 billion jobs in the informal economy. It means the total of almost 2 billion people out of 3.3 billion global workforce may lose their jobs, according to rather appalling data from the International Labour Organization. The coronavirus does not seem to discriminate between the rich and the poor, or between white-collar or blue-collar workers. In today's world, the poorer the people, the simpler and lower paid the job they hold, and the more that they rely on their jobs as the sole source of income, the more that they suffer. According to a recent study by a group of economists from the Center for Economic Policy Research, they say that previous pandemics and crises have only exacerbated inequality, and the corona crisis is unlikely to be an exception. Unfortunately, Ukraine is all too familiar with many of these problems. We expect that unemployment in Ukraine will peak at 1.5% in the second quarter 2020 due to the corona crisis, compared to 8.2% last year. As the gradual easing of quarantine measures has started in May continues and the economy recovers, unemployment will also decline in 2020, but will remain higher than last year. The job losses that hit Ukrainians as businesses closed down have not only complicated job search efforts by increasing the workload per vacancy, but also have shown that there will be no easy solution to the labor migration problem in Ukraine. Some Ukrainians working abroad did not even return home for the quarantine as they fear the prospect of becoming jobless in Ukraine. They find any work at all after the lockdown is lifted, and those who did return are now forced to compete against local laid-off workers for jobs that rarely pay as much as these migrants earn in other countries. For this reason, migrant workers have been leaving Ukraine again. However, most of the problems in the Ukrainian labor market are not related to COVID-19. First, one of the systemic problems of the Ukrainian economy has for years been the mismatch between job seeker skills and employer requirements. Late last year, a set of companies cited labor shortages as being one of the key factors limiting production, according to business surveys. This partially explains why unemployment in 2019 was quite high despite significant demand for labor from businesses. This gap can primarily be attributed to the Ukrainian education system inability to keep up with changes in the modern labor market, which are taking place amid globalization and technological progress. As a result, 34% of workers with higher education in Ukraine work in professions that do not require it, according to the ILO. This is one of Europe's highest shares of such individuals. Second, it's the low productivity. Despite having grown over the past 15 years, productivity is still too low. Ukraine is below the top 100 countries in an ILO ranking of countries by productivity. In 2019, labor productivity in Ukraine was lower not only compared to EU member states, but also relative to several former Soviet countries. The third, population decline and aging. Ukraine ranks 12th in the world in terms of population decline, according to World Bank data. Overall, Ukraine has 11 pensioners per 10 employees. As a result, the pension fund needs constant additional contributions from the state budget. This diverts public funds from being spent on investment and education and weighs on potential GDP growth. The high workload on employed individuals further increases their already elevated levels of informal employment. In 2019, 1 in 5 workers in Ukraine was employed informally. So the fourth, labor migration, as I have already mentioned. About 3 million Ukrainians work abroad. Some of them are seasonal workers. Last year, an average of approximately 2.5 million of our citizens were abroad at a given point in time, according to our estimates. For us, this presents a double challenge. Not only does labor migration affect the quantity and quality of labor resources and labor productivity in Ukraine, but also it makes our economy heavily dependent on remittance. Ukraine ranks 12th globally in terms of total income in remittances and is in the top 15 countries by the remittances to GDP ratio. The fifth, low labor force participation. In particular, the labor force participation of women in Ukraine is insufficient compared to Europe. While the labor force participation of men in the population aged 15 and older is 65%, that of women is 49%. This is due to difficulties with accessing childcare services and the low availability of part-time employment. And in its turn, low labor force participation puts a drag on potential GDP growth. How can monetary policy help in such cases? A dual mandate whereby a central bank pursues both price stability and full employment is not particularly commonplace in today's world. The Reserve Bank of Australia and the US Federal Reserve have pursued dual mandates since post-war times, as has the Reserve Bank of New Zealand since a year ago. However, making monetary policy decisions that take labor markets into account does not require a dual mandate. After all, it has been proven that there is a close link between wage growth and inflation, and labor migration in many countries has a significant impact on inflation, both through labor supply and wages and through remittances and the exchange rate. For example, the rise in labor migration from Ukraine in 2016-2018, in particular to Poland, was one of the key factors fueling the rapid increase in wages. This has led to the growth in production costs and thus in prices, especially those for services. In addition, when productivity is low, high wages make domestic producers less competitive, which in turn restrains economic growth. Have we considered this is conducting our monetary policy? We certainly have. Moreover, even those of us central bankers who pursue standard single-purpose inflation targeting mandates are actually impacting macroeconomic stability, economic growth, and thus the unemployment rate. And as the current crisis has shown, this choice is not so clear-cut, and the balance can sometimes be deliberately and purposefully disrupted in order to sustain the economy. In recent months, we have seen developed countries with near zero interest rates resort to non-traditional monetary policy instruments. Meanwhile, emerging economies that still have room for monetary easing are relying on standard tools. For instance, we at the NBU have done a lot to support the economy during the corona crisis and to strengthen its ability to quickly get back on its feet when it's over. We have slashed the key policy rate from 11% to 8% in just the past 2 months and are not ruling out the possibility of further cuts. We have expanded the list of bank liquidity support tools and facilitated access to these tools. We have introduced long-term refinancing for banks for a period of 1 to 5 years and an interest rate swap with banks, and made a currency swap deal with the EBRD so that it can provide hryvnia loans to Ukrainian companies. We have thus created conditions in which businesses can access funding at affordable rates, not only for short-term needs, but also for large-scale businesses projects that require long-term investments. However, the power of central banks has its limits. Can we do anything about the differences in people's perceptions of economic recovery? No, I don't think we can. I think we should leave this up to national governments. In times such as these, central governments ought to prioritize fiscal incentives, including targeted measures to maintain consumption levels for those who have lost part or all of their income to the quarantine. Like other central bankers, we in Ukraine can provide a favorable monetary environment and ease financial market conditions. But this is a good question to ask, and the corona crisis has given it special relevance. We will have 2 days to discuss in particular how monetary policy affects economic inequality and whether economic inequality should be among a central bank's goals. And as we talk about it, we should find the answer to the most fundamental questions: is the dual mandate of central banks justified, and is it more appropriate to focus on inflation? I wish you fresh ideas and interesting discussions.
Good afternoon. Hello, this is Paweł Szałamacha talking from Warsaw, from the National Bank of Poland. Governor Smoley, thank you very much for the insightful introductory speech. On behalf of the co-organizer of the conference, Narodowy Bank Polski, I would like to emphasize how our continuing cooperation and strong relationship is important for us, both as a neighboring country and as a banking partners, the cooperation between central banks of our countries. One of our flagship joint initiatives is the annual research conference, today already its 5th edition. Time passes by quickly. Only a year ago I was in Kiev, in the splendid city, and now we meet in the entire different context and the entire different circumstances. The agendas of the previous conferences addressed not only top priorities from the standpoint of specific economies, but also in the context of the global economy. And this is also the case of the subject matter of this year's conference. It's also equally relevant. We will be raising an important, complex issue, which in the light of the recent events is even more critical than before. The labor market and its implication for monetary policy is a serious global problem. In the midst of the COVID-19, unemployment rates are increasing everywhere and heavily influencing monetary policy. Layoffs are more frequent, welfare costs are higher, wage growth has stagnated or has been reversed, cuts are more prominent, and the nature of the labor market, labor relationships has changed as the digitalization of jobs moving from the foreseeable future to here and now is more substantial. This has happened almost everywhere. This has happened also in our bank, in the National Bank of Poland. We are hopefully in the middle of the road as far as the schedule of the COVID-19 epidemic, but it's still having a devastating effect on the global economy, hitting activity in all sectors and posing a unique challenge for economic policy. My country has entered the lockdown crisis as a well-balanced economy with a sound fiscal position reflected in declining public debt and historically low budget deficit. Actually, the purpose of the government was to have the balanced budget in this year for the first time ever in the modern history. Strong macroeconomic fundamentals of the Polish economy enabled it to smoothly absorb macroeconomic shocks associated with the outburst of the economy so far, and at the same time create necessary room for the fiscal and monetary loosening. Government has enjoyed quite a wide fiscal space because its indebtedness was relatively low and it was decreasing during recent years to around 43% as relative to the country's GDP. So as you see, we had an ample space for maneuver. And the government did not hesitate to take the large burden of these costs of adjustments to the crisis conditions by introducing large packages of measures, introducing variety of measures. They are well known to numerous countries. They differ obviously from jurisdiction to jurisdiction, but the list is more or less similar. And these measures, of course, include loans for micro enterprises and small and medium enterprises, even with the possibility of 75% of these loans being written off under certain conditions in the future. Measures include exemptions of self-employed and micro enterprises from social security contributions for the foreseeable period of time, for a few months. Cash benefits for self-employed and people employed under civil law contracts. Wage subsidies granted to the enterprises directly if they observe a reduction of the turnover, reduction of business. Loans to micro enterprises granted for 12 months, forgiven under certain conditions. Obviously, the scope of these measures vary, and new packages are being announced, or older one calibrated and improved. But it would be safe to say that so far, all these measures exceed 5% of the country's GDP. Simultaneously, at the central bank, we believe we have done quite a lot to help the economy and the labor market as well. We have acted countercyclically to lose monetary policy by reducing policy rate by 100 basis points to the historical low of 0.5%. National Bank of Poland has also relaxed reserve requirements and introduced repo transactions to provide additional liquidity to the banking sector. We are offering bill discount credit aimed at refinancing loans granted to enterprises. We have launched the purchases of the government securities on the secondary market and government guaranteed debt securities as part of our structural operations. So thanks to two factors, that is the wide fiscal space and very active monetary policy, we believe that we are in a fairly optimistic shape, although perhaps it's a bit premature to say, because as I said, we are in the middle of the road. But the forecasts for my country from IMF or from the European Commission are, again, given the circumstances, quite optimistic, if they could be optimistic in these months. As I mentioned before, Narodowy Bank Polski and the National Bank of Ukraine have joined their forces for the 5th time to give you the annual research conference, this time in an absolutely new setting, in a different approach, with social distancing in action. We find it challenging, obviously. I find it challenging personally, but still I believe that for all our audience and participants, this conference will be equally engaging and interesting. With the indispensable help of our presenters and discussants, let us face the challenge, the labor market, and implications for the monetary policy. I wish us all a productive, interesting, and educative conference. Thank you.
Okay, dear colleagues, good afternoon, those of you who are in Ukraine, probably good morning in other parts of the world. It's a great honor for me to launch the first session for this conference. I'm Olesya Verchenko. I am a VP for Economics Education at the Kyiv School of Economics. And it's a great honor for me to chair this session. We have 4 distinguished participants. This is Jordi Gali from University Pompeu Fabra, Yuri Garnichenko from University of California, Berkeley, David Berger from Duke University, and Dmitry Sergeyev from Bocconi University. We have 2 extremely interesting papers that we will hear today, and then the discussion. And you probably know the rules by now. We are going to have about 20 minutes of a presentation, then about 15 minutes of discussion, and then there will be time for questions and answers. Please submit your questions and answers in Zoom in writing. I will try to group them together and to make sure that as many of them as possible are answered by our speakers and the discussants. And without any further ado, I think that we can start with the first paper. This is a paper by Jordi Gali, Insider, Outsider, Labor Markets, Hysteresis, and Monetary Policy. Dr. Gali, the floor is yours.
Hello, good day to everyone. Thanks so much for inviting me to participate in this conference. Let me share the slides with you. Hopefully these are the right slides. Okay, very good. So can you hear me? Can you hear me well? Good. Okay, so again, the title of this paper is Insider, Outsider Labor Markets, Hysteresis and Monetary Policy. And it's motivated by one phenomenon that I have always found fascinating, namely the behavior of the unemployment rate in Europe, and in particular in the euro area, relative to other economies. So what you see here is a plot of the unemployment rate in the euro area starting in 1970. And one thing that is clear is that in addition to being relatively high for much of the sample period, that's something that is well known, it's also highly persistent, and fluctuations are extremely persistent. And this is in contrast, I would say, with the behavior of the unemployment rate in other economies like the US. And one way to represent this, or to formalize this notion, is to look at the autocorrelogram of the unemployment rate. And here I'm restricting myself to the to the European Monetary Union period starting in 1999 Q1, because some people may argue, well, much of this apparent high persistence may be the result of this seeming upward trend in the earlier part. So let's forget about that, and let's just restrict ourselves to the period starting in 1999, which is also a period in which there was a common monetary policy for all the countries in the euro area. So in the red line here displays the autocorrelogram of the unemployment rate in the euro area. And what you see, and the blue line and the black line are the mean and median of the distribution of the autocorrelogram generated by simulating a random walk, highly persistent process, 500 times. And the gray area is just the confidence interval of the 95% confidence interval for the estimated autocorrelograms resulting from those simulations. So this is just to say that, look, the autocorrelogram for the unemployment rate in the euro area is hard to differentiate from the autocorrelogram that would be generated by a random walk. Okay. Now, I don't want to get into the debate of whether there is a unit root or not in the unemployment rate in the euro area. I'm not particularly interested in that. Instead, I want to take this evidence as suggesting that the unemployment rate in Europe is extremely persistent. Okay. Then, based on or motivated by this observation, the paper asks a number of questions. The first question is whether the new Keynesian model, which is the workhorse of much macroeconomic analysis these days, can account for the high persistence of European unemployment. Okay, and I will try to answer I will ask that question, and as my answer will be no. Okay, a standard version of the new Keynesian model cannot account for the high persistence of European unemployment, at least with plausibly calibrated. And then that motivates the modifying the model in a relatively simple way, which I will explain, which is to reformulate the labor market in order to introduce what is known from a much earlier literature, the insider-outsider labor markets and hysteresis in labor markets. Okay, so I see how I show how to incorporate those assumptions that economists like Blanchard and Summers had made in the 80s into the modern new Keynesian model. Okay, and I show how that model can account, in principle, for this high persistence of European unemployment when the monetary policy is described by a rule that one could think of as being a realistic description of monetary policy in the euro. Okay, that's what I will call a simple rule, or the baseline simple rule. Okay, and then I ask myself, well, is it optimal to have such persistent, high persistent unemployment rate fluctuations? Or is there something that the central bank could do to minimize any inefficiencies resulting from that? So that leads me to look at the optimal policy in the context of this model, and also to look at simple targeting rules that will approximate what is otherwise a relatively complex optimal policy. So this is essentially what I will show you in these 20 minutes. In the paper, for those of you who are interested, if you have access to the paper, there's also an additional section that relates hysteresis to this notion of the labor wedge, but unfortunately, these are short presentations. So let me just take a couple of minutes to describe the framework that I'm going to use, and that both for the common ingredients that to both the standard new Keynesian model and my modified version of the model. So the framework is based on some work of mine, also with Frank Smets and Ralph Wouters, that shows how to introduce unemployment, a meaningful notion of unemployment into the new Keynesian model. So there's an infinitely lived representative household with a continuum of members, and a continuum of occupations, divisible labor, sharing within the household. These are the preferences of the representative household. So they're relatively standard. So this is the log of a consumption index, which is a bundle of continuum of differentiated goods. And here we have the quantities, employment, I would say, for different occupations J. Okay, so NTJ is employment in occupation J by the representative household, and ZT is just the preference shock. And the preference shock will be one of the shocks in the model. Then there will also be what I will call a markup shock, which is a shock to the elasticity of substitution between these differentiated goods that are inside this CT index. And the rest is, the rest of the assumptions should be familiar to all those of you who are familiar with the new Keynesian model. So there is monopolistic competition in goods and labor markets, and there is staggered price and wage setting a la Calvo. Okay, that means that each period only a fraction of firms adjust prices, and only a fraction of workers, in particular a fraction of occupations, will adjust their wage, nominal. Then firms use this technology, this production function, which is absolutely standard, but it's just an excuse for me to say that one of the third driving force in some of the simulations that I will show is this technology shock, which follows one process. And finally, and this is important, the monetary policy is described by an interest rate rule, which has partial adjustment, okay, with the coefficient, the inertia coefficient being phi I, and the interest rate target being a function of price inflation and the growth rate of GDP. And these coefficients, these three coefficients, will be calibrated in a way consistent with evidence in the euro area evidence coming from Orphanides, Smets, and others. Very good. Now, let me just mention what the notion of unemployment in the model is. The unemployment rate is naturally, I would say, defined as the gap between the log of the labor force or labor participation, which is L, P, and the log of employment. Employment is demand determined, and participation is determined by the aggregation of a participation constraint or participation constraints for all individuals in this economy, which leads to an equation like this, where here you have the log of the real wage, WT is the nominal wage, P is the log of the price level, CT is consumption, and LT is the log of the labor force or participation. Okay. Now, if you combine this equation with the standard definition of the wage markup, which one of the key variables in the new Keynesian model, which is defined as the gap between the real wage and the marginal disutility of labor at the current employment level, expressed in consumption goods, so what we would call the marginal rate of substitution. So if you combine the definition of the unemployment and these two equations, you get a very simple relationship between the wage markup and the unemployment rate, thus defined. Okay, there's a simple linear relationship. So we just need to add this equation to the standard model to derive implications for the unemployment rate. Okay, very good. Now, in the standard version of the new Keynesian model, okay, wage setting goes as follows. And this is the version due to Erzek, Henderson, and Levin originally, and that it has been widely adopted by many central banks around the world in their in-house models. So each union represents an occupation here, sets the nominal wage to maximize the representative household's utility, taking aggregate variables and other unions' decisions as given, because each union is infinitesimally small, because there are a continuum of occupation. So this leads to an optimal wage setting rule that looks like this. The optimal wage is equal to a desired markup, the markup that they would maintain if wages were flexible, over a weighted average of some reservation wages, okay, current and future, okay, in expected reservation wages, where the reservation wage is given by this expression, and this is nothing but the wage, the nominal wage that would prevail if there was perfect competition in the labor market. Okay, so notice that in that case, the real wage would be equal to the marginal rate of substitution. Okay, and where the desired wage markup is given by this familiar function of the wage elasticity of labor. So this gives rise to a wage inflation equation that looks like this. Okay, you combine it with other equations of the model. So wage inflation is related to expected wage inflation and to the unemployment gap, or the gap between the unemployment rate and the natural rate of unemployment, where the latter is defined as the unemployment rate that would prevail if wages were fully flexible. Okay, and this is important because to understand some of the results that I'll show you next, because this equation contains the seeds of a very stable behavior of the unemployment rate. Because if the unemployment rate were to be very high and relative to the natural rate, you could see that inflation would go down, wage inflation would go down. That would be inherited by price inflation, and the decline in price inflation would lead the central bank to lower interest rates, stimulate the economy, and thus lowering the unemployment rate. So there is this like self-stabilizing mechanism embedded in this version of the model. Unfortunately, because of this self-stabilizing mechanism, the model will not be able to generate the persistence of the unemployment rate that we see in economies like the euro area. So now let me show you some results based on a calibration of the model, which is, I don't have the time to explain this calibration. Let me just say that most of the parameters are absolutely standard. I use the calibration of the interest rate rule, as I said, based on Orfanidi and Smets, and estimates of the persistence of the shocks, of the three shocks that I'm considering, taken from estimates of the new area-wide model of the European Central Bank. Okay, so now let me show you what is the implied persistence. So the red line here is the estimated autocorrelogram for the using actual data. Okay, it's the one that I showed you earlier using euro area data starting in '99. Okay, and what you see in the black line and the gray area is the estimated, or it's the median and the 95% confidence interval of the autocorrelogram of the unemployment rate based on simulations of the calibrated model, the standard version of the model. Okay, and this is driven by technology shocks, driven by when fluctuations are driven by markup shocks, and when fluctuations are driven by demand shocks. And you can see that independently of the shock, the persistence generated by the model, because of that self-stabilizing mechanism that I mentioned, is very far from the persistence that we observe in the. Very good. So now let me, given this in a shortcoming of the model, I modify that model in a very simple way that is inspired by the work by Blanchard and Summers, Godfreys and Horn, and Lindbeck and Snower in the 80s, and which is usually referred to as the insider-outsider model. Okay, and as Blanchard and Summers argued in their paper, they said there is a fundamental asymmetry in the wage setting process, and they had Europe in mind at that time, by the way. Between insiders who are employed and outsiders who want jobs. Outsiders are disenfranchised and wages are set with a view to ensuring the jobs of insiders. Shocks that lead to reduced employment change the number of insiders and thereby change the subsequent equilibrium wage rates, given rise to hysteresis. Okay, so how do I introduce this? Very much inspired by their work and without claiming any solid micro foundations, I admit that. I modify just one equation of the model that I just showed you, the wage setting equation. So instead of the equation that I showed you a couple of minutes ago, wage setting now by unions representing occupations will be such that when the union is allowed to reset the nominal wage, it will choose the nominal wage such that this particular weighted average of current and expected employment in that occupation equals a target level of employment for that occupation, an employment target that the union has. And how does that employment target evolve? That's the hysteresis part. Well, that employment target is not a constant, but instead, even though there's a long-run target and star, but instead it is a function, okay, it is positively related to actual employment, in particular employment at the end of the previous period. In other words, fluctuations in actual employment change the employment target for unions because it changed the natural base, or if you want, the measure of insiders. And this parameter gamma is the parameter that measures the degree of hysteresis, the extent to which the target depends on the actual evolution of employment. Okay, so it turns out that if you combine this wage setting assumption with the other equations of the model, it gives rise to a wage inflation equation that looks like this, in which wage inflation now depends on two variables: the deviation of employment from steady state, NT hat, and the growth rate, or the change in the log of employment. Okay, with the weights attached to those two variables being related to gamma. Okay, in particular, the weight of the change in employment is related to gamma, and the weight of the level of employment relative to steady state is related to 1 minus gamma. Okay, there are two extreme cases. If gamma equals 0, there's no hysteresis, then we get an equation that looks very much like the previous one, but instead the one that I showed you a few minutes ago, but instead of unemployment, we have employment here and with a positive relationship. But you can see that there will be that self-stabilizing mechanism. If gamma equals 1, the other extreme, we get just the change in employment. This is important because it means that even if employment is very different from the efficient level, if it doesn't change, if it remains relatively constant, there won't be any pressures on wage inflation that may help stabilize or may help bring back employment to the efficient level. So now let me show you a picture like the previous one, but on unemployment persistence generated by the model, but now for this modified version of the model. Okay, and now you can see how the model generates much more persistence. This with, by the way, I should say this with a baseline calibration in which gamma is taken to be 0.99. So we need a high value for that parameter gamma in order to get high persistence. But you see that we can generate quite a bit of persistence. And you can see here, this is the response of the unemployment rate to technology shocks, markup shocks, and demand shocks as a function of gamma. Okay, so as we increase gamma, the degree of hysteresis, you can see how we go from the blue to the purple to the red. You can see how the persistence of the unemployment rate to shocks increases. And in the case of gamma equal to 1, the effect is actually perfect. Now let me turn to optimal policy. Okay. Now, all the results that I showed you were based on that baseline simple rule that was meant to be a realistic description of monetary policy. But how about optimal policy? Well, when I solve for optimal policy using the calibrated version of the modified model, I find large differences in the impulse responses between a number of macro variables under the optimal policy versus the simple rule. Okay, so you can see here the blue line. These are responses to technology shock. Okay, so the blue line are the responses of under the simple rule, and the red line, the responses under the optimal policy. Okay, and I don't know if you see because the numbers are very small, but this is the unemployment rate and this is employment. Let me focus on those variables. You can see that the two variables are much more stable, is close to zero, the initial value, under the optimal policy than under the simple rule. Under the simple rule, there are what look like nearly permanent, though they are not completely permanent, responses to the shock. Okay, this is for a markup shock, same finding, very different, large differences with unemployment and the employment being nearly constant or under the optimal policy. Okay, obviously that those differences are also reflected in inflation and price inflation, wage inflation, and nominal and real interest rates. Okay, but I don't have much time to describe that. But in general, what we see is that the optimal policy, this is very clear here, for instance, calls for a much more aggressive response, a much more stimulating response than the one that implied by the simple rule. You can see how real interest rates here are much lower, especially at the start. Okay, and these are the responses to the demand shocks that are most dramatic because the way I have introduced demand shocks, it is optimal actually for employment and unemployment not to change, and for inflation, price inflation and wage inflation not to change. And this is achieved with the optimal policy. You can see here the unemployment rate is flat at zero, employment is flat at zero, wage inflation, the two inflation rates are flat at zero. But with the simple rule, there are large fluctuations in response to these demand shocks, fluctuations that are completely inefficient. And not only there are large fluctuations, but they are highly persistent. And here you see the welfare. These are the welfare losses for alternative values on the horizontal axis. You have alternative values of gamma, the degree of hysteresis. And in red, you have the welfare losses under the optimal policy, and in blue, the welfare losses under the simple rule. And you have, again, technology shocks, markup shocks, and demand shocks. And you can see, well, not surprisingly, welfare losses are smaller and substantially smaller under the optimal policy, but you can see, and that's what I want to emphasize, how the gap in welfare losses increases as the degree of hysteresis increases. In other words, the gains from adopting the optimal policy, okay, and shifting from these very high, large welfare losses to the small ones, are increasing in the degree of hysteresis. Okay, and now in the last part of the paper, I show that, motivated by the impulse responses that I showed you earlier, that simple targeting rules that just fully stabilize employment and fully stabilize the unemployment rate approximate very well the optimal policy, which is otherwise a complex object. And here, again, I don't have much time, I'm running out of time, but what I show is that the impulse responses are very similar to the three shocks, okay, under the optimal policy and the targeting rules. Okay, here you see differences, but if you look at the scale, they are tiny. The differences are tiny. Okay, here these are just decimal points of differences. And by the way, under demand shocks, they are identical. Okay, so the economy is fully stabilized. Now these are the differences in welfare losses between the optimal policy and the simple targeting rules. And again, I don't have time to go into each of these pictures, but the basic message is that the differences are very small. Okay, so effectively, the central bank could adopt these simple targeting rules and approximate very well the optimal policy. So let me just conclude now, take 30 seconds to conclude and wrap up. So the basic message that I wanted to convey is that the standard new Keynesian model cannot account for the high unemployment persistence, as observed, for instance, in Europe and in the euro area in particular, but that a simple modification of the model that incorporates this notion of insider-outsider labor markets and hysteresis can generate high persistent unemployment and even a unit root. And the reason is simple, and that's what I would like to emphasize. If the central bank follows a baseline simple rule like the one that the European Central Bank, for instance, seems to follow, the economy may remain persistently at an inefficiently low level of activity without generating any deflationary pressure. It's the kind of deflationary pressures that would elicit policy response, a more aggressive stimulating response. Okay, so that calls for a need for a direct stabilization of employment and unemployment, not one that is mediated by inflation, by how the central bank responds to inflation by central banks that focus on inflation. And the welfare gains from shifting to the optimal policy can be considerable and increasing in the degree of hysteresis. And that optimal policy, as I said, can be well approximated by simple targeting rules that focus on stabilizing employment or unemployment. Thanks a lot. I'm sorry for taking a couple of minutes.
Okay, thank you very much, Dr. Gali, for this very interesting presentation. I would like to now give floor to Yuri Gorodnichenko, who is a discussant of this paper. Yuri, you have about 15 minutes, and then we will start general discussion. I would like the other participants of the conference to prepare their questions and submit them through the Q&A instrument that we have in Zoom, so that we can group them effectively and ask Professor Gali to answer them later on.
Thank you. Let me share my screen. All right, so first of all, I would like to thank the organizers to allowing me to discuss this very timely, very important paper. And to help you appreciate the significance of this work, let me show this slide, which plots the time series of actual GDP, the black line, and the time series of potential GDP constructed by the Congress Budget Office just before the Great Recession for the US. The two lines are normalized to take zero value just before the Great Recession. And what you should see from this figure is that the potential output, the red line, was projected to grow at a significant rate for the next 10 years. But then, of course, we see the Great Recession. The black line shows a huge decline. The difference between the red line and the black line amounts to roughly $1 trillion. That was a massive contraction in the US economy. And then what is striking here is that even 10 years after the start of the Great Recession, we see that the black line is not catching up to the red line. The black line doesn't catch up with the red line. We don't see convergence. So it seems like, the Great Recession had a permanent damage on the US economy. Now, as more data were coming in, we see that CBO, Congress Budget Office, started to revise its estimates of potential output. In light of new data that said, well, maybe potential is not going to be as high as we saw before. Then 2 years later, they said, well, maybe even lower. Then 2 years later, they revised it further down, further down, further down. And by 2017, basically, CBO was saying that the level of actual output is close to the potential, and so we don't have an output gap. And that had huge policy implications. For example, this was the point at which the Fed started the normalization process for monetary policy, specifically started to raise interest rates and wind down portfolios accumulated during QE rounds. Okay. Now, what is striking here is that unlike what we normally see in theoretical models, that the actual output catching up with the potential, we see that the potential output was revised to match the actual output. And the key question is this a new normal? Should we think about these recessions as having permanent effect on the economy, or maybe there was something special about the Great Recession? There are several explanations for why we could see this kind of dynamic. One is that we may have problems with the estimates of the potential output. We see this persistent revisions down, and there is some work suggesting that these estimates have various issues and we shouldn't take them at face value. Maybe a potential output is not falling as fast and as much as suggested by the Congress Budget Office. But that's a more kind of boring econometric issue. A more interesting, at least in terms of economics, is the explanation based on hysteresis, where the shocks, business cycles, can have permanent effects on the economy. And this may come from the supply side. For example, in a recent speech, Janet Yellen was saying that recessions can force people out of the labor force. They can negatively affect their research and development, and then the result, their productivity grows. And so there is very little monetary policy can do about this. And it's only really the job of the fiscal authorities to stimulate growth by giving, for example, research subsidies or encouraging people to participate in the labor force. Another explanation of this hysteresis, this persistent effects of business cycles on output, come from the demand side, where basically you can construct an economy where the level of output is demand determined. And if you have low demand, you can get stuck in a low equilibrium, low level of output for a significant period of time. Now, which of these stories is true, it's hard to establish because we have relatively limited data. But it is important to think through various issues that can come up when we have supply side or demand side hysteresis. There are several ways you can model hysteresis, as I already mentioned. One is through changes in the research and development. The main point of this class of models is that if you have endogenous technical change and recessions force firms to abandon their research and development projects, they do not develop new technologies, productivity growth is slow, and so great recessions can have a permanent damage on the economy. The actual output will never catch up with the pre-recession potential level of output. Another story is more about bankruptcies that can adversely affect the economy. You have a pool of entrepreneurs, they lose a lot of equity, and it's very hard for them to rebuild this pool. And so as a result, you can have very persistent effects on the economy, kind of a financial story. Yet another explanation is based on the idea that recessions discourage many people to participate in the labor force. For example, they can enroll into disability insurance in the US. And after that, it's very hard for them to go back to labor force because the whole point of disability insurance is that you have health issues or some other issues that prevent you from working. And this works as an absorbent state. Now, this paper takes a different route. It takes the classic insider-outsider insight and puts this into the state-of-the-art new Keynesian model. And so as a result, we have very rich analysis. We can talk about welfare dynamics, various policy experiments. And one key policy implication is that policymakers should put a lot more weight, not just on inflation, but on employment. So just focusing on inflation is not necessarily the best policy. And so in this sense, monetary policy has to be a lot more aggressive in fighting recessions than what is prescribed by conventional new Keynesian models. There is a lot to like about the paper and the model. I really enjoyed reading the paper. And I have only a few comments, basically aim to improve the appeal of the paper and make it even more interesting. The first comment I want to make is that the paper framed as basically addressing a European issue, that many European countries have problems with persistent unemployment. In the US, I think, the new normal is that we have equally persistent unemployment. For example, after the Great Recession, it took the US economy 9 years to recover to the level of unemployment we saw before the recession. And to me, this strikes as an extremely slow adjustment, similar to what Jordi was emphasizing in his presentation and in his paper. So I would broaden the appeal of the motivation and say this is not just a European issue. It seems to be a big issue for other countries, specifically the US. Another point I wanted to highlight is that in the classic insider-outsider models, basically unions have, there are two options how you can model unions. One is that unions set wages and then firms choose employment. Another option is that unions set employment, firms choose wages. In the big scheme of things, it's not terribly important how you do it, because if you face a demand curve, which is downward sloping, and unions decide what they want to do, by setting wage, they effectively set employment, and the other way around, if they set employment, that set wages. But in dynamic models, when you have a lot of uncertainty unresolved when we make these decisions, in principle, this can influence the dynamics. Now, the way paper does it, it focuses on setting the employment targets rather than wages. And I was wondering how we can differentiate between these two options. Is there anything we can see in the data that can inform us about which of the options is a better description of reality? Now, I don't have a ton of micro level data from union contracts or anything like this, but when I was looking at the aggregate series in the US, I studied the dynamics of real wages during the recession and after the recession. And strikingly, the real wages remained very, very stable over this period. You know, we had a lot of unemployment here, and then unemployment was declining quite significantly in this segment of the time series. But what is striking here is that wages were really stable. And to me, this suggests that maybe a better description of how wages are set is this option one rather than option two. But again, you know, maybe this is not terribly important in the model setting because these two options are highly connected to each other. Another caveat we should keep in mind is that this serious measurement of real wages is fraught with many, many challenges, the composition bias, all sorts of other measurement issues. And so this is definitely not the best time series to analyze when we think about the dynamics of real wages. But as a first pass of at the data, this seems to suggest that wages were really, really rigid during this time period. And maybe we can have a joint analysis of wage dynamics and employment to inform our modeling choices and also policy implications. Another thing I wanted to bring up in our discussion of this paper is that the traditional story of insiders and outsiders is that the trade unions are the insiders. These are the guys who set wages, determine employment, and so on. The paper takes a much broader view of this. It just says for some reason the current employees have a much higher weight in the decisions on wages and employment, and there is certainly some truth to that. But it would be nice to have some concrete examples, case studies, if you will, on how this can work. Because the traditional explanation that the trade unions are the insiders doesn't seem to be particularly appealing in the current environment. And to see this, I here plot the time series of union density, basically the share of workforce covered by union contracts. And we see that in the 70s and 80s, when these models were developed, unions were a significant force in the labor markets. But there is a dramatic decline in the importance of trade unions, even in many European countries, such as Germany. It's even true in Nordic countries where the density declined relative to what we had here. And so ideally, we need to have a more concrete story for who are these insiders. And this can make the paper more appealing to a broader audience. And I guess one thing I have in mind when I think about these case studies is the dynamics in the labor markets during big recessions, and specifically in Finland, where after the collapse of the Soviet Union, there was a massive increase in unemployment. You know, when people in Finland talk about the Great Depression, they don't talk about 1930s, they talk about 1990s. And even though the unemployment increased dramatically and stayed elevated for a very significant period of time, for 15 years, what was striking was that at this time when unemployment was really, really increasing very rapidly and by huge amounts, the trade unions refused to take any pay cuts. So this would be a perfect example of somebody who is an insider saying, okay, we set our wages, firms can choose employment, and as a result, firms will choose to have very little employment because the labor force is going to be so expensive. And just to kind of document this, you can look at the distribution of wage changes of individual workers. For example, you know this figure shows the distribution of wages for specific workers that you track over time. So, for example, here it would be a guy who didn't have any wage increases in manufacturing, and this person has no manual occupation and a service worker. What you should see here from this micro level data, again, tracking wage rates and salaries of people at the micro level, you see huge spikes at zero. Okay, and why is that? Well, it's because the unions, again, refused to take any pay cuts. And because wages were so high relative to where they probably should have been, the unemployment rate increased dramatically. So this will be, I guess, a kind of a perfect example of what insider-outsider model should predict, and it's going to be borne out by the data. And I hope that there is something similar we can do in the current environment where we have clear notion of insiders and outsiders, and this is going to be helpful in motivating the model and making it more appealing. Another comment I would like to make is about kind of specific model and assumptions we have in new Keynesian models. Typically, we assume that there is no firm entry in these models, and it doesn't really matter most of the time. But sometimes, specifically this application, it may be important because even though the unionized workers set wages and the unemployed have no say in how high wages or how low wages are set, in principle, if we have firm entry, then the new firms can dip into the pool of the unemployed workers. These workers are going to be very cheap, and because new firms are not bound by incumbents that didn't have any previous workforce, in principle, it will create a very strong incentive for firm entry, and we can partially or completely bypass the challenges created by the insiders. Now, I don't know what's the rate of new firm creation in the European countries, but in the US, there is a huge turnover of firms in general. And this figure here shows the number of firms applying for tax ID. And this is often taken as a proxy for new firm creation. And what you should see here is that it's a high number. So every quarter, roughly 600,000 firms apply for a new ID. And then during the recession, this number declines, and then we have a fast recovery. So to the extent these firms are not bound by incumbents, it means wages may be a lot more flexible than we would observe in a model with no firm entry. Now, this is not to say that the model has to have firm entry, but my thinking was more about the key parameter that govern hysteresis, the parameter gamma, may be calibrated to capture this firm entry. And depending on how you count the number of firms in the US, roughly 5 to 10% of firms I created every quarter relative to the pool of firms in the US. And that's a big entry, and maybe we can calibrate gamma to be something like 0.05 or 0.1 based on this data. In any case, I think it will be helpful to think more about firm entry and what this means for hysteresis. The final comment I would like to make is about sort of the empirical appeal of the paper. Georgi motivates this kind of work by looking at the serial correlation of unemployment rate in the model and in the data. And that's a very useful statistic, but maybe we can have a more direct test of the mechanism. And specifically, Georgi showed in the slides, and it also shown in the paper, that you can have a wage Phillips curve where current wage growth depends on expectations of the wage growth in the next period. Then the difference between actual unemployment or employment and potential employment and the growth rate of employment in the economy. Now, this term is standard in new Keynesian models. This term is non-standard. This shows up only if you have hysteresis. And one thing we can do is basically try to estimate this equation and see if this coefficient here, B2, is going to be different from 0. Now, the key challenge in estimating this kind of equation is that we have to have expectations of wages. And at least in the US, I know there is one survey, the Livingston survey, which has very long time series going on from basically the end of World War II. It has information on wage growth expectations in manufacturing. It's not the whole economy, but at least it's some information. It's also a semi-annual survey. It's a downside, but it has very long time series, and so we have lots and lots of variation during this time series, that time period. So what I did, I took the Livingston survey, constructed employment gap using HP filter, and growth rate of employment for manufacturing. I also have real wages actual wages for manufacturing. I have expectations from the Livingston survey. And when I estimate this equation, I consistently find that the coefficient on the growth rate of employment is positive and highly significant, which is consistent with some notion of hysteresis, the main prediction of the model. And so I think we can have much more direct empirical support for the mechanism emphasized by the paper. One unfortunate thing here is that the coefficient on the employment gap is negative, even though the model predicts it should be positive. But I don't have a full resolution of this coefficient, but in principle, we can dig a little more into this data, and maybe there is some hope to turn around this inconsistent result. In the end, this is most timely work. We have to think very carefully about how aggressive monetary policy has to be in the current environment when unemployment rate is extremely high and everybody is concerned that we may have an L-shaped recovery or W recovery or U recovery or all sorts of recoveries where it can take a very long time to reach pre-recession levels of output. And this paper has some very important insights on how we should think about this issue. So it's also a very clear paper. In terms of future work, I think it would be very helpful to study the dynamics of wages and employment at the same time, have a maybe better story of insiders in the modern economy, think about firm entry. And finally, I think it would be helpful to report some sort of direct test of the mechanism. Thank you.
Thank you, Yuri, very much. Maybe Professor Gali would like to address the concerns that Yuri has raised for about 3 to 5 minutes, and then we will turn to questions.
Okay, good. Let me share the slides again, if possible. Okay, well, thanks, Yuri, very much. As usual, your comments are very insightful, and I can tell you that I will definitely take up some of them when revising the paper. Now, just to respond very quickly to some of your points, okay. On the US, no, why restrict the analysis to Europe or the motivation to Europe? Well, things may be changing in the US. I don't know, I haven't really looked at changes over time, but if you look at the full sample, at least starting in 1970, and you compare the two autocorrelograms for the unemployment rates, they are very different. You have them here. This is, by the way, is from a companion paper in which I focused precisely on motivate the paper on the differences between the US and the Euro area. Okay, but again, as you say, maybe there is some new normal, and hysteresis may also be playing. Maybe in the US, but it's true that the unemployment rate has reverted back relatively slowly, okay, after the past 2 recessions or so. But you can tell that there's this clear trend or this tendency to revert back to some value that is around 4%, and that's something that we don't have in the Euro area. Now, just to clarify, regarding your option 1 and option 2, I mean, the model in my paper, the modified model, is clearly option 1. Huh? I mean, unions, workers set wages, and then firms decide employment, determine employment. It's just that relative to the standard model, unions set wages with an employment target in mind. Okay, but still, I mean, employment is not set by the unions. And by the way, in this companion paper, I look at some of the empirical, actually the paper focuses on the empirics of wage inflation and the unemployment rate in the Euro area. And one of the main conclusions of the paper is that wage inflation is in the Euro area is explained pretty well by the insider-outsider model. Here you have actual wage inflation and wage inflation predicted by the insider-outsider model, a calibrated version of that model over since the inception of the European Monetary Union. And whereas the standard model does very poorly, okay? Here the black line is what the standard model predicts wage inflation should be. This has to do with the well-known twin puzzles. Not during the boom in the early 2000s, the model predicts that wage inflation should have been much higher than what we saw. And during the recession, the standard model predicts that wage inflation should have been negative, very negative, and we didn't see any of that. No, so that's actually that. I mean, this kind of observations is what I think gives an edge to the insider-outsider model relative to the standard model. And the unions, yeah, you mentioned that affiliation, union affiliation, or union density, I think that's what you called it, has been going down in many countries. I agree, that's well known, but we have to differentiate between union density and what is really matters here, which is the coverage of workers by collective bargaining agreements. No? And it's not clear to me that this has gone down at all in Europe. I don't have the data here. But certainly, what the phenomenon that the model, I mean, using the term unions is just a rhetorical device in the paper, just to give it some name, to facilitate the communication. But what the model is really trying to capture is what I think you had in mind when you presented this very nice evidence from Finland that I would definitely refer to in the paper. It's this idea of dual labor markets. There are some workers that have indefinite contracts that are very well protected with high hiring costs. And whereas there's another subset of workers that have temporary contracts that can be fired at almost for free by firms, and they have a very fragile attachment to firms. There has been very little investment in human capital and so on. So I think that's what I would view as the relevant dimension of these insider-outsider markets rather than unions. And just I agree that if you added entry to the model, obviously if entering firms could hire the unemployed at the competitive wage, then the unemployment problem may disappear. But the implicit assumption in the model, which I think is relevant also in practice, is that they cannot underbid the insiders. Okay, that the wages that are set by insiders apply to the whole economy. Okay, otherwise, obviously, the equilibrium would the equilibrium that I emphasized would just fall apart. Okay, well, thanks a lot, Yuri. I enjoyed very much your discussion.
Okay, thank you very much. We have about 5 minutes to answer other questions. We have quite a few questions. It came through the Q&A instrument. I would like to group some of them. And the first one is a more technical one about how you measure technology shocks, which variables define technology shocks in your model. So if you can briefly.
Yeah. Oh, that's easy. That's easy to answer because I don't measure them. I just assume it's a theoretical model, and I assume a production function in which there is total factor productivity varies exogenously, and the way, and I calibrate that. That's true using evidence from paper by Kai Christoffel and others at the ECB that use the whole, Bayesian methods and using all the equations of the model simultaneously to approximate the behavior of those driving forces. But I don't really measure directly that.
Okay. Another question is that we have is the following: if a higher bargaining power of employed leads to higher than optimal wages, then of course newcomers are not going to be hired. But how is this consistent with low wages and price level growth in Euro area?
Okay. Well, I really don't have much to say about real wages being high, low, and so on. I mean, that will depend on many things that are probably captured by an exogenous parameter in my model, which is what I call a wage markup. My model has more to say about how wages respond to fluctuations in employment or fluctuations in the unemployment rate as a result from shocks. No, and what I see, and in looking at what we see in Europe, is that during the Great Recession, the unemployment rate increased a lot, okay, but wage inflation did not decrease much, okay, which suggesting that this stabilizing, self-stabilizing mechanism that is implicit in the standard model is not at work in practice, at least in Europe or in many European countries, and that's something that can potentially be explained by this insider-outsider model. There may be other explanations. I'm just offering one.
Okay, thank you. There are a few questions that are very close to each other. They are about the trade-off between unemployment and inflation. So in order to bring this, in particular, persistent unemployment down, we have to accommodate some high inflation, right? And this is not quite consistent with the inflation targeting regimes that the central banks are following. Many central banks are following nowadays.
Yes, we would have to accommodate. So the answer is through the lens of the model. The answer is, the comment is correct. We would have to accommodate some positive inflation, some higher inflation, but it would be temporary. It would be temporary. What during the period in which employment increases, okay, if employment increases, okay, that will increase wage inflation, and presumably that will be captured in price inflation. But you know, that's one of the messages of the paper, that you know, maybe central banks should not worry so much about inflation, and look and instead, you know, put more weight and respond more directly to measures of slack in the labor market, measures of the trended employment, unemployment rate.
Okay, yeah, there is another question that is related about the COVID crisis, and what would central banks have to do to stop unemployment growth. But I think it's related to what you have just mentioned, unless you want to add something to that.
No, I don't. You know,
Yeah.
well, there are things that central banks cannot do. For instance, to bring to an end the health crisis, okay, which is the most important thing to end the current economic crisis. So central banks cannot do that. But while they, and also there are many aspects of the current recession which do not result from insufficient demand. So I think there are limits to what central banks can do in terms of stimulating demand. Because much of the or part of the recession is a result of supply constraints, no, self-imposed because of all this social distancing.
Okay, we are running out of time. We have to turn to the next paper. There are two other questions that are related to heterogeneous agents and inequality, but I think this is not really quite what you address in this paper. So if you would like to look at questions, I think you have access to them and maybe answer to them. If not, then
I don't see. In the past,
okay.
Here we go.
So, but we have to move on to the next paper.
Okay.
Thank you so much. Very interesting paper and very interesting discussion. And the next paper in the panel is the paper by a group of authors. This is a paper that is also related to labor markets. The title is Layoff Risks, Welfare Costs, and Business Cycles and Monetary Policy. And I would like to invite David Berger to present the paper.
All right. Well, hope you can hear me. Great. Thanks again. I'd like also to thank the organizers for having me. This paper actually dovetails quite nicely with the last paper in the sense that it has a very similar message. Let me share my screen. Okay, hopefully you can see the paper. Good. All right. So here we are. Yeah, this is joint with some previous colleagues of mine, Ian Dubecker, Lauren Schmidt, and Yuta Takahashi. So the motivation is quite similar to the previous paper, which is it's going to be the whole thrust of the argument I'm going to try to make is to argue that perhaps central banks, the reason to think that central banks should put a little bit more weight on unemployment fluctuations. So the way to think about this is, you know, many central banks around the world have a mandate to think about both stabilizing prices and output. And, you know, just if you talk to economists, typically, you know, the main story is that you should be focusing on stabilizing price fluctuations. Why is that? Well, it's like sort of just well-known results that the welfare costs from aggregate output fluctuations are quite small. Therefore, in these models, which capture these sort of standard calculations, optimal policy typically says the central bank should put more weight on inflation relative to other fluctuations. Now, our approach is to sort of build on a literature that's been going on for decades in labor economics, and to ask, maybe there's some features of the real world that the standard sort of New Keynesian model is missing. And in the same way, this is sort of how the paper is very similar. The last paper talked about hysteresis, which I think is very relevant. This is going to think about incomplete markets. So the main way that we think about market incompleteness, or the inability to insure against risks, might show up here is that in recessions, typical New Keynesian model focuses with complete markets. But in reality, it seems like the burden of recessions are borne by a few people. Who are those people? Those are people who suffer layoffs. And those who suffer layoffs but have a hard time of finding a job. So these are people who are typically high tenure. So people who have been working for a long period of time at the same job, maybe like middle age, a bit older. So have high wages, they lose them, and it takes them a long time to sort of get that back. If you don't, lose your job, the wage costs are the welfare costs of losing it are not that bad in recessions. But what we're going to do is try to have a model where we have these type of behavior in the model. And what you're going to see is that when you do that, when you introduce this feature, and it's going to be a little bit complicated because we have to modify the model in a few ways, it's going to provide a rationale for central banks for caring a little bit more about unemployment fluctuations. So what do? I'll walk through this. We're going to take the very sort of standard 3-equation New Keynesian model. And the key thing we're going to add is we're going to say that there's going to be some layoffs, some job loss that's not insurable. What does that mean? That means when you lose your job, some of those losses are going to be suffered with large permanent declines in your earnings, which is going to translate into lower consumption and hence lower welfare. So we're going to try to capture the idea that in the real world, it does seem that some layoffs are quite costly, and I'll provide some evidence about that from the US. Moreover, this is actually quite complicated to do technically, because these are big nonlinear changes, and typically we don't want to have those in our models. So we make some few simplifying assumptions. This is roughly speaking going to be similar to like a two agent type of model, unemployed and employed. That's going to allow for it still to be amenable. We're still going to be able to solve it with a first order approximation, but there's still going to be, like we standardly do, but there's still going to be uninsurable idiosyncratic risk, meaning the layoffs are going to be costly. That's what I mean by that. So what is the main result? So contrary to these sort of classic results from Lucas, we're going to see now that the welfare costs of business cycles, so how much agents would be willing to give up or to avoid any sort of business cycle fluctuations, which again, the central bank can control, are going to be much larger. Rather than, I said before, almost 0.04%, they're going to be at least 1%. And I would say that we try very hard in the paper to keep our calibration, to be conservative. I think this is likely a lower bound. I'm going to argue there's many reasons things we're not modeling or our model doesn't match that actually would amplify these results. What is this going to mean? So once you introduce these features, we're going to then think about optimal policy. And here we're going to allow the central bank to think about not only responding to inflation and output, but now they're going to be able to respond to the source of the main welfare losses, which is going to be layoffs. And what we're going to see is that they're going to want to put some weight on stabilizing employment contributions, in particular minimizing layoffs. Moreover, these welfare rules, because losing your job is so costly, there's going to be massive differences between how much weight you want to put on these certain objects, layoffs versus employment, versus price stability. And what we're going to see is that in general, central banks are going to want to, this sort of analysis, adding these features is going to it's going to be another reason why central bankers would want to put much more weight on minimizing unemployment fluctuations. So let me talk a little bit about the motivating evidence. These are sort of well-known graphs. This is from a paper by Steve Davis and Till Van Wachter in 2001, but it's not unique to the United States. Gregor Jarosz and many others have done stuff in Germany and other countries. So what does it show? It shows in the average job loss or earnings loss for people who suffer a job displacement event, for someone who is laid off. So what do we see? We see year 0 is when they lose. These are event study graphs. So in year 0, these are when people lose their job. Okay, so beforehand we see, in here what we're doing is we're comparing a worker to another worker in the same firm who has the same sort of level of tenure, so the same job experience, to a person in the same firm who does not suffer a layoff. All right, so what happens? Before the layoffs, they both sort of have similar earnings growth. That makes sense. Then one worker suffers a layoff. What happens is earnings fall. That's going to compound two things, both the wage they're paid and they're working fewer hours. And then over time, we're following how much their earnings are relative to this person who didn't lose their job. So what do you see? You see that wages, when people suffer layoffs, on average, they typically lose a large part of their earnings, around 25%. But moreover, it's quite persistent. This is years on the x-axis. So even after 20 years in the United States, we see that people's earnings are about 10% lower. Moreover, the red line, the red squares versus the blue diamonds contrast what happens when you lose your job in a boom, and that's the red, versus a recession. And what we see is it is much worse to lose your job in a recession. In fact, on average, earnings drop 40%, not 25%. And moreover, the long-term permanent effects are larger. And I don't have time to there's a very large empirical literature about this, but what is going on here, that what people think is, you lose your job and then it takes a long time to find a comparable job going forward. These are people who had worked for at least 3 years on the same job. So you should think about these people who have developed sort of very specific skills for a certain firm. They were earning pretty good wages, and it takes a long time to get back to that firm. Moreover, when you're unemployed, your skills depreciate, and that can lead, so that means when you're reemployed at a new job, you have a lower wage. And so that's going to lead to this permanent job loss. So we're going to try to add a feature in the model, costly layoffs, that sort of can match these cracks. This is sort of the empirical counterpart that we're going to try to measure. All right, so what are we going to do? How are we going to do that? This is going to be a very standard new Keynesian setup. Calvo pricing, monopolistic competition. There's going to be a supply and demand shock. We're going to have wages very similar to Blanchard and Ghali. They're going to be proportional to TFP, and there's going to be standard CRA utility. I don't want to talk about that because I only have 20 minutes. I'm only going to talk about the key modifications. One, how we're going to have uninsurable income risk. Again, we're going to have two agents, and how we're going to add heterogeneous agents in this economy. So I'm going to focus on the non-standard bits. So the first part is, how do we have layoffs? So we need a notion of hires and fires. So what are we going to do? So for a firm, intermediate firms, what they're going to do is they're going to have aggregate shocks, AT, and firm-specific shocks, AMT. K is the average human capital of the workforce, K employed, and N is the employment. They're going to they produce output, and they pay a wage. And here your wage is going to be proportional to the amount of human capital you had. Okay. What is the law of motion? How does employment evolve at an individual firm? Well, all firms are going to suffer some exogenous to the firm quit rate. That's going to end up being pro-cyclical in equilibrium. And then they're going to have fires, and they're going to have hires. Now, no firm will be hiring and firing in equilibrium. That's an assumption. But the basic way will be is the amount of how much you want to hire or fire will depend on what your labor demand is, net of how many people quit. So if you get a good shock, many people quit, and you want to grow, you're going to have to hire. If you get a bad shock and even you want to fire, you want to have a smaller workforce even after people quit, you're going to have to lay them off. That's how we're going to have hires and fires. How is human capital going to evolve? So agents are going to have human capital K. It's going to be two types of agents, employed and employed. And so their dynamics of human capital are going to determine the welfare losses here, because again, wages are proportional to your human capital. So how is it going to work? K is going to evolve according to, it's going to depend on how much human capital you have. You think of this as the skills you have while you work. There's going to be this indicator where you lose when unemployed, you're going to lose D per period. In our calibration, it's going to be about 1% per quarter. In addition, all people lose some, it just depreciates. Think of it as you have to learn a new programming language, some new skill. And then we're going to have this G. So in the model, one of the challenges is it's hard to have endogenous savings. Here, this is going to be kind of like a way of having some savings. What is it going to mean? It's going to mean you can always think of it as like if you were unemployed, you're going to always be able to turn some of your current human capital into consumption. That would be sort of like home production. So if you get laid off, yes, I am a good economist, but I can also cook. So I use some of my skills to cook, and I can just save on going to restaurants. This is going to allow me to maintain my consumption while unemployed. So it's a way of using savings. So it's basically, you can eat some of your human capital as consumption. And then, so this is how it's going to evolve. And then the final thing about being unemployed is that there's going to be some replacement rate, meaning you're going to be unemployed, you can get some unemployment benefits, and B is going to capture that. Finally, the other non-standard bit is we're going to have a Taylor rule, and in addition to having some interest rate smoothing motive and some weight on inflation and output, we're going to allow the central bank to think about stabilizing the layoff rate. All right, so that's the final thing. And then we're going to now, it's hard to solve with heterogeneity for the Ramsey policy, but I'm going to show you some contours of what policy looks like. So the key model moments, the main one is we're not going to use crazy risk aversion. We're going to have a risk aversion of 3. There's going to be standard log, CRA utility. So that's, so we're being conservative in this, and I think. And in the labor market, what's going on? So if we make a calibration to the US data. So in the US data, roughly speaking, every quarter, there's around 4% of people churning every month. That accounts layoffs and quits. We're going to have quit rates that are around, on average, 2%. But we're only going to allow some of the layoffs to be costly. And this is another way in which we're going to be conservative. Because if we said that every layoff that happened in the United States was costly, then the welfare costs are just enormous. Because when you lose your job, you saw is very, very costly in terms of your consumption of welfare. So we're only going to say, roughly speaking, 25% to a third are really, layoffs are actually costly. What is that going to mean? So the layoff rate in our model is going to range, depending if it's a boom or a recession, between 0.6 and 1.4% per quarter. That's going to mean the model is going to miss, it's going to say the duration of unemployment is around 6 quarters. That's counterfactual. In the real world, it's probably closer to a quarter, 2 quarters in the US. So you should think of this as a model of not of every worker, but of these high tenured workers. So it's really a model of how long did it take you after you lose your job to find another good job in something. That's what it's a model of. And most crucially, it's going to capture this, that the consumption loss from a layoff on average is around 15%. So these are big. This is the big change from the standard model. Typically in standard models with complete markets, layouts are not that costly. Here, they're quite costly. And that's going to change everything. So let me show you a little bit about how it works in the model. In the top panel, I'm showing you the earnings losses based on when you find a job, because that's stochastic in the model. So if you lose your job, your earnings, if there's no replacement rate, it goes to 0. But if you find your job within a year, within 4 quarters, your long-term loss is only around 5%. On average, some of the people are quite unlucky. It takes them 4 years to find a job, and those people suffer quite big losses, like 30% of their consumption. And so it's this sort of, in the model, everything is sort of this exponentially distributed in the losses, and it's these losses, this potential for big losses, which is going to drive the welfare results. What do consumption declines look like in recessions and in the model? Well, you see they fall, not completely, because there is some insurance. It's only, you lose your job, there's some earnings, but you can sort of use your human capital to smooth consumption. And then over time, you can see that it sort of falls around 15%. Moreover, in the model, there is a little bit, it's harder to find a job in a recession. So the job losses from losing your job in the model are higher in recessions, but not nearly the time variation that we saw in the data. And if we added that time variation in, these welfare losses are getting even bigger. Okay, so what are the welfare costs? Overall, since not that many people are losing their jobs, the welfare losses are not enormous. The total welfare loss, this is the cost from eliminating all aggregate shocks, would be around, or all idiosyncratic shocks would be around 1.4%. Now, we can make this much bigger by having higher risk aversion and so on. For example, if you allow for time varying, if you sort of match the actual degree to how bad it is to lose your job in a recession, because that's when margin utility is high, we can more than double them. We can double the results. But the point is, the key is to compare between the cost, how much of it is coming from idiosyncratic losses, coming from losing your job, versus the standard welfare inflation effect. And the key is, it's mostly from losing your job. And so that's the key thing. In standard models, the losses that come from losing the output, the The reason why the standard models put a lot of weight on stabilizing prices as the result of not thinking about unemployment is that it's actually not that costly to be unemployed in these models. Once you make unemployment costly, it's much more important. The central bank's going to want to put much more weight on this in stabilizing this. And then finally, we decompose it into aggregated idiosyncratic risk, and most of it is coming from stabilizing idiosyncratic risk. If we just said, if we asked how much would people pay to eliminate just fluctuations in aggregates, it's only 0.03%. So it's very similar to the Lucas number I quoted. It's this addition of costly idiosyncratic risk that's driving all of the results. Now, we can make the numbers bigger or smaller depending on if we have more generous unemployment insurance or lower risk aversion. But the point of the matter is, it's always the case, even in the most conservative calibration, that stabilizing idiosyncratic risk is an order of magnitude bigger than stabilizing the welfare costs from price dispersion, which is what's going on with unemployment, or with prices. So how do we see this? So here I'm showing you some simple contour plots around how much weight the central bank should put on, say here on the y-axis, inflation versus stabilizing firings. And what you see is that in total welfare losses, as you move towards, if you only stabilize prices, you suffer welfare losses of around 2%. But as you move to the right, as you put more and more weight on stabilizing the layoff rate, you move to, you can lower the welfare losses by 1-2%. So what does this tell you? The lower numbers mean less welfare losses, that it's better to put more weights on stabilizing employment. All right, so stabilizing layoffs, that's what it's saying. Why is that? Well, here it's I've shown what's going on, similar side graphs, but now instead of showing welfare losses, I'm showing the standard deviation of inflation and unemployment. And we see that what's going on is if you put a higher weight as you move to the right on the x-axis on stabilizing fires, you lower the standard deviation of unemployment. So you're minimizing unemployment fluctuations. Now that comes at a cost. You're amplifying, the central bank would have to accept larger fluctuations in inflation. But as Professor Ghali pointed out, many of these would be temporary. Much of this would be temporary, okay? But because we've made layoffs quite costly, it's important to do that. So in some sense, this is a very simple paper. The optimal policy involves putting much more weight on stabilizing unemployment fluctuations, in particular, maintaining employment relationships so we don't have these costly layoffs. And inflation volatility is much less important. Why? Because just in these models, in the typical models, it's very true that the inflation, the welfare loss from inflation is much bigger than the welfare loss from output fluctuations. But once we add in these sort of costly layoffs, which I think is a very real feature of the real world, the whole logic flips, and central banks should put much more weight on stabilizing layoffs as well. Okay. Now, one question that I always get that I think it's interesting to think about is, how well would we do if we didn't think about layoffs per se? We just stabilized output. So here what I'm showing is instead we're not going to put two different contour plots. I'm plotting the efficient frontiers basically and for two different measures based on if we had policies where we just targeted layoffs and how much we just targeted output. So both work pretty well, but what you can see is the ones that stabilize output are the dashed lines, and the one that stabilize layoffs are the solid lines. And we have two measures. Here we're looking at the standard deviation of the variables, and here we're looking at it in terms of welfare or utility terms. And the main lesson I want you to see is that the solid line is always closer to the origin over here. What does that mean? That means that for a given, say, standard deviation of inflation, for a given standard deviation of inflation, we can have a smaller standard deviation of employment if you focus on layoffs, not output. So this tells you that stabilizing layoffs is actually putting more weight on layoffs as the policy variable, not output, is a more useful thing in the context of this model. Why? Because in the language of the model, it's very direct. All right, let me just, I have 1 minute left. It's pretty easy. This is, up to now, has been sort of a theoretical exercise. I think an empirically grounded one, because I think that these costly layoffs are a real feature of reality that the models miss. One question you might have is, do actual central banks think about these things? So here I'm quoting, for the US at least, the correlations of the federal funds rate innovations with a bunch of variables. And the key thing is, you see they do correlate very, very strongly. In fact, most strongly with initial claims. So they do seem to be thinking about this, because as you know, layoff rates spike at the beginning of recession. So I think in practice, central banks do think about this stuff. And moreover, we estimate both policy rules, sort of empirical Taylor rules backward and forward. I think my discussant is going to talk more about it. And all of them suggest that the layoff rate is quite important. So let me just conclude. There's sizable costs of business cycles. There's a well-known literature that suggests that losing your job is quite painful. And this feature is typically not in our models, in the sense of unemployment fluctuations are typically not that big a deal. And so what we do in this paper is to try to augment the model to sort of capture these features of reality, that losing your job can be quite painful in terms of consumption losses. And when we put that in, it overturns this standard result that the central bank should mostly focus on stabilizing prices. It suggests that they should put more weight on stabilizing unemployment. And so this provides a mandate for thinking about both objectives rather than just stabilizing prices and inflation. Thank you so much.
Okay, David, thank you so much for interesting paper and presentation. I would like to invite Dmitry Sergeyev from Bocconi University as a discussant. I would like to ask Dmitry to be done in about 12 minutes so that we have enough time for David to respond to some of the comments and then to answer a couple of questions from the audience. And I would like to encourage the audience to write their questions in our Q&A channel.
Hello, everyone. Just to double check, how much time do I have?
Let's say 12 minutes.
Okay, I'll try. Again, yes, it's a great pleasure being with you. So let me quickly jump at the paper. Do you see my slides? Cool. Okay, I will begin by quickly describing what this paper does and how it does it. So the paper first empirically documents that federal funds rate is related more to layoffs rather than output gap or unemployment rate. Then using a model, as you have just seen, David and his co-authors show that when the central bank targets not only output gap or unemployment, but rather something closer to the labor market like layoffs, it can increase welfare. So let me state upfront that this first result is more like a motivational fact. In fact, in his presentation, David put everything towards the end. And the key contribution of the paper is the solution of this very interesting and complicated model. Nevertheless, how the authors do it? First, they estimate forward and backward standard Taylor rule specifications a la Clarida, Gali, and Gertler by augmenting it with layoffs. They run horse race between layoffs rate, for example, and unemployment rate, and the layoff rate wins. And then they solve the so-called Hank model, and specifically they show that social welfare can be higher if the central banker targets not the output gap, but something like the layoff rate. So I think this is a very insightful paper. I enjoyed reading it. It's an important one. And in my discussion now, I will first talk about this empirical motivational fact. And then I will put the paper in this broader Hank literature, provide some intuition, and talk a little bit about alternative Taylor rules. So, so essentially, I revert David's presentation, and I will first talk about this empirical observation in which David, with his co-authors, they re-estimate the standard Taylor rule, which they augment with this extra term that depends on the initial unemployment benefit claims. So, and what they show is that when this extra variable is added, it essentially steals all of the significance from either output gap or unemployment, depending on what you add to this regression. And so this is consistent with this idea that the Federal Reserve in the US cares about the labor market, and in particular, it cares about layoffs. So let me emphasize that I believe that the Federal Reserve cares about the labor market and in particular about layoffs. However, what I want to do right now, I want to provide a potentially alternative interpretation of such an observation that they document in the paper. So let me show you this two New York Times front pages from March 27th and May 9th, 2020. So already on March 27th, we knew that by observing this huge spike in the initial unemployment benefit claims, we knew that the US labor market experiences tremendous strain. However, it took more than a month for the Bureau of Labor Statistics to issue the official unemployment rate data on May 9th. And of course, the Federal Reserve, it didn't wait all of this time to lower the interest rate to zero. They did it way, way earlier. So it all hints at this idea that maybe empirically layoff rate is just a very good leading indicator of business cycles. And so if this interpretation makes any sense, that maybe other leading indicators kind of also can be helpful in explaining the nominal interest rate that the Federal Reserve sets. And so let me show a little empirical exercise that I did. I was fortunate, David sent me his codes and his data. And so in this table, in the first two columns, I essentially recalculate David's result that shows that once you add the layoff rate in the second column, it makes the output gap insignificant. So the output gap variable goes from this green box to the red box. It loses significance. The sign is wrong now in front of output gap. So what I did, I just added a bunch of extra leading indicators into such a regression. Specifically, this is a growth rate of business inventories, and this is the so-called PMI index. And so after adding these two indices on top of layoffs, they seem to steal significance not only from output gap, but from layoff. So at least to me, this suggests that maybe other leading economic indicators are important in explaining like a real-time variation in the federal funds rate. I'm not an expert in estimating Taylor rule specifications, so maybe this happens simply because all of these leading economic indicators are super correlated with each other, which is of course the case. But so I just wanted to point this out and see what David can say about it. Of course, the key contribution of this paper is the exploration of the effects of monetary policy in the so-called Hank models. So if you know what Hank type models are, it is great. So for those who don't, let me just make sure that we are on the same page. So HA in Hank stands for heterogeneous agents, like these two guys here. Scrooge McDuck represents a wealthy person. Donald Duck is a poor, potentially credit constrained person who needs to work to earn his living. And NK represents new Keynesian ideas like sticky prices and wages, and they're represented here with Keynes himself in his famous chair. So this class of models has become super popular very recently because it captures in a realistic way micro heterogeneity across players in the economy. And so recently, people have been, or let me say, early contributions to this growing literature, and so they have been published 2 or 4 years ago, but so the tide, the flow of this paper is so huge that let me call them early contributions to this literature. These papers have been solving this like huge, complicated black boxes numerically. And what became clear very fast, that these Hank models, they're boxes with many interesting and rich channels. And so by now, this literature focuses on like trying to parse these different channels of this model, understand their implications. Let me just here I put 5 of them. Let me name a couple of them. For example, the cyclicality of inequality effect is important because sometimes it is thought that poor credit constrained people like Donald Duck their income is super responsive to the business cycle. At the same time, the cyclicality of the idiosyncratic risk over the business cycle contributes to the effects in this model as well. Like for example, in recessions, you may face a larger risk of being fired, so you start saving more, you consume less, you exacerbate the recession. So there are more channels here. Let me skip them, not because they're not important, but because David and his co-authors, they actually they put themselves in this box. And again, this is for a good reason, because if you try to capture all of them, it quickly becomes really hard to understand what is happening. Moreover, they utilize this very cool trick that make the model slightly tractable by assuming the so-called zero liquidity assumption. Essentially, in equilibrium, agents in his model do not hold any financial assets. So in a nutshell, what happens in David's world, agents are heterogeneous. They can be employed or unemployed. Moreover, they can have different levels of individual human capital. So, and they face risk of being fired. And when you're fired, your wage drops potentially temporary, but your loss of human capital is very persistent. So it takes time to build it up again to went to the frontier of knowledge in your sector. So, and in the model that David presents, this risk is counter-cyclical. In a recession, chance of being fired is higher, so risk is higher. You want to save more, you consume less, and this exacerbates the recession. So now, who do we have here? So here's Yakov Smoley designing optimal monetary policy using the Hank model. So as I said, Hank models are very complicated on their own. Now, thinking about monetary policy design in this model is like yet another level of complication. And nevertheless, researchers cannot be stopped. They started trying to approach this question, and this is where David's paper contributes to the literature. And again, let me remind you that David's paper chooses specifically to think only about cyclicality of idiosyncratic risk. And so the key question here is, what is that Yakov Smoley should think about in such a framework? So in this model, there are essentially 2 frictions: sticky prices and incomplete markets. And in such a world, when a policymaker designs optimal policy to maximize social welfare, you can summarize this design through some sort of like objectives. So it is typical to think about stabilization of output and inflation. Of course, with incomplete markets, the central bank will think of providing insurance to these agents with different income for those who are unemployed can potentially benefit. But of course, monetary policy cannot hand out transfers. But nevertheless, it can potentially affect certain amount of inequality. On top of that, there is this important interaction or feedback effect between sticky prices and market incompleteness. And let me repeat it once again. So when the economy is in a recession, unemployment goes up, risk of being fired is higher. So it is natural to start saving more for rainy day and you consume less. And when prices are sticky, decline in your aggregate consumption, demand reduces output. So this is what the central bank will want to think about. Central banker will want to address in this world. And let me reinforce this idea with a simple example of a positive cost push shock, like for example, an increase in oil prices. So in such an environment, in such a situation, typically inflation goes up, output goes down. Without any incomplete markets, a typical New Keynesian prescription would be, on the one hand, you want to increase nominal interest rate to fight inflation. On the other hand, you want to reduce nominal interest rate to support output. Here, of course, there is this, let me call it a new objective, or just an attempt to fight this strong feedback effect, because if output falls, it increases idiosyncratic risk and starts this like negative feedback that you want to fight. So this is going to be an extra reason why you want to reduce and react stronger to output. Now, the question is, if you do it with a Taylor rule, what should you include in a Taylor rule? Some measure of economic activity like output gap or unemployment, or layoffs, number of people who are unemployed? And so the answer that David and his co-authors give to this question, it is better in terms of like maximizing social welfare to respond to layoffs. Why is that? Well, this interaction effect that I mentioned earlier, the key source of this feedback thing is idiosyncratic risk. So you want to address this time-varying idiosyncratic risk. And some labor market variable like change in employment or number of layoffs tracks closer this idiosyncratic risk compared to output, which, for example, in David's model also depends on some other factors. So output would be just like a imperfect measure of this labor market activity. So, and let me just say one last thing. Actually, let me ask a question to David, and maybe he can respond. So, in the paper, they only considered this route that rules that include either output gap or layoff rate, the layoff rate. But what about alternatives? So we're not talking about here about optimal monetary policy. We're constraining ourselves to the set of Taylor-like rules. And so in this set, we can experiment a bit more. What happens if, for example, instead of layoff rate, we add their employment or a change in employment, so which also a good tracker of a labor market? How does it compare in terms of achieving social welfare to the layoff rate in the Taylor rule? Moreover, again, the cost here is this like feedback loop from sticky prices to idiosyncratic risk. So yes, this the layoff rate kind of relates to the probability of job loss, but it's not only the only thing that affects the cost. Of course, the consumption decline once you lost your job is also important. So I wonder if there is like a better sufficient statistic for this time varying layoff rate. Okay, so with this, let me conclude just by saying this is a very insightful and I think important paper on an important topic. And my only relevant comment, I think, is this question of alternative Taylor rules that can be discussed in this framework.
Thank you very much, Dmitry. I think we have about 3 minutes for David to address the questions that Dmitry has asked. And then I have quite a few questions that I would spend the remaining 5 minutes on. Okay, so
Sure.
David, go ahead.
I'll try to obey the time constraint. All right, well, thank you, Dmitry, for the very helpful and insightful discussion. Just briefly, first about the econometric issues. I mean, I completely agree with you. The layoff is just the layoff rate, or it's the initial claims rate, it's a leading indicator. It's definitely correlated with other leading indicators, and we need to do a better job of disentangling them because they're all quite positively correlated. Personally, for myself, I think of it as more suggestive evidence. I think it's kind of incontrovertible that at least the Fed cares about labor market variables. And I think that, I agree the exact channel is difficult econometrically with these forward Taylor rules. That's why I think of it as more suggestive evidence. As to your questions about the model, I thank you so much I didn't have barely enough time to talk about the model. You're absolutely correct. There's these sort of the new channel, this new friction that we're bringing in is incomplete markets. And so, and how the interesting interactions, but how it interacts with price stickiness are quite interesting. actually in our model right now, because we're kind of conservative about the calibration, these dynamic effects through precautionary savings are actually pretty weak. I mean, we could obviously amplify that by amplifying the risk. So most of it, as you pointed out, is coming from the role of the central bank in preserving employment fluctuations, basically minimizing the number of layoffs that happen in equilibrium. I completely agree. I think on your final comment about alternative, yeah, I mean, in some sense, the paper is very simple. We added an ingredient that made job loss potentially costly. And so then targeting job loss is the thing that would, improve welfare in terms of you're limiting yourself to Taylor rules. We'll definitely try, it's a very good suggestion, to try different ideas like change in employment, or maybe there is like a more, I'll even try maybe, it's possible that we can come up with an analytical solution of like a more sufficient statistic approach. That's something I'm not sure, but we will work on for sure. So thank you so much for your comments. They're very helpful.
Okay, great. So I have a question from one of our panelists who could not type it into the Q&A tool. And the question goes like that. Does the cost of layoff and their uninsurability, change our view of the welfare benefits of labor reallocations in normal times? Or in other words, could welfare be higher in a lower productivity economy with more stable jobs?
It's a very good question. I mean, to answer that question, you have to take a stand on, so one thing we're not doing in the paper, in some sense it's very reduced form on what are the source of these benefits of being in an existing employment relationship, and where are the costs of the job loss coming from? So the answer is, it is quite possibly. If your view was that what an employment relationship is what is a firm doing? It's ensuring idiosyncratic risk for the firm. Then the answer could be yes, actually yes. I think empirically it's actually quite difficult to know, but it is potentially possible. I mean, I think this is a little bit more of a micro labor question about where the source of these wage benefits are, but it is possible. Yes.
Okay, another question is what would be the implications of the model? How would they differ for developed and developing economies? And in developing economies, inflation is still is a concern, like in Ukraine.
Totally right. So, I mean, I should have stated this more clearly. When we calculate the welfare cost of inflation, we're doing this around in a zero inflation steady state, which I think is a reasonable approximation to the United States. And that's where, we're building on a long literature, and that's where the welfare numbers come from. And we get numbers very similar to the previous literature for the welfare losses coming from inflation variability. Obviously, and why do we do that? I think it's a reasonable assumption with a Calvo model around, zero. Calvo is a reasonable assumption when you don't have stochastic trend inflation. Once you do, and then I think the welfare losses from inflation can be quite large. Okay, so I fully admit, I apologize. I'm a product of America. I'm biased I'm motivated by what I was thinking about in America, where inflation for most people doesn't seem to matter as much, and job loss does. It could easily reverse in the other case. So totally reasonable.
Okay. One more question is that if there is a dual mandate and we have unstable inflation expectations, sensitivity of financial sector to liquidity expansion, high probability of supply side shocks, and restrictions on the balance of payments, what would be the model implications in the face of those circumstances, if this can even be discussed within the model?
Yeah, I'm very reluctant to discuss because it's hard for me to even think through in real time. But I mean, let me just say that I don't want you to take any of the numbers seriously in the model. I view the model as merely suggested, in the sense that I think that this feature that layoffs are quite costly is a real thing, and I think it's something that's not really captured in the models right now. And this is just one attempt to add some realism that pushes central banks in favor of thinking more about sort of minimizing employment fluctuations at the expense of inflation. That's my only point. I think obviously there could be caveats to that, but that was sort of the goal of the paper.
Okay. We have one more question, again, not in the Q&A tool because one of the panelists could not put it into that tool. Oh, sure. So it's again about two welfare losses from business cycles that are additive. The one that is explored in the model and related to idiosyncratic risk. And then there is a negative effect from unemployment volatility on the level of employment and output, as documented in Valentin and Westermark. So these losses are complementing each other. They're basically additive. And yeah, so I'm not sure what the question is, but maybe you can comment on that comment.
I don't quite understand, but I mean, I'll try to talk to Carl exactly. I think that's from Carl. Like we can, I'm sure that yeah, I would love to hear more about it. So yeah.
Okay, great. One last question. I think we have about 2 minutes from one of the participants. Do you think that the goals of full employment and price stability are compatible and achievable simultaneously? That's a more general question, I guess, to pretty much all panelists today.
I mean, so, I mean, look, I think, yes. I mean, in the model, or like if you know, again, we're not solving for the Ramsey policy. So, but if you look across different sort of linear Taylor rules, it is possible to have, say, inflation between like empirical bounds between, say, 1% and 3%, and to have lower, lower employment fluctuations than we've seen. So I think it is quite possible. But again, I'm not like an expert on this. You know, I'm not a practitioner.
Okay, I guess at this point we have covered all the questions that we had. We actually managed to be done on time. Thank you so much, David. And if someone thinks of a question and can put it in the Q&A tool, maybe David can follow up on that if someone comes up with a question later.
Yeah, and thanks again to the organizers and my discussant. I very much appreciate it.
Thank you very much. It was a great panel. I enjoyed it a lot. I hope everyone who's present in the room virtually, right, enjoyed it as well. And now it's time to switch to the next session, I guess. Stay here. We are not really going anywhere. Okay, thank you.
Good day to everyone. So we start our second session of this conference. Unfortunately, in the online events, we don't have coffee breaks, so we don't have a possibility to chat between each other. But I would like to remind that all panelists can raise their hands to ask questions, and our attendees can use a Q&A option or tool in order to ask questions to speakers. So the second session will be dedicated to other two interesting topics on labor economics and monetary policy. We will have Aysegül Sahin from University of Texas at Austin, and with the paper on the missing inflation puzzle, the role of the wage price pass-through. And the discussant will be Slavik Sheremiro from the Boston Fed. Then we will switch to the second presentation titled Worker Heterogeneity and Employment Recoveries in the Face of Aggregate Demand and Pandemic Shocks. And the discussant for this paper will be Alexei Krivtsov from Bank of Canada. And the paper eventually will be presented by Federico Ravenna from the National Bank of Denmark. So I would like to invite Aysegül Sahin to turn on camera and microphone, so we can start with the first presentation.
Hi, everyone. Let me try to share my screen first. Is everyone seeing my screen?
Right, we can see your screen. You can make it full screen if you wish.
Okay, now it's full screen. Okay, so first of all, I'd like to thank the organizer for inviting us to present at this conference. I'm going to talk about the missing inflation puzzle, and the paper is joined with my former colleagues, Sebastian Heise and Fatih Karahan. So as you all know, inflation remains subdued following the Great Recession in the US, below the Fed's 2% target, despite historically low unemployment rates that we have seen until very recently. And the question we are going to ask is that what explains this so-called missing inflation? And this topic already got a lot of attention, and some prominent answers to this is the anchored inflation expectations, labor market slack that exists beyond the unemployment rate, and the low natural rate of unemployment that is due to demographic factors. This factor in this paper, we actually take a complementary approach, and we focus on the sectoral origins of low inflation using detailed industry level data. So what we do and what we find is that we first start with the aggregate data on unemployment, wages, and inflation. And we show that missing inflation is mostly due to core goods inflation. And then we turn to disaggregated price and wage data, and we find significant pass-through from wages to prices in services. However, we show that there's actually no pass-through anymore in manufacturing from labor costs to prices. And then we propose two explanations for this lack of pass-through in manufacturing. One is the increase in import competition, and the other is the increase in market concentration. And we find that both of these factors contributed to the disappearing pass-through in manufacturing. So let me start with aggregate facts. These are well-known facts, but I'm going to look at them in a slightly different way. So when we discuss the Great Recession, we always talk about how slow the recovery was in output and also in the labor market. And as we have seen from David's work and many other work, that there's emergence of jobless recoveries in the US. So what I'm going to do is, instead of looking at expansions over time, I'm going to define a new metric, a very simple metric, which I call the cumulative unemployment recovery. So this is going to be the share of the rise in unemployment during the recession.
I'm sorry, Isaac. I'm sorry for interrupting you. It seems that we cannot see your slides, so we just can see the first slide and that's all. Maybe you can start share your slides one more time so we can fix it. I'm sorry for interrupting.
Okay. I did not realize this.
Just try to share your slides one more time.
Okay.
Okay, now it works. Yes, now it works.
Okay. Do you want me to go back, or I think there was nothing to show? So going back, I'm going to look at everything relative to this cumulative unemployment recovery metric that basically computes the share of the rise in unemployment during the recession that has been reversed. So a value of 100 indicates that the unemployment rate is back to its pre-recession trough during the expansion. And now let's first look at inflation during expansions over time, quarters since peak unemployment rate. And my definition of expansion will start from the peak unemployment rate. And this is cumulative inflation starting from peak unemployment rate in the last 5 expansions. So you can see that over time, inflation has become slower and slower to pick up. In the 70s expansion, after 10 quarters, prices rose by about 20%. And in the latest expansion, even after 20 quarters, the cumulative increase was only 10%. So now let's look at this using the cumulative unemployment recovery metric, which will take into account changing speed of recoveries and the emergence of jobless recoveries. So what we see here is slightly different. The 70s and 80s expansions stand out as expansions where inflation picks up relatively fast, while the other 3 are relatively well aligned. But what's also interesting is that early on, there's not much of a change in unemployment inflation dynamics, but later on, the dynamics of inflation is different. So that clearly points to inflation expectations being an important factor, which I'm not going to analyze but acknowledge. So now let's dig deeper and look at core goods and core services inflation separately. So we see a 80s expansion and 90s expansion. The blue line is the core CPI. And you can see that in both of them, services CPI increased more, but we have seen a good increase in core goods CPI in the 80s, a relatively muted one in the 90s. When I look at the last two expansions, the picture is different. We again see services inflation picking up with unemployment recovery, but there's essentially no change in core goods CPI as unemployment keeps going down. So it seems like part of missing inflation is really due to core goods CPI if we were to decompose it into these two categories. So this is going to be the main point that we want to make, and we want to understand why did good CPI become flatter. And one possibility is that if we think of the link between the labor market and inflation as being wages, there was no increase in labor costs. So there was nothing to pass through, so that's the reason. However, evolution of wages and also, more importantly, unit labor costs shows us that this was not the case. So I can show you here in the last two expansions, goods and services cumulative wage increases, and the figure is actually more stark if you look at unit labor costs. So wage increases were in line in goods and services. However, this did not pass through into prices. And that's why we think that the missing part of the puzzle is the pass-through from wages to prices. And that's what we're going to look at next. But before we look at our empirical framework, I want to just give you a very simple framework to motivate our empirical specification. Let's think about a representative firm that produces using labor and capital. And cost minimization implies that firms' marginal costs depend on TFP and factor prices. And in the case of perfect competition, or when the firm charges a markup, we can write firm's price as a function of markup, TFP, and factor prices. And taking logs and differencing will give me the main empirical specification that I will try to estimate. So change in prices depend on change in factor prices, but they will pass through in proportion to their shares. So that's where labor share will be important, which has been declining. And then productivity growth is going to allow the firm to lower its price, so it's not inflationary. And then there's markup that firm can choose. So now let's take this intuition and let's look at our empirical framework. So our empirical specification will try to estimate the pass-through from wage changes to price changes using weekly earnings at the industry level and producer prices for 255 five-digit NAICS industries. And of these, 148 are in manufacturing. And we will be able to control for productivity, which is an important part, as we have seen in the simple specification. And we also control for gender, age, and age composition of industries to alleviate the concern about compositional bias in wages. So now let's look at our first result. We're going to look at pass-through. This is essentially this beta coefficient from changes in wages at the industry level to changes in producer prices for 2003-2016 period. So in the aggregate, we find around 6% pass-through. However, when we look at manufacturing and services differently, we find that there's about 10% pass-through for services, but the pass-through in manufacturing is economically and statistically insignificant. And the other concern, of course, is the decline in labor share, which is more stark in manufacturing. Is it because of the decline in labor share? So what we're going to do now is we're going to interact the change in wage with the labor share, and we find a similar picture. The services now even has higher pass-through, around 20%, while for manufacturing, we still don't see much. And of course, it's hard to think of wages without thinking about productivity changes and competition for workers. So that's why in the paper we also consider an IV strategy, and we use job-to-job transitions as our instrument to capture wage increases in excess of productivity growth, and we find very, very similar results with that instrument to these findings. So then the question becomes, but the missing core inflation is something that we have seen in the last two expansions. So what about the earlier period? So we are able to go back to 1990s for only manufacturing, where we see this non-existent pass-through. So now we look at whether this was something that coincided with the flattening of core goods inflation. And this is indeed the case. In the pre-2003 period, we actually find a positive around 5% pass-through from wages to prices in manufacturing that seem to have disappeared in the later period, which coincided with the flattening of core inflation. So now the question becomes, why did this happen? Why did pass-through disappear in manufacturing? So we're going to consider two potential explanations. One of them is the rising import competition in the US, this increased exposure to foreign competition of domestic producers. And the other is the increasing domestic market concentration in the domestic markets in the US. So these are two suspects that we are going to empirically investigate. So the first one is what we call the import penetration channel. The way we're going to think about trade competition is by computing import penetration. So import penetration is essentially the contribution of imports to domestic sales of an industry. So we look at imports in a given industry and divide it by sales minus exports plus imports. So after computing import penetration, which as we have seen rose in the aggregate, we are going to estimate a modified pass-through regression by interacting wage changes at the industry level with increases in import penetration for that industry relative to 1997. So a higher increase in import penetration will imply that domestic producers in that industry are facing more severe competition from foreign producers. So that's what we find. So when we look at import penetration, for industries where there is no change in import penetration, we find a 3% pass-through from wages to prices. However, as we see in the second row, increases in import penetration lowers pass-through in a given industry. So this, coupled with the aggregate rise in import penetration and competition that the domestic producers are facing, suggests a weakening of pass-through from wages to prices. And the second is the market concentration channel. So several recent papers have been focusing on the role of rising market concentration in the aggregate economy. Of course, market concentration could affect the degree of pass-through from labor cost to prices by changing the way that domestic producers set their prices. But the direction is not clear. A firm with high market power might easily pass labor cost increases to prices, but at the same time, a firm with high market power does not necessarily need to pass through labor cost to its prices if it has high markup. So what we are going to do essentially is to investigate in this channel by again considering a modified pass-through regression, where now we are interacting changes in industry level wages to measures of market concentration. And we are going to consider different measures of market concentration. So the first measure that we consider is top 4 firms market share. The second is top 20 firms market share. And the third one is the Herfindahl index. And again, the first row shows that actually we find positive pass-through from wages to prices, but market concentration has a positive and big negative effect on pass-through, offsetting the positive effect that we find from wages to prices. So then the question becomes, which one? Because our empirical strategy showed that both of these factors are at play, but it didn't really do much to differentiate between the two. But probably this is not really a bug, it's a feature, because what we are seeing is that these changes are actually correlated. So what we see in this plot is we look at industries and we rank them by their concentration measures, and we put them in buckets. And this is the average of 1997 to 2012 concentration levels. And then we look at how much import penetration increased during the same time period for these industries. And as you can see that in more concentrated industries, there was a bigger increase in import penetration when we consider top 4 sales or top 20 sales. So these changes seem to be correlated when we look at industry level data. So let me now end with an interpretation of these findings in light of models with variable markups such as Atkinson and Bernstein's 2008 paper. So one interpretation is that the entry of foreign competitors into the US market caused many domestic firms to exit, contributing to the increasing US domestic market concentration, as highlighted in a recent paper by Gauthier and Philippon. And this allowed the surviving large US firms to charge on average higher markups, which made it possible for them to at least partially absorb cost push shocks. So this interpretation actually connects the increase in import competition to rising domestic concentration and connects it to how firms set their prices, and therefore provides the link between these two related trends and the missing inflation in the aggregate economy. Okay, so thank you, and I'm now looking forward to Slavik's comments.
Thank you very much. So now let me introduce Slavik Sheremirov with his discussant presentation.
Hey, can you hear me?
Yes, we can hear you.
Thank you very much for inviting me to discuss this very interesting paper. Let me share my discussion slides with you. Okay. Can you see the slides now?
Yes, we do.
Perfect. Okay, so this is an interesting paper about a very important question. How do we explain the missing inflation puzzle? And the paper identifies the wage price pass-through as one of the main explanations. So let me first talk about what are these inflation puzzles. Actually, there's more than one. So if we look at the US unemployment gap data for the period starting, say, in 2005, until recently, we would see a wave that consists from an increase starting around 2007 and peaking in 2009, and then a slow decline and then recently. So if we think about the relationship between inflation and unemployment governed by the Phillips curve, we would expect a strong disinflation during the early period, followed by a strong inflationary wave after it. Well, if you look at the inflation data, and here you can see the core CPI data, you actually won't see much of the wave. So inflation has remained quite stable during this period. There's a little bit of decline around 2010, but then it went quickly up. So what is going on? Why we do not see the relationship between inflation and employment that many of our theoretical models predict? Well, I'll think about it from the perspective of the Phillips curve. So the Phillips curve can be written down as a relationship between inflation and period T. This is pi T here, inflationary expectations, the unemployment gap, UT minus the natural rate of unemployment, and supply shocks. So as you can see, there are several potential reasons why inflation could be stable during this period. So one reason is anchor inflation expectations. So as we know, the central banks around the world have become more transparent during the Great Recession, communicating their policy and invoking the forward guidance mechanism. And so now when they communicate their inflation target more effectively, consumers form the expectations so that inflation adjusts instantaneously to get back to the target. So that's one potential story. Another story would say that there was a decline in the natural rate of unemployment during this period because of the advent of the internet. So now with all the social social services that we have online, such as LinkedIn, that facilitate employment flows, it's easier for employees to move from job to job, and so the natural rate of unemployment is down. Then the third explanation would emphasize supply shocks. There were actually several industries, such as the telecommunication in the US and others, that faced negative price shocks during this period. And this theory emphasized that because we've been lucky, in a sense, we don't see a lot of inflation because these different industries had negative shocks. And probably one of the most popular explanation for the missing inflation puzzle is the decline in the slope of the Phillips curve. And I think deep inside, this paper is actually contributing to explaining the mechanism why the Phillips curve had flattened. So let me show you the next chart, which graphs the slope of the Phillips curve over time. So I estimate a very standard equation which allows for the backward-looking expectation components and the forward-looking components. And then I estimate it with 80-quarter moving windows starting in 1965 to 1985 and moving until today. So you can see that in the early period, the slope of the Phillips curve was about -0.2, -0.3, which implies a strong pass-through from changes in employment to change in inflation. But it started picking up around 1990, and then it went up to nearly zero. So now it's almost indistinguishable from zero. Okay, so what can explain this decline in the slope? So many practitioners see wage pressures as a key link between the unemployment and inflation. So intuitively, when the unemployment rate is low, there's a lot of competition across employers to hire new workers, so they would have to pay them higher wages. And when they pay them higher wages, their costs increase, and so they would have to pass through this cost increase into prices. And so you can decompose the slope of the Fries-Phillips curve here into roughly two components. So you can have a slope of the wage-Phillips curve that shows how wages change with unemployment, and the pass-through, wage to price pass-through that Isagul and co-authors estimate in their paper. So why do they focus on the pass-through and not on the slope of the wage-Phillips curve? So apparently the slope of the wage-Phillips curve didn't change as much. So I show two charts here. The left chart shows the average hourly earnings, which is a proxy for wages, and the right chart shows employment cost index, which shows total compensation. So you see a little bit of flattening for the average hourly earnings, but not as much as for the Price-Phillips curve. It's much less flattening for the ECI. So if it's not the slope of the wage-Phillips curve, it must be the pass-through from wages to prices, and this is exactly what this paper is focusing on. So the paper explores the rich industry-level data, but since as a macroeconomists, we're interested in the aggregate effects of these results, I decided to also present some results for the aggregate data. So the reason why the authors focus on industry-level data, because they can invoke much more controls and control for time fixed effects and industry fixed effects that you can't really do at the aggregate level. So you should take my results with a grain of salt. So what I'm doing here, I'm estimating the pass-through from wages to prices by running a regression. It's a standard Jordan's local projections regressions where you have leads of price inflation at quarter H, on the left-hand side and wage inflation on the right-hand side, and I control for the lags of wage and price inflations to control for pre-trends and autocorrelation, and also for some other aggregate controls to capture supply-side shocks. So there's some caveats, as I said, there are no shocks or instruments, so there's simultaneity problem and the segregate regressions, but they can still be interpreted as a VR with Cholesky decomposition with somewhat questionable timing restriction that price inflation does not affect wage inflation within the same quarter. So I will interpret this beta H as just reflecting conditional correlations between price inflation at lead H and wage inflation. So what do we get? The first graph shows the impulse response function for the core PPI producer prices to changes in average hourly earnings. So this graph peaks at about 8 quarters, and for a long period, we cannot reject the null of the pass-through being 1. So now I focus on the peak lag of 8 quarters, and I estimate the pass-through using the same moving windows as before. And you can see that the pass-through was much larger at the beginning, and then it started falling to, again, nearly 0 in the mid-2000s. So this aggregate fluctuation sort of mirrored the results that Isigul and co-authors show in their paper. Now, they focus on PPI data. I also look at the CPI data. And so you see a little bit less of a response. It's a little more delayed, but the overall picture is the same. You have a large pass-through in the early samples and almost no pass-through recently. So why did the pass-through decline? Well, so this paper offers 3 compelling explanations. One is the labor share has declined. And this is very intuitive because as firms have to pay less in terms of wages, then changes in wages don't really matter that much for them, so they don't need to pass through these changes into prices. The more interesting, I think, and a novel point is that because import penetration increased as China joined the WTO in the early 2000s, there's a competition from foreign producers in the US market that prevents them from passing through wage shocks into prices. So I think more generally, this paper points to the role of globalization and the fact that globalization makes domestic cost condition less relevant for pricing. Finally, they also find that market concentration has increased, and that contributed to the decline in the pass-through. So at first, it seems a little counterintuitive, but when you think more about it, actually, this explanation has a lot of sense, but it's also very nuanced. So I'll talk about it in the next slide or two. But I want to point out one thing is overall, it's very difficult to distinguish between these 3 channels because all of them happen around the same time. And they also affected a broad range of industries. And so running these regressions doesn't always tell us whether it's really import penetration from China or market concentration. I think Isigul pointed that out at the end of her presentation as well. So that's why this paper making a very important step to try and to disentangle these different channels. So concentration and markup. So in many standard models, markup is modeled as constant. So firms with monopolistic power would charge the price that would be 1 over 1 minus 1 over epsilon times their marginal cost. So here, epsilon is the elasticity of substitution. There is also a demand elasticity. So when epsilon goes down, we have less competition in the market, which implies a greater markup. So that's sort of the opposite to what this paper finds. And why is that? Well, so they point out that markups may vary, and they specifically vary in the oligopolistic competition markets. So think about the king demand that an individual firm is facing. So if a particular firm faces an inflationary shock, it will be less likely to pass it through because that would result in losing some market share to competitors. But if the shocks are deflationary, they would be more likely to pass it through because they can gain market share. So then you have this kink, meaning that on different sides of the curve, you have different pass-through. So as competition intensifies, pass-through from rising wages goes up. And that's the point of this paper. So I have a few comments. So one comment is that the relationship between concentration and markups may be nonlinear. So if it's not the case, wage increases would eventually erode the markup. So we would have a competition structure where firms have large concentration, but almost no profits. We don't typically observe that in manufacturing. So that points to some nonlinearity that may be not operational in this particular data, but it nevertheless must be in the model. Also, the oligopolistic competition may itself be unstable. This is because when firms compete aggressively, if one firm wins the competition, they become a monopolist, and so they move closer to the constant markup with a stronger monopolistic power. If firms are able to differentiate their products more, then they move towards monopolistic competitions, and then again, it becomes a constant markup with less power. The nature of inflationary shocks matters as well. So the paper is controlling for TFP, which is controlled for one part of the shocks. But more generally, I would think about differentiating between aggregate versus idiosyncratic shocks. So this is very important for the King's demand curve specifically because firms are less likely to pass through idiosyncratic industry shocks than aggregate shocks, because if everyone faces the same shock, then by firms simultaneously passing them through to consumers, they would not lose any market power. It also matters for persistent versus transitory shocks, because if the shock is persistent, eventually firms would have to pass them through to consumers, versus with transitory shocks, the key demand curve may be more operational. Finally, demand versus supply shocks. I think this paper is focusing mostly on demand shocks, but I think it's important to think about this pass-through in the face of supply shocks as well. And my third comment is that generally it is difficult to separate market concentration from import penetration, and these models in particular requires that foreign producers do not face the same wage shock. So in a sense, it's a heterogeneous producers model where you have producers in China that do not have the same wage shock as producers in the US. And that's why we see this kink where US firms cannot pass through wages to prices. Some other thoughts. I think monetary policy is very important here, because monetary policy with strong commitment can stabilize inflation, in which case theoretical pass-through would not be identifiable in the data. And also, I would like to point out that the relationship between wage and price pass-through may be nonlinear, and there's some recent work that finds nonlinearities in the price Phillips curve, and potentially there could be similar nonlinearities in the wage price pass-through as well. So let me conclude. And because we're all doing this conference remotely and going through the COVID-19 crisis, I had to say something about it. And to the extent that the crisis presents a risk of reversal in the globalization trends and less reliance on foreign trade, I think this paper has a lot to say about design of optimal policy going forward. In particular, if we see a flatter Phillips curve because of the rise in globalization and that trend reverses, we should see a steeper Phillips curve again, at least speculated based on the results of this paper. Well, if that's the case, that could change the balance between the short-term benefits of monetary and fiscal accommodation and the long-term costs. So I would be interested to hear the author's opinion on this trade-off. Thank you so much.
Thank you very much, Slavik. So before we allow Azigul to answer comments, I would also like to invite co-authors Sebastian Hayes and Fatih Karahan. So if you may join us for the discussion, since I see that you already started the discussion in the chat, but...
So let me first thank Slavik for really amazing comments. And I really like the way you translated our paper into the Phillips curve framework. We obviously had it at the back of our minds, but coming from the more micro side, we mostly focused on more disaggregated data. But this is really a very good way to summarize our findings and put it into more macro perspective. So before letting Sebastian and Fatih talk about your last question, so I'm not really sure what's going to happen in terms of import exposure or competition, because I feel like now we are competing with all the economists all over the world through Zoom. So it could lead to a winner takes all kind of market if there's one yoga instructor who is Zooming all over the world and who is the best one. So I'm not sure in terms of how the competition will change. But I think that's something we'll definitely think about. Thank you. And Sebastian, Fatih, if you want to add.
Yeah, thanks very much for the great discussion. I also really liked the macro evidence that you provided, these projections. I thought that was very nice, that actually confirmed what we found. I just had a small point on this nonlinear relationship between concentration and markups. So I think there we have to be a little bit careful, because you have this point that maybe that markups would erode if pass-through was permanently low as we move towards higher concentration. But I just want to say that as input penetration is also going up, firms can potentially get cheaper and cheaper inputs from abroad. So there could be this offsetting force that allows them to keep their markups somewhat constant, even though they're not passing through wages fully, because they're lowering their input prices at the same time. And yeah, that's kind of one thought I had.
Yeah, I just want to thank. I mean, I don't really have anything to add to what Sebastian and Shigul already said. I think the local projection is a great way also to motivate the paper as well. Thank you.
So one other thing I want to add related to discussions on the chat box is monopsony and monopoly. So we are still learning a lot of new facts about monopsony power and monopoly power, market concentration. So one thing that we are interested is whether increasing monopsony power is going to affect wage growth. So far, it looks like labor market concentration in the local labor market did not increase, and we are not seeing much of an effect on wages. But this could potentially affect the unemployment wage growth relationship that did not change over time. So that is something that we don't know much about yet, and I've started seeing recent work on that. But that's definitely interesting, because we still see a similar unemployment wage growth relationship, and this could be affected by changing monopsony power.
Okay, thank you very much. Now we move to other questions that we received both through chat. So far, we don't have any questions through Q&A. And one more time, I encourage panelists to raise their hands if you want to ask questions in live. But what we have so far, let me see. So we have a couple of questions, and as we discussed with Isaac Gül, I will read 3 questions in a row, and then you guys can answer all of them. So the first one, the paper uses idiosyncratic variation in wages to study the pass-through. However, the properties of shocks may be different from the properties of aggregate shocks. Could the authors comment on this? So the second question would be, the model estimates correlation. How much do the change in the coefficients reflect the changes in the composition of shocks rather than a structural change in the economy? Okay, and the third one would be, can the econometric specification link to a structural equation? For example, the Phillips curve with wage stickiness and price stickiness, which is similar to what Jordi Gali had in his paper. So is it possible? Okay, so 3 questions. Your answers, please.
Okay, so in terms, in terms of the second question about the change in the shocks, I mean, our regressions have time fixed effects. So to that extent that these the shocks are varying economy-wide, we would pick it up because we're controlling for those time trends. Obviously, to the extent that the shocks are industry-specific and time varying, that would be picked up in our pass-through regressions. That would show up as a change in pass-through. So that's something, yeah, we treat all shocks equally, and once we've purged the aggregate trends. For the structural equation, yeah, I think that's what the discussion has shown to some extent. I think that's possible. And I think that's a very interesting and good observation. I think we should probably try more to draw out these connections to the Phillips curve and so on. The first comment, I'm not sure. Maybe Aisha has some thoughts on that.
Sorry, can you remind me the first comment?
It was about the aggregate shocks and pass-through. Like to what extent is aggregate shocks versus?
Right.
Well, I mean, to the extent that we could control for them, we have time fixed effects. We are really exploiting within time, within industry variation. But other than that, yeah, we don't really differentiate between the two.
But I think the discussant's point about his regressions, I think that was quite interesting to show that in the aggregate, we also see a decline in pass-through. So at least that seems to be there also in the aggregate. And then obviously for concentration, we really rely on cross-industry variation to be able to pick up that effect.
And in terms of the question about idiosyncratic versus aggregate shocks, it's true that we use idiosyncratic shocks, but these are shocks idiosyncratic at the industry level. And so if you believe that the spillovers aren't that large, within a quarter, which is the variation that we're using, the difference between the response to aggregate shocks and the response to idiosyncratic shocks may not be all that different. So you can assume, like, you can think of our specification as thinking of industries as separate economies being hit by these idiosyncratic shocks, which may not be a terrible approximation within a quarter.
Okay, any other questions from panelists maybe? Okay, I don't see actually any more questions. We're still online. So if anybody has additional questions to the authors, they can write them private messages or contact them, and I'm sure they will be happy to answer. So now we move to the second presentation in our session. This is the worker heterogeneity and employment recoveries in the face of aggregate demand and pandemic shocks. And the presentation will be by Federico Ravenna from the National Bank of Denmark. Yes, please, Federico, you can share your slides.
Hello, let me share the slides. Okay. All right, so I'll start. Thanks a lot for the invitation and this great conference. And this is my first 6 hours in a row online experience at the conference. So I'm very excited to see how it ends. This is joint work with Carl Walsh at the University of California, Santa Cruz, and we are going to talk about selection in the labor markets. Let's see. So I'll first try to look into the question of who is unemployed. That's a question that's less often taken up by macroeconomists and monetary economists rather than simply how many are unemployed. And then we'll build, starting from empirical evidence, a model of selection and look at its implication for monetary policy and implications in the how these models can help us to think about the current pandemic. So we've seen a huge wave of separations happening in every country between firms and workers. So the first question is, who is unemployed when unemployment is high? And it's been already observed in several papers that even a shock which hit society at large, the pandemic recession, is not the so-called great equalizer. It has affected some category of workers more than others, some sectors much more than others. So workers are not really randomly chosen when they're separating. The first thing that we need to keep in mind is that They have a lot of new entrants and re-entrants in the labor market, but the share of job losers among the unemployed is very cyclical, and it increases during recessions. So we know that we have a very cyclical inflow from employment to unemployment. And of this, we know that certain groups are more affected. The volatility of workers with low schooling in terms of the employment rates is much higher than the volatility of workers with higher degrees. But there's also a dimension of unobservable characteristics, which is the one which we will focus on. There's been recently empirical evidence showing that the people who flow into unemployment in a recession, even keeping equal all the observable characteristics, in fact, they tend to be lower productivity or lower quality or lower efficiency workers. Grigsby has estimated that the mean human capital, unobserved human capital of employed workers rose by 10% during the Great Recession, because those with lower human capital were separating and flowing into unemployment. There's also a long literature about mismatch by now, showing that the skill mismatch is counter-cyclical, and that underqualified workers are the ones which are fired in a recession, reducing the mismatch in ongoing jobs. And this will have implications also for measured labor productivity, and that we also explore in our model. Keep in mind that there is a lot of reallocation of workers, so we should think of workers changing sectors and changing occupations, and once they need to rematch, somebody needs to assess their abilities. And it's estimated that around 44% of all workers which lose the job change occupation in their next job. So what we do is we take very seriously all this evidence, and we try to think about what are the implications, especially if you have severe contractionary shocks or large bouts of separations like we are observing in the current pandemic episode. So here is a way to think about the main mechanism at work in the model. Firms and workers needs to form a match. This will be a model with search and matching in the labor market. And there are varying productivity levels of workers. And here I've represented, which is this distribution, the productivity level separates. And this will be the workers who are in the lower part of the productivity distribution. So in red, you see the share of separating matches. This could be low, but what's important, responsive to business cycle shocks. Once I have a recession, I'll observe a large relative increase in the inflow into unemployment that's represented by this red bar moving to the right. So now additional workers are separating, which are of relatively higher quality compared to the ones separating in normal times. But remember that there's also workers which are separating all the time randomly across these distributions. So recessions will be times when relatively more low efficiency or low productivity workers enter the unemployment pool. And this will mean, in terms of measurable variables, that the distance between the productivity of the employed and the unemployed will increase during a recession. And that's the key to the mechanism, because when firms are hiring, they care about the productivity of the ones who are where they're fishing from, the pool where they're fishing from, which is the pool of unemployed. So why is this especially relevant for policy? Well, we think about this in the following way. Separations destroy matches, and with it destroy information about workers' productivity, and the matches need to be re-established. And this costs resources. And if it involves selection, we will see that it also leads to very amplified movements in aggregate variable. we also will see that there is an inefficiency in the market allocation that should be fixed by policy, and that if we are at the zero lower bound, monetary policy has a really hard time when there is a selection to bring the economy back to trend. So this is how we'll proceed. We'll now look at the model, and we'll ask how this selection works and what is the inefficiency that it brings about. And then we'll take the pandemics as an example of a shock where selection is at work, and we'll see what it means in terms of what the aggregate variables look like, how do different subgroups of workers experience a recession, and what happens if we account for the zero lower bound. So it's going to be a new Keynesian model with selection in the labor market. We try to keep it with as few rigidities as possible, and we need price rigidity to be able to discuss monetary policy and the zero lower bound. But otherwise, you'll see that it's a very efficient model in many other respects with very few distortions. So I'll only discuss the key parts which are important to understand selection. First of all, job creation happens through random matching. So a firm worker match comes from a random meeting. At this meeting, the amount at which these meetings happen will depend on the number of searching workers, ST, and the number of vacancies posted by the firm. And the firm will choose optimally the amount of vacancies to post. So for example, if there is a lot of unemployed, then a vacancy is going to meet with a searching worker more easily. So probably they'll post more vacancies, everything else equal. Generating these matches is costly because to post vacancies, you need to pay a cost, which we call kappa. And we're going to have two types of workers. So we could have a whole distribution, but it's easier to think about it in terms of two types. Ones are the high efficiency types, and then we need a group of workers with a lower average or lower expected productivity, which we call low efficiency. And remember, these workers are not distinguishable until a firm can meet with them and interview them. But there is a sunk cost. You have to pay this cost kappa to be able to figure out who these workers are. And for the low efficiency worker, because we want to have a constant flow of this worker going from employment to unemployment and the other way around, then they also have a idiosyncratic productivity. So once they're in a match, they could be more productive, but ex ante, they are expected to be less productive than the high efficiency workers. So everything else equal, the firm would always prefer to find a high efficiency worker. So if productivity is low, three things will happen in this setup. First of all, there will be endogenous separations. So low efficiency workers will separate from firms if they're employed. The second thing that will happen is that hiring will be more selective. So firms meet with a worker and they can become very picky. They can meet with a worker and say, oh, you know, your productivity is too low, so thanks for the interview, but we're not going to hire you. And finally, there's something that happens to the stock of unemployed. In a recession, it will become more tilted towards the low efficiency workers. So the quality of the unemployment pool will be time varying, and this will affect aggregate variables. So the key variable that we need to keep track of is what we call gamma, which is the share of low efficiency workers in the unemployment pool. Now I'll discuss the last equation, which is the key equation to understand why do we have an inefficient allocation. Wages are determined through Nash bargaining, so there's no distortion in how wages are set up from a partial equilibrium point of view. And this is the key equation that will decide how many matches happen in equilibrium, so how many people are hired. So on the left-hand side, you have the cost of posting a vacancy divided by the probability that the vacancy is filled. So you can imagine of this, you can think of this as the cost of creating a productive match. And on the right-hand side, you have the benefit for the firm. So, well, as a share eta is paid to the worker as a wage, a share 1 minus eta is kept by the firm. And you see that there is a difference between a surplus, which is really the value, the net value of this match. So the surplus that the firm would get from a high efficiency worker, which need to be subtracted of a term. And in this term, there's two parts which are time varying. One is gamma t, which is the share of low efficiency workers that I might meet. So as this share increases, this expected surplus is falling. And the second part is this 1 minus rho, which is the probability that I meet somebody that I actually want to engage in a match with after the interview. And this will also be cyclical because this separation rate, this rho, is going to increase during recessions. So let me say only this, that the inefficiency that we observe stems from the fact that firms take as given this share of unemployment of low efficiency in unemployment and also the vacancy filling probability, but in reality, the planner would take them into account. If I hire somebody who is high efficiency, I'm making it more difficult for everybody else to find a high efficiency worker and damaging them. And this results in too low unemployment for high efficiency worker and too high unemployment for low efficiency workers. Okay, let's think about a COVID recession. We're going to take an economy which has a share of low productive workers in the labor force around 23.3%. These workers are really not, on average, not much less productive than the high efficiency workers, but there is a very large variation in how productive they can be. And we compare it to an economy where there is reallocation, but this is not cyclical. So there's also high and low efficiency workers, but their share doesn't change with the business cycle. So endogenously doesn't change. And we're going to think of a recession driven by a pandemic as being the combination of two shocks, both coming from social distancing. One, there is a random increase in separations because you're just at the workplace, you cannot be as many people as you used to be in the office. And another one is coming from a loss of demand. The social distancing on the consumption side, so the demand for market goods is falling. And we're going to target a certain path for separations, for total separations, and a certain path for output, and see what happens to all the other variables. So we cannot really say something about, this is not a forecast about output, it's a conditional forecast to look at what happens to subgroups and the experience of unemployment in the economy. So the first thing to observe is that if I look at the model with selection, which is the solid line here, I end up with counter-cyclical selection. So this endogenous selection accounting for 60% of all the separation that I want to target. If I had a model without this counter-cyclicality, this pro-cyclicality of separations, counter-cyclicality of separations, then I would see that I require a much larger exogenous separation shock. So in both models, we're going to have total separations going at the same rate, but selected separations, so the endogenous one and the separation shock is going to go in different directions. So what happens in the aggregate? I think I'd like to focus besides what happens to output, which is amplified by 2 percentage points if we use the same demand shock for both economies. The more interesting part is the plots on the right-hand side, where we see the unemployment rate increases up to 10% in a model with selection and up to about 4% in a model without selection. And one way of thinking about what is happening is looking at average hourly productivity for the unemployed. It's basically constant if I don't have selection, but if the people who are fired are the ones with lower, let's let's say human capital, for us lower productivity, then the expected productivity in the pool of unemployed is going to fall by up to 6 percentage points. So we are creating an endogenous TFP shock among the unemployed, but that's the one firms care about because that's where they're hiring people to form productive matches. And this doesn't only hurt the low productivity people who are screened out, this is also hurting everybody else, because in equilibrium there will be fewer vacancies per unemployed worker. And if I have fewer vacancies, I also have a lower probability of creating a match also for high efficiency worker. Now I'm going to look at subgroup impact. Who bears the burden of this COVID recession? So it turns out that if I look at an economy with selection and one without selection, the problem is really for the low efficiency workers. They're going to see an increase of nearly 35 percentage points in their unemployment rate, much more than they would see in a model without selection. What happens to the high skill or high efficiency workers? Well, they increase their employment rate by 2.5 percentage points, and it doesn't matter in which ward they are, because mostly they lose the job because they're going to be hit by this exogenous separation shock. And here you see what happens to the job finding probability. It falls by 35 log points for the low efficiency and just by 10 log points for the high efficiency. Now, something that we can generate with this model, it's an interesting disconnect between wages, productivity, and unemployment. This is what happens to average total earnings. So if you look at the solid line in the top panel, this is the average across all employed workers. So it falls by about 7%, and then it goes back to trend. But the low efficiency workers, their wage is actually increasing because firms are retaining the good low efficiency workers and they're shedding the ones with the lowest productivity in this group of low efficiency workers. Now, what if we are at the zero lower bound? We will see that this amplifies the increase in markup that we observe in the economy, and selection then amplifies the impact of the resulting fall in demand. And in the long run, what matters is selection, not so much the zero lower bound. So we look at an experiment where we are at the zero lower bound for 4 quarters, and this you see in the lower left-hand side panel. The nominal interest rate until quarter 4 is at 0, and then it starts increasing towards its long-term rate. Retail output falls by an additional 5 percentage points, so the zero lower bound is amplified by 50% the impact. And if you look at the unemployment rate, that now increases by about 16 percentage points relative to its steady state, which is around 5%. Most of the fact that monetary policy cannot stabilize enough the economy are in fact the low efficiency workers. I have 1 minute to conclude and to discuss the fact that compositions and changes in who is unemployed and who is employed delivers some pretty characteristics dynamics in wages. So wages after 4 quarters, they're back to the trend, while the unemployment rate is still at 10 percentage points above the steady state. And wages are actually increasing at the same time as average hourly labor productivity is falling. And this depends on the fact that the wage depends on the composition of who is employed, and not only on today's productivity, but on the overall expected value that the firm can extract from the match. So to summarize, we have built a model which is consistent with empirical evidence on selection on labor markets. Even in the face of a lot of unemployment that affects all workers, we have a paradox of some separations where we will end up with a lot of endogenous separations which are inefficient. The inefficiency comes from this externality of firms not not accounting for the fact that they're damaging the perspective of other firms and other workers when they take off from the pool of unemployed by hiring a certain amount of high efficiency workers and the screen workers. The average productivity of the pool of unemployed relative to that of employed will move procyclically. And importantly, the constraint of the zero lower bound implies results in a differential impact across workers, and the ones that suffer the most are the ones which are with the workers which have the worst expected lifetimes outcomes. I'll stop here. Thank you, Alexander.
Thank you very much, Federico. So now we move to a discussion. I invite Alexei Kritsov from the Bank of Canada. Alexei, please. Yeah.
Hi, can you hear me?
Yes, we can hear you.
Good. Let me show my screen. I hope you can see my slides.
Not yet. Okay, now we see it.
Great, thanks. Hello, everyone. So first of all, thanks very much for giving me the opportunity to read this paper. I enjoyed it a lot, and I also learned quite a bit about this wonderful literature. The paper is about this mechanism where in recession, less capable workers are more likely to leave the workforce, and then also less likely to find another job after that. And the empirical part of that literature goes back at least until the 80s, and they document how less capable can be associated with observed characteristics like age, level of education, or skill. And this mechanism has proven to be very useful for understanding interesting facts about the labor markets, such as the slow recoveries after recessions, and also the decoupling of wages from employment that became especially more pertinent more recently, in particular during the Great Recession. So that's the broad theme. This paper takes this mechanism and applies it to the current experience of economic crisis during the COVID pandemic. The backbone of the paper is the Nikesian business cycle model, augmented with search and matching frictions in labor markets to think about the labor market flows. I think it's important to say right away that the focus around the selection mechanism is quite a bit more narrow than I said in the first bullet here. The authors focus on selection associated with productivity differences across two types of workers who otherwise compete for the same job. So it's not about composition related to workers across different occupations or across different industries. And I'll say more about this later on. The previous, so there's an earlier version of the paper in James CB 2012, which lays out this model quite well and explains a lot of mechanisms that are also that are present in this paper. But in that paper, application is about understanding differences between the strength of the selection mechanism between United States and European Union, where the labor market flows are quite different. In this paper, the focus is different. It's new. There's the focus on this stylized COVID scenario, and the model is calibrated to US data. And the paper also is set up so that they could analyze the implications for monetary policy, which is also very useful and very fitting for this conference. So let me first start with going through the model's key features. The sort of households are a big set of members. There's a continuum of its members. who can work. And workers can be of two types: high efficiency workers and low efficiency workers. They differ in productivity in the following way. High efficiency workers have productivity level phi high, and low efficiency workers have lower average productivity captured by the phi low parameter, which is lower than phi high. And they also can experience these the specific shocks specific to low efficiency workers captured by AL, where it's driven from a distribution with finite support here. The assumption is that these idiosyncratic shocks are IID, which makes this model very tractable. And I think it's a very elegant feature of this model. In particular, you only need to keep track of 4 worker states. So employed workers can be either high or low types, sort of more or less productive. And when they become unemployed, they still have their innate average productivity that is high or low. So 4 types of workers that you need to keep track of. So there's random matching technology between these prospective workers and firms based on the standard matching technology function. There is a function of vacancies and the share of job seekers. When a match happens, it's still not necessarily a match for the job, because it's an interview where during the interview, the firm finds out the worker's productivity, which otherwise it doesn't observe. Okay. Based on the observation of productivity, it decides whether to offer this worker a job or not. Under these assumptions, the firm will offer high efficiency workers the job always, so it will always hire high efficiency workers. But it will screen out those low efficiency workers that experience bad enough productivity shock. Okay, so that's screening. The wages are determined by Nash bargaining with the parameter eta, so that's a standard feature of these models. An additional new feature is separations that have 2 components: exogenous component, which applies sort of equally to separating with high and low efficiency workers, and also an endogenous component, which works very similar to how the screening works, which is the worker who is employed of low type realizes the value for the idiosyncratic productivity shock A, and if that value is low enough, the firm decides to let this low efficiency worker go. Okay, so that's the endogenous part of the separation that applies to those low efficiency workers that happen to be unproductive. Those workers that separate from the firm, there's a loss of information by the firm of whether those workers that it let go had high or low productivity value. So when the firm loses a worker and it has to go and look for another worker, it does that blindly, because the search is random, and at the point of search, the firm has no idea about the level of productivity of the worker, which also is a crucial assumption. So how does the selection mechanism work? Start with a homogeneous case when there's no average productivity differences between workers, and what happens is that there's not going to be difference between the productivity of those workers that are in unemployment pool, because on average, by assumption, the productivity is the same, and so there's going to be no decomposition effect in this homogeneous case. So that's kind of standard Euclidean model with searching matching frictions. Now change one thing: differentiate the average, the permanent productivity levels for high and low workers. Introduces heterogeneity. And assume there's no screening at this point, just endogenous separations. What will happen is that at the time of the recession, and I think it's, for the sake of example, you can think of recession driven by the sort of TFP shock, bad TFP shock, but I think it applies also when the recession is driven by falling demand. What happens is that during the recession, the firm wants to improve the pool of the workforce that it has. And so it decides to let go of those low efficiency workers that happen to be unproductive this period. what it does is that it increases the share of low efficiency workers in the pool of unemployed workers who have both the mix of low and high efficiency workers. So the share of low efficiency workers goes up. The firm understands that during the shock, that's what's happening. The composition of the pool of unemployed biases more and more towards less productive workers. What this does to a firm, it makes it less incentivized to post vacancies because the surplus, the present discounted value of the surplus for the firm from having a match is lower now. So that's a so-called composition effect that's related to the fact that endogenous separations increase the share of low efficiency workers in the pool of unemployed. When firms post less vacancies, it means that it's harder for either type of unemployed workers to find another job. The lower value of the surplus from the matches also means that during this time, real wages go down. Now, there's already here this composition effect going on, but it's not very powerful just because when firms need to hire and have no ability to screen, they will hire workers of both types. What gives this mechanism extra power is this screening. It's another bottleneck. What happens is that now, low efficiency unemployed workers also are less likely to find a job than the high efficiency unemployed workers, because some of them, those who will realize low idiosyncratic shock, will actually be screened out by the firm, even if they get an interview. What this means for the firm is that the firm now realizes that it will have to wait even longer to fill a vacancy, which lowers its incentive to post a vacancy even further. So that's so-called incentive effect associated with the fact that the screening makes the likelihood of finding a job for low efficiency workers lower. At the same time, because the firm can screen out less productive low type workers and leave those who are more productive, it means that the level of productivity of the workforce goes up, and so real wages go up, at least for the low efficiency types. I think an important sort of implication of this setup is this powerful amplification mechanism that works through two endogenous variables here. One is this threshold of the productivity idiosyncratic to the low efficiency types that is part of the decision of screening decision of the firm. And the other one is the fraction of low efficiency types in the pool of unemployed. And both of these objects move in a way that they amplify each other. Higher threshold for hiring low types make it more likely for the firm to separate with low efficiency types, which of course increases their share in the pool of unemployed, so higher gamma. Now, when there's this higher share of low efficiency types in the pool of unemployed, that lowers the value of the match with prospective employee for the firm, lowering the incentive to post the vacancy. If the firms have to become more selective, which means higher threshold for hiring low type workers. So this is a very powerful amplification mechanism, and I think it sort of very elegantly comes out in this model. I think it's a very attractive feature of this mechanism in this model. So in my comments, I'll try to think about the COVID shock scenario in this paper and sort of expand the context for the exercise that is actually done in the paper. In the paper, the COVID shock is the simultaneous rise in exogenous separation rate and the fall in consumption demand that I assumed. It's a sort of scenario. This model is useful with this scenario for thinking about at least three things. One is the shape of this scenario, of the recovery after this crisis. And in this model, it's going to be very protracted recovery. The asymmetry across outcomes affecting high and low efficiency workers, even if the shock itself is very symmetric. And third, it's useful to think about flows in and out of unemployment. So first of all, in the model, by design, because the spells of unemployment are so long and the fall in unemployment is so high, the model naturally fits the scenario where the recovery is going to be L-shaped. Of course, the data is still evolving, and whether the recovery is going to be V-shaped or L-shaped is yet to be determined. I make two comments about this. One is, the feature of this model is that the layoffs are permanent. When you let go of a worker, you forget the worker's productivity type. There's this paper by Mariana Kudliak and co-author that looks at the recent data from this Federal Worker Adjustment and Retraining Notification Act, where firms, small businesses, can report the expectation for whether their layoffs are temporary or permanent. And what they document is that for the fall of unemployment in the first two and a half months of this year, which was about 2.7 percentage point up, 10.8 percentage point were actually reported as temporary layoffs, 0.4 permanent, and the other reasons for layoffs were actually went down, the rate went down. So this sort of points to the importance of understanding the data today and whether, how permanent the separations that are happening during the COVID pandemic is. And I think it shouldn't be difficult for these co-authors to think about the mix of temporary and permanent separations in the model. The other point I want to make here is that it seems that the economic crisis is tightly linked to the health crisis. And although the model doesn't have explicitly the modeling of the health crisis and its relationship with economic crisis, I think if the paper added the health crisis, it will predict that economic recession would actually last longer after the health crisis. But maybe this is something the authors could consider in the future. The second comment here has to do with assumption in the model that the shock affects sort of both assumptions of the shock, separation rate and demand, is symmetric. It affects either type of workers equally. Of course, in the data, there's a lot of evidence that different industries and occupations, jobs are affected very differently by the pandemic. I give two examples here. One is that you could look at across industries and give examples of those that fall a lot, such as personal services, food, and so on, and some that are not disrupted. Economists. Not only different sectors are hit differently, but they have different ability to be flexible in accommodating workers to work from home. There's this paper by Dingle and Nyman that document that there's large variation in ability to telework across occupations, industries, and countries. On the theory side, there's new papers emerging that discuss how the sector heterogeneity can actually lead to amplification of the economic outcomes during the crisis. A recent paper by Guerreri and co-authors talks about how the supply disruptions in multi-sector setting under certain conditions can lead to demand contractions that even larger than the supply shocks themselves. So I think the interesting version of this paper, expansion of this paper, would be to add two sectors, two sort of heterogeneous types of jobs, and see whether compositional shifts that are due to the mechanism that is currently here within jobs, how does that interact with compositional changes as across industries? I'll mention one more feature of the paper, which is there's no in and out flows into labor force assumed here by assumption. And that's an important reason why the mechanism gives such a big effect on unemployment. There's a recent paper by Yuri Gordyshenko and co-authors here looking at the Holmescale-Nielsen data that document that out of the 20 million workers who lost their jobs by early April, relatively small, surprisingly small change was associated with increase in unemployment, only 2 percentage points, but there was a huge change in participation rate, where participation fell by 7 percentage point. And a large fraction of that fall in participation was actually permanent in nature. A lot of them took early retirement. I think it should be relatively straightforward to add endogenous labor force participation in the model here and think about how that will weaken the selection mechanism in the paper. I'm out of time, I think, and so I'll just add with a quick take on monetary policy here. One is the nod to David Berger's presentation earlier. In the environment when there's a mechanism that gives a lot of variation to the level of unemployment during a shock like the COVID crisis, that could be a case for monetary policy to sort of pay more attention to how to, whether to pay a lot of attention to the price stability as opposed to really try to react to the change in unemployment. And another point about monetary policy here is that in this model, the trade-off between inflation and unemployment is not favorable for central banks that favor inflation or price stability. And so the question is, in this model, if monetary policy decides to really respond to unemployment, will it generate a lot of inflation? Or if monetary policy is constrained, like it is in the experiment considered in the paper, whether they're going to be deflationary pressures. My reading is that right now in the paper would conclude that it's rather the latter, that this mechanism is probably associated with a lot of deflationary pressures during the pandemic. And I'll start here.
Thank you very much, Alexei, for this comprehensive discussion. I would also like to invite Carl Walsh, who is the co-author of the paper, to join our discussion. So please, Federico, if you want to answer comments of Alexei, you're welcome.
Okay, in the interest of giving space to question and to Carl's remarks also, I'll answer 3 questions and then I'll fold maybe the other answers into when we have more questions. I think one of the things I learned from Alex's discussion that was really very, very thorough is that it's complicated to think about the pandemic shock, and we certainly didn't want to dismiss a lot of the complications, but it's fair to say that we did not include them, especially about the occupation changing and sectoral shocks, and having 2 sectors could be a very good idea. Now, to this, let me say that we are thinking about, so what's key for us is how many of these workers who end up not employed anymore, so who separated, need rematching, because that's where there is going to be the cost to the economy in terms of net loss of resources for having this changing in occupation, changing in sector, and building a firm worker match again, which will build over time some firm specific human capital. When we think about separations, I think we used a number targeting separations, which was about 1/4 of the worst case scenarios, and that was to account for the temporary layoffs. Bloom and Calders have a paper where they estimate from previous state level data in the US that about 42% of all separations end up being permanent, regardless of whether they started as temporary. So that's we try to be conservative there, exactly because a lot of the separations, they are expected to be temporary. Then, as a second comment is about supply shocks. I think it's important to see that in a search and matching model of the labor market, an increase in the separation rate is really a supply shock, because not only it's severe the match, so then the match needs to be recreated, spending resources, but it also makes any future match with the same person, which has a higher separation rate, less valuable to the firm, because the firm cares about the whole expected flow over the lifetime of the match that it's going to obtain from the worker. If this worker is going to separate with a higher probability, that's going to be a smaller value to the firm. And so this acts really as a supply shock. It's equivalent in a certain way to any fall in TFP. And finally, let me say about monetary policy. If we were not at the zero lower bound and you wanted to avoid a very large increase in unemployment, you would have to be very expansionary and you would end up with a lot of inflation. And that's what we found, even if we haven't discussed it. But at the Z lower bound, there's not much that you can do. You would like to be more expansionary, but you cannot because you are at the Z lower bound. So the shock ends up being very deflationary. In our model, because we don't have any backward-looking inflation, part of inflation, it ends up being hugely deflationary. So maybe I wouldn't buy that as a prescription, as a forecast really for inflation. But it will be a deflationary shock in as much as we see as we see now in the data and in the current debate. Maybe Carl can address other questions or the issue of efficiency of separations.
So Alexei, yeah, I thought they were great comments. Really found them useful. So thank you. Let me comment on a couple things. One is that, and this has to do with sort of sectorial, a multi-sector model, various other aspects of worker heterogeneity based on observables. Again, it's important to, we're focusing on unobservables. And so if you think of a more general model, you can think of lots of observables that contribute to the way we think of heterogeneity. But within each group of workers characterized by all their observables, there's still unobserved heterogeneity. And that's kind of what we're focusing on. So even if you had a sort of different labor markets for different worker types or different worker skills or different sectors of the economy, within each of those, workers are still not identical. And that's why, take the academic labor market. We don't randomly select a new PhD to hire. We interview them and meet them, and we learn something in that process about their unobservable differences. And that's what really drives the selection in our model. And so it would still be present in a more disaggregated model where you disaggregate it by observables of workers. This sort of selection aspect, the screening aspect is still at work. And so what it leads to is that matches, which in a standard search and matching framework, matches are identical with hires. Screening means that matches are not equal to hires. And the observed efficiency of the matching function then moves pro-cyclically. In a recession, fewer matches turn into hires. And so it looks like the matching function has become less effective, and that mechanism is sort of really key. And then on the efficiency, we're all aware of the kind of congestion externality associated with a standard DMP model. So that's present. You can fix that with a Helios condition. But here there's also a composition externality that a firm's decision about whether to hire a high efficiency worker, screen out a low efficiency worker, has an impact on the pool of unemployed and therefore affects the ability of other firms to successfully make a hire. And that's an externality that the firm itself does not internalize. And so what we do is we look at the social planners allocation. And in that part of the paper, we generalize to allow both low efficiency workers and high efficiency workers to be subject to these idiosyncratic productivity shocks. And relative to the social planners allocation, firms are more likely to lay off low efficiency workers and reject them in the interview process than the social planner would. They're more, and therefore unemployment rates, layoff rates, duration of unemployment is going to be much worse for the low efficiency workers relative to an efficient allocation. And in the case where high efficiency workers have idiosyncratic productivity, they're going to have durations of unemployment that are too short, layoff frequencies that are too low relative to the social planner's equilibrium. And so I think that's another interesting aspect of the model. One reason we can show that is we've kept the structure very parsimonious. But I think the extensions to thinking more about sectorial allocation, labor force entry and exit would be certainly interesting extensions of the framework to kind of focus on these mechanisms. So Alexei, thanks for the comments.
Thank you very much, Carl. So we have time for one or two questions. The question from chat, Nick Bloom has a recent paper suggesting that COVID-19 is also a reallocation shock. that some industries will not return. What would this imply in your model?
So, Alexei raised the point that there's some evidence that a lot of people who are, at least in the US, who lost their jobs view their layoffs as not permanent, as temporary. Our model is one where essentially layoffs are all permanent because you've lost that knowledge about the individual worker. I think if there's lots of sectorial reallocation, it's closer to the framework we're looking at, where the unemployment, you lose your job in one sector, that's a permanent loss of knowledge about your skills, and therefore reallocating or relocating to another sector is likely to need this knowledge building screening process to occur again. So I think it's an environment where our mechanism would be sort of more important than one where all layoffs are essentially temporary, or there's no information, worker specific information that's lost in a layoff.
Okay, thank you. Another question that's, let's say, the last question that we have for this presentation would be, if firms need more time to interview or to observe the type of the worker, does it mean that the recovery will be more sluggish?
So my short answer would be yes. One of the things that's going on in our model is this loss of information that comes from the knowledge a firm gains about its worker. We make it all on the sort of idiosyncratic productivity of the worker. Clearly, there are match worker aspects of that information that a firm and a worker gain about an ongoing match. And when you lose that through a separation, it has to be rebuilt. And to the greater the extent there is the importance of this sort of idiosyncratic knowledge about the fit between a worker and a vacancy, I think the longer it takes to kind of recover that initial unemployment rate.
Okay, thank you very much. There is also a couple of, I guess, one question from Carl Valentin. So we can take one more minute to answer it. So Carl writes that Andreas Müller in the American Economic Review in 2017, he documents that the unemployment pool is counter-cyclical in terms of previous wages of the workers. How does that square with the main mechanism in your model?
Federico, you want to take that one?
Yes, so the short answer is that it doesn't. So that paper essentially seems to find that recessions are great times to hire because you get relatively better workers, and that would happen if you imagine an economy where essentially people are fired. They're coming from firms that go bankrupt, probably they go randomly bankrupt for reasons which are exogenous to these firms being more or less productive, and then you end up with workers which comes from all sorts of productivity levels. I think that it's every paper that uses hourly wages, I think it was from the CPS, can run into some complications of measurements because this number of hours is self-reported. We have more recent evidence which seems to use various sources of data, including SIP data, which goes in a different direction. But that's certainly a paper that would give food for thought to a model like ours. And thanks for pointing it out.
Okay, thank you very much, Federico, Carl, Alexei, and our audience for good questions. This is time to finish with this presentation, since we have to move forward in our program. So next we will have a short speech by Kenneth West from University of Wisconsin, and currently he is the co-editor of Journal of Money, Credit and Banking, and this annual conference of the National Bank of Ukraine and Narodowy Bank Polski this year is supported by GMCB. So Kenneth will tell us a couple of words about submissions of papers to GMCB. So we'll be back in a couple of seconds. I'm sorry to interrupt. Unfortunately, we are not able to hear you. Maybe your microphone in Zoom is unmuted, but maybe you have some troubles with your hardware.
Hello, everyone. I'm Timothy Milovanov. I'm going to chair the panel. We will have Christopher Erceg, Sergey Guriev, Andrzej Rachko, and Yulia Sviridenko speak about labor market and monetary policy. We'll start with Christopher, who will discuss his perspectives on the current labor market situation and the monetary policy interaction with us. Christopher, the floor is yours.
I just have to first have my slides shared. So I'll just do that. So desktop. Okay. Where? They should be able to see your screen. Okay, do you see where the slides are? Yeah, so right there. Open your slides. Where'd you see them? Right there. Those aren't my slides. Oh, okay. Shoot, we need to go to your folder. Yeah, just tell them just a minute. Okay. Where, do you know where the folder is? Yeah, it's right down here. Okay, good, right there. Okay, almost. And then you should go to my file. Download? Right here? Yeah. Good. And then yeah, there's. Okay, I think almost set. The host. Oh yeah, okay. And share. Where? Go to share. Sure. And then this. Can oh, I'm sorry. Now I have to. Just go back. Okay. Maybe the microphone is okay. Okay. We just start. Yeah. Okay. Go. Okay. Okay. There you go. Do you think they can see my slides? Can you see my slides? Oh my lord.
Well, we can see something, but it's to me it's a black screen at this moment.
Oh, it's a black screen. I'm sorry. Let's see. Do you see? Okay. Okay. Can you see now?
Yeah. Yeah, we can see.
Excellent. Sorry for the hitch there. Thanks, Brent. Can you stay around just for a second? Okay, so I will get started. So the COVID-19 pandemic has induced an astounding collapse in employment around the world. Beyond the grim statistics and ongoing human tragedies that unfold each day, there's substantial uncertainty about how this crisis will play out that depends both on medical advances and on economic policy responses. My discussion will begin with a brief overview of the recent downturn in the labor market, and then consider headwinds likely to affect the pace of recovery. I'll then turn to the formidable challenges facing monetary policy. I should state at the onset that these views are my own and do not necessarily represent the views of the International Monetary Fund or its staff. One of the salient features of the COVID crisis has been the rapid swoon in employment across much of the global economy that really defies historical comparison. I'll highlight just a few aspects. First, while some of the massive rise in unemployment is expected to reverse fairly quickly with the easing of quarantine measures, unemployment is expected to remain high for a protracted period. For instance, a Congressional Budget Office forecast released last week projects that US unemployment will remain close to 9% even in the final quarter of 2021. And moreover, persistently high unemployment is likely around the globe. Second, in contrast with previous recessions in which employment declines were typically concentrated in cyclically sensitive sectors such as manufacturing, the COVID recession has pummeled the service sector, including areas such as retail trade that are both labor intensive and typically more resilient during recessions. So you can see that in the figure in the US case, just the number of jobs lost in the leisure and hospitality sector at the top. So many small and medium-sized firms, mom and pop stores that involve close social interaction, such as restaurants and beauty salons, have been caught in the wake. This shock has also had disparate effects across geographic regions and countries, given the substantial differences in what they produce, with tourism and energy salient examples. Finally, the combination of a weak overall labor market and complications of searching for a job have greatly depressed labor force participation. This is apparent in BLS data, as well as in novel high-frequency data derived from surveys, for instance, in Yuri Grodnichenko's work, a theme to which I will return later in my discussion. With this backdrop, I'll next consider some factors that may weigh on the pace of labor market recovery. Central banks were already facing the challenge of low inflation and very low equilibrium interest rates, or R*, before the COVID crisis, including from long-term structural forces related to demographic change and slower potential output growth. Major central banks had launched framework reviews to assess whether their tools were adequate and strategies appropriate to confront even a garden variety recession. Of course, the COVID crisis struck as a Category 5 hurricane. Well, there's a great deal of uncertainty about the path of recovery, and upside as well as downside risks. A full recovery in employment may well take years. What does seem likely is that the COVID shock will intensify downward pressures on R* and inflation that are likely to prolong the process of economic recovery, as well as amplify downside risks. In this vein, I'll begin by discussing some key headwinds that are likely to depress R* in the short to medium run, even well after the medical crisis has subsided, and that affect the labor market through standard aggregate demand channels. I'll then turn to some potentially important labor reallocation effects. The first key headwind is a massive deterioration of public and private sector balance sheets. At a federal level, the large increase in public spending deployed to cushion the effects of quarantines, including to reduce the risk of widespread insolvency, will likely boost debt to GDP to levels that are unprecedented in most of the post-war period. For instance, the US Congressional Budget Office released a preliminary forecast indicating that the US debt to GDP ratio could rise by over 25 percentage points relative to its pre-crisis baseline to 108% of GDP by the end of fiscal year 2021. Concerns about debt sustainability may well prompt a fiscal about-face in the direction of premature tightening that could markedly slow or even imperil recovery. Well, this would be an unfortunate policy for countries that have ample fiscal space and capacity to borrow at low interest rates. Fiscal consolidation may be unavoidable for countries that may face severe borrowing constraints, including many lower income countries. Lower levels of government, including states, provinces, and municipalities, may also feel deep strains given their limited tax bases and may be forced to make sharp cuts that raise unemployment substantially. In some jurisdictions, balanced budget rules may intensify the cuts. Corporate balance sheets will also deteriorate as corporations around the world suffer major revenue losses due to domestic quarantines, the collapse of external markets, and higher funding costs. While household balance sheets will deteriorate as a sharp rise in unemployment induces saving. Many corporates had binged on cheap debt before the crisis and hence were highly vulnerable. This theme was often highlighted in financial stability reports, including the IMF's flagship GFSR. The COVID shock will weaken balance sheets much further and thus restrain both corporate investment and household spending. A second key headwind is a high level of uncertainty facing firms and households. Higher uncertainty facing firms on both the demand and supply side is likely to restrain business investment by increasing the option value of waiting. Emerging market economies and lower income countries are likely to be particularly affected by heightened uncertainty about the implications of the pandemic for global supply chains and the multilateral system of trade, which is likely to act as a further brake on global investment. Household demand is also likely to remain weak as uncertainty about job prospects induces precautionary savings. A third headwind is tight financial conditions for many classes of borrowers. The rebound in equity and corporate debt markets, spurred by the aggressive deployment of stimulus by governments and central banks, has been remarkable, but small and medium-sized enterprises are likely to suffer as deteriorating balance sheets and earning prospects reduce their access to credit. Well, labor market recovery depends crucially on these and other factors influencing aggregate demand and to some extent supply. It also depends on factors more specific to the labor market, including the potential to reallocate labor across sectors or industries. The key question is whether workers will return to the same jobs and employers, or whether they'll have to seek new employment relationships as the old ones are destroyed, with the intended loss of firm-specific capital. While many analysts project a V-shaped recovery earlier this year, expectations have shifted towards a slow recovery in which many jobs will be destroyed due to bankruptcies and firm downsizing. Some geographic regions or countries within currency unions, such as the euro area, are likely to experience disproportionate impacts due to COVID-related shifts in demand away from key sectors such as tourism, as well as intra-industry shifts such as from restaurants to meals at home. While surveys suggest that many workers expect to return to their same jobs following furloughs, recent research by Barrero, Bloom, and Davis suggests that more than 40% of layoffs in the United States may be permanent. The process of reallocating a substantial part of the workforce to new firms, as well as to potentially new industries and geographic regions, is likely to be time-consuming and costly. The beverage curve shifted out substantially following the global financial crisis, as skill mismatch arising from the collapse of key sectors such as construction was compounded by other factors, including policies that disincentivized job search or limited worker reallocation. These factors, including the degree of skill mismatch, are likely to be consequential in determining the pace of recovery from the COVID pandemic. The headwinds just discussed are likely to be a persistent further drag on the cyclical component of our star, even after the medical crisis is abated, and contribute to a protracted period of high unemployment. A lesson from the global financial crisis is that persistently high unemployment can in turn fuel various scarring effects on the labor market, including an increased frequency of long-term unemployment, a significant drop in labor force participation, and deterioration of worker skills. The US experience is particularly telling in this regard. Before the GFC, recessions typically lasted only 9 to 12 months. While it took longer for unemployment to recover, there was relatively little increase in long-term unemployment. By contrast, the prolonged rise in unemployment in the wake of the GFC induced both a large rise in long-term unemployment and drop in labor force participation. The scatter plot here shows that states with particularly large run-ups in unemployment, let me just go up a little further, shown on the horizontal axis, over the 2008 to 2010 period often experienced large housing busts, if they had big rises in unemployment like Nevada, had especially pronounced declines in prime-aged labor force participation, shown on the vertical axis. So this draws on my research with Andy Levin. The ability to cut policy rates in the recessions before the GFC, policy rates were typically cut in the range of 500 basis points during the 1990 and 2001 recessions, clearly helped limit these scarring effects from emerging, just as the binding effective lower bound constraint, or ELB, during the past decade served to amplify them. Accordingly, a major risk with COVID is that the effective lower bound constraint will substantially slow the pace of recovery and contribute to scarring. How should monetary policy respond, recognizing that the ELB now binds well out the yield curve for many countries, so that even key unconventional monetary policy tools of the past decade, such as sovereign debt purchases, may have diminished traction? This question bears both on the appropriate monetary policy strategy as well as tools. Turning first to strategy, it's helpful to begin by considering the implications of the effective lower bound constraint within the context of a simple DSG model that includes endogenous labor force participation to help capture scarring effects. For the purposes of illustration, an aggregate demand shock is assumed to drive up the unemployment rate substantially relative to baseline. Figure 2, so this panel in the left shows the unemployment gap, and it shows how much more difficult it is for the central bank to achieve its policy objectives when the ELB is binding. So unemployment, as you see in the upper left panel, rises much more sharply, and inflation, shown in the lower right panel, drops much more when the ELB is binding. What's critical is the scarring effects. And so you see that the much larger rise in unemployment induces workers to leave the labor force, contributing, as shown in the right panel, to a much more prolonged recovery in the participation gap, so that it takes a long time for labor force participation to move back to trend. A lower R star than assumed, if the COVID headwinds are more pronounced, would markedly intensify these scarring effects. So against this backdrop, there's a strong case for monetary policy to be highly accommodative on two grounds. I'll call it aiming broad and high. First, monetary policy should focus on broader measures of slack that include labor force participation to spur recovery. Intuitively, if labor force participation is a slow-moving variable that recovers more gradually than unemployment, pledging to keep monetary policy accommodative until broader measures of slack have closed will help support a faster recovery. As shown in this simulation, the policy rule that responds to a broader measure of slack that includes participation, you could think of it as being the employment to population ratio of working aged adults, spurs a much faster recovery in the unemployment gap, shown in the upper left panel by the red line. And there's some undershooting, that it falls below zero. So that means unemployment falls below potential. And that hot labor market induces a much faster return of participation, which is shown in the upper right panel by the red line, compared with what would happen under a rule that just responded to the unemployment gap. So monetary policy should also take account of abundant downside risks in a low R-star environment. Sorry, almost done here. In particular, to keep inflation close to target and employment close to potential, it's desirable to calibrate policy stimulus so that the modal distribution of inflation is well above target. This is the aim high. The benefits of insurance are higher as the risk of long-lived scarring effects, including from the lower labor force participation, become more material. Such a strategy can be implemented in a number of ways, including by temporarily raising the inflation target or through various incarnations of price level targeting. Of course, there's some cost to the insurance insofar as it raises the likelihood of overheating by design, as well as increases financial stability risks. In addition to strategy, central banks face new challenges with respect to tools. With sovereign bond yields already low across the maturity spectrum, central banks must act directly to reduce borrowing spreads of corporates and households to improve monetary transmission. This will entail moving even more deeply into private assets, including through targeted lending programs that subsidize bank lending to particular sectors and purchasing corporate bonds. Targeted lending can be instrumental in easing credit strains on SMEs and thus help boost employment. Even so, these and related programs may raise significant political economy challenges for central banks, and balance sheet normalization may be a distant prospect in an environment with a low R star and large downside risks. Well, thanks. That concludes my remarks.
Thank you very much. We're going to move to the second panelist, and I see there are some questions. If you can post them, in Q&A session, not in chat, that would be fantastic. And then we'll have them answer in the end of the session of the panel. Now, Sergey Guriev, the floor is yours.
Please unmute me. Okay, thanks. Thanks, you've unmuted me. So I will not use slides. Thank you very much for inviting me to this conference. I really appreciate the honor. I have always tried to attend this conference, but didn't happen before. But then this year, finally, I managed to join. So what I'm going to talk about is a political economist view. So if we think about the implications of labor market dislocation for economic growth and for recovery, then of course, traditionally, we would talk about the scarring of human capital, the long-term impact on human capital of being unemployed for a while, of the destruction of matches and the role of organizational capital within the firm. And this is something that is very much related to what was just discussed in the previous session. And yet we always underappreciate the political implications of unemployment rise. The last recession in developed countries in 2008-9, and then in Europe, the second recession, which came later, provided a lot of material that we can actually appreciate now and learn from those data and take certain lessons. So while the role of human capital is quite obvious, if you're unemployed, you're lagging behind in learning on the job, on getting the skills, while your employed peers are getting ahead with their on-the-job training, learning on the job. You may be scarred for life and never recover to the wages your employed peers have. The same, of course, applies to people who just come out of the job market in the year of recession. There is a lot of research in that, that if you come out on the, if you're looking for a job, if you graduate during the year of recession, you will never catch up to a level of labor earnings relative to people who come out of school in a good year. The organizational capital is also very important, and this is the main rationale behind all programs, partial unemployment programs or paycheck protection programs, to keep the employment matches alive. So when the lockdown is over, firms can quickly roll out production without needing to spend time on hiring new workers, training new workers, and so on. This is also something that has been known. What has become much clearer in the last few years, studying the implications of the global financial crisis and the concentrated rise of unemployment during the global financial crisis and follow-up recessions, was that unemployment has a major political impact. So what we've seen, and this analysis has been done for US and for Europe, and I have a paper with Elias Papayannou, Evgenia Passari, and Jan Algan, which came out in 2017, and Brookings papers for economic activity. We looked at the whole Europe and we tried to trace subnational regions within Europe and saw the regional impact of the crisis on unemployment. As it's usually done in this literature, we used the pre-crisis structure of a regional economy as a predictor of the impact of the crisis. If you specialize in construction, real estate, tourism, you of course are much more vulnerable during a crisis like 2008, 2009 crisis. So we saw the causal impact of rising unemployment on populist vote share was actually substantial, was actually much higher than we thought we would find. In some specifications, we would find that 1 percentage point increase in regional unemployment, in local unemployment, would result in 1 percentage point increase in populist vote share. In some specifications, we actually found the impact which was twice as high. So each 1 percentage point change in unemployment would result in 2 percentage point increase in populist vote share. Now, that was due to the what we call a trust crisis. This is something that has been observed in the US, but we were first to document it in Europe, where we saw that the increase in local unemployment would increase distrust towards national and European politicians. Interestingly, there was no change in trust in global governance, like United Nations. There would be no change in trust in local police or church or trust of people to each other. But people who suffered from the crisis in terms of unemployment increase at the local level would put a lot of blame on politicians at the national and European level. Now, the question is to what extent these magnitudes are comparable to the individual impact. So one of the takeaways of this research was that it's not just the people who lose their jobs who vote for populists and reject the system. It's also people who just live in places where unemployment is going up. If you compare the regional numbers that we find, and if you compare individual numbers that we find or some other people find, people who look at individual effects are much smaller. Why? Because even if you don't lose your job, but unemployment in your locality goes up by 5 percentage point or 10 percentage point, and in some places actually went up by 20 percentage points during the crisis, you still are extremely unhappy. Unemployment around you hits you even if you keep your job. Why? Because you're at risk to become unemployed yourself, because wage growth is going to be unlikely with many unemployed people around. And this, of course, undermines your well-being, undermines your income growth, undermines your career perspectives. And so in that sense, we shouldn't be surprised that the hit of unemployment on political outcomes is not just on those who lose their job, but also on those who keep their jobs but see that their wages are not likely to grow. So this huge impact, of course, is a political outcome. To what extent these political outcomes translate into economic growth? Now we have a lot of research showing that impact of populists on GDP growth is negative and substantial. There are country-level studies like UK, where you would see that, for example, Brexit, which we also show was in a large extent explained by unemployment spikes. So you can see that in the UK, Brexit cost UK GDP growth about 1 percentage point a year. So without Brexit, the UK economy would be growing at 1 percentage point a year faster since mid-2016, which of course is a huge number, comparable to something like 400 million pounds per week since mid-2016. Now, studies of the same kind, these are the synthetic control studies, studies of the same kind show that US, until recently, these studies pretty much finished last year, US had no net negative effect of election of Donald Trump. Another country where you don't observe a negative effect is, of course, Poland, where things still have been fine and are continuing to be, in relative terms, not bad. But if you take the whole data set of populist governments, and this is a paper which is not yet published, but is coming out soon by Funke, Szularek, and Trebes, So this paper takes the whole data set of populist governments around the world for the last 100 years in 60 countries. These are the 60 large countries who account for something like 95% of global economy, of global GDP. So if you look at those numbers and build synthetic control panels for countries where populists would come to power, it turns out that if you have a populist government for something like 15 years, or if you look at the outcome of populist takeover 15 years later, not necessarily if populists are still in power, but if you just look at the impact on the GDP, you see that the victory of populists today makes your GDP 10 percentage points lower in 15 years if populists take over today. And so some of that is because populists, of course, are not necessarily competent or good macro policymakers. Some of that is because populists, as these authors show, are very likely to undermine checks and balances, to destroy investment climate, to introduce higher corruption levels. And some of that is because removing populists often involves political instability, because populists, as these authors show, suggest that populists don't like to be voted out of office, so they are often removed through coups or other riots or protests, and that may also slow down economic growth. But this takeaway is actually very clear. You have populist victory today, 15 years down the road, your GDP is 10 percentage points lower than it could have been. Interestingly, this 10 percentage point estimate is the same for left-wing populists and right-wing populists. And so in that sense, you have this link of unemployment spike during the crisis, then support of anti-system populist governments, then slowdown in growth if these populists are successful. And in that sense, we shouldn't underestimate this political channel of the impact of spike in unemployment on GDP growth. Now, this crisis, of course, may be different. Why? Because this crisis may actually undermine popularity of populists and increase respect for experts and for science. And we already see, I think most clearly in Brazil, that populist leader Jair Bolsonaro, who came to power on after a spike in unemployment, but mostly, of course, after a huge corruption scandal that implicated 3 presidents and both mainstream parties. Still, we see that this populist leader cannot manage neither economic nor sanitary crisis and is unlikely to stay until the end of this term. I'm speaking here as a person who speculates about politics. We still don't know what's going to happen to Jair Bolsonaro. We also see that US President Trump is not doing a good job. UK government is not doing the best job ever. But overall, this crisis may be different. But still, it is important to take lessons from the previous recession, which was 2008, 2009, but also 2010, 11 in Europe, and respond to this crisis with packages that would reduce potential fallout and unemployment and make sure that people, even if they don't produce anything, remain connected to firms and therefore can come back to jobs reasonably quickly, because otherwise we may actually see major both political and therefore economic implications. Let me stop here and I'll be happy to take questions later on. Thank you.
Thank you very much. As we have discussed, we'll try to push the questions back to the end of the panel. Let's now start with Andrei.
Thank you very much for invitation for this conference. It's a pity that it's not possible to meet in beautiful Kiev, which I remember very well when I had opportunity to visit Kiev 2 years ago during our common conference. Let me to speak today about dilemmas of migration policy. I pick up this topic, take into account the Polish experience, because we have experience as a country of the big bang exodus of people just after the first years of our accession to European Union. And now we are the host country for migration from East, mainly from Ukraine. And to compare these two cases and analyze what is necessary to do to achieve some economic objects, in my opinion, it's an interesting one. Maybe there are lessons for Polish and Ukrainian government as well. So to assess migration, it's necessary to start from the Polish position in the context of demography. So if we look for the basic indicators, I think, for instance, total fertility rate, the indicator of the aging society, and even population growth. So take into account the data from 2004 when we started to be a member of the European Union, and now it's not a significant difference. And we may tell that nobody should take a risk to have a huge migration from Poland. It was necessary to have immigration to Poland. But let me to explain why it was happened in the case of Poland, that we accepted such huge migration from Poland from 2004. You see in the left graph the stock of migrants from Poland to other European Union countries. Now it's stabilized about 2.5 million people. And on the right hand, we have the basic countries with migration from Poland is, of course, Ireland, Germany, and UK. But what is the explanation of this government support for migration process? So it's a question mark, but on the other hand, it's a little surprising if we take into account our demographic position. The proof that it was a real position for our government, what our position in the negotiation process. In the negotiation process, we would like to obtain as quickly as possible free entry to common European labor market without any derogation. At least it was not possible, so we have free access only to Irish, UK, and Swedish market. Then we, Polish government, would like to obtain the full social benefits for the Polish people working in the European Union. And the very hot potato was the discussion, acceptance of professional certificates for the Polish workers in the Western countries. But the main point that we in this time accepted a huge migration from Poland was our economic situation. They are basic indicators of our economic position in 2003. The first one, the most decisive, was a very huge unemployment rate, which was about 20%, especially if you take into account youth unemployment, which was over 40, and no room taking into account the fiscal position and fiscal policy, because the deficit to GDP ratio was very high, at the level 5%. The same was in the case of the current account, even we observed an inflow of foreign capital in Poland. Last but not least, inflation, it looks in 2003 very low, but it was the consequences of very tight monetary policy during the last 5 years before accession. This was the reason that we paid a very high price for low inflation. So the good example for this is the level of real interest rates, which was in this time very high. So the reason is very simple. The economic stance was the reason that we accepted this big bang of migration in the Polish case. But government trust that it was the temporary, not permanent migration. What was the story behind this? The first, we strongly believed in this time for convergence process, and there are information about this convergence process in the terms of GDP per capita, taking into account with comparison with the average in European Union. So it significantly increased during the convergence process. There was indicators, but still positive was in the case of the wage gap, which was step by step lower. I put this information of the wage gap in the case of the German economy and UK economy. So we assumed that it should be a positive story, that last but not least, the Polish people, when we have a significant improvement of the economic situation, would like to come back to Poland, take into account that for them it will be very positive because they deliver some money which raised during the emigration, and of course they obtain some additional skills. In Poland, then after 10 years, we have a significant improvement of living standards, and then we analyze what kind of people emigrated from Poland. We assume if they are single, young, and transferring money, it's a positive story. It means that it's only temporary migration. And look on the remittance, which are in the lower corner graph. So it was true in the first 4 years. So the remittances are growing very fastly. Then in 2008, but it was linked to the crisis in Western European countries, it was slowed down and then stabilized on the similar level until today. So why we step by step observed a permanent migration from Poland to the Western Europe, even we have a significant better economic situation. Now the comparison of the same indicators as before for 2002 and 2019, and you see that it was significant improvement of economic situation. But why the Polish people did not decide to come back to Poland? One of the explanations is that it was uneven growth of living standards for all Polish peoples. I used only small indicators to show you what is the unemployment rate for a different voivodeship in Poland. So, for instance, in the case of Poznań, with this indicator is 2.6. Due to a big city like Poznań, which is nearly zero unemployment rate now. But it means that in rural areas and small towns and small villages, this indicator, unemployment indicator, is relatively high. So this was the reason that the emigration to the west from Poland is not from the big cities, but mainly for rural areas. For those people to emigrate to big city or to London, for instance, sometimes was a significant challenge in the both cases. So what about Ukraine? Now we observe the same problem as Poland has had 16 years ago in the case of Ukraine. If we analyze situation from Polish point of view, this is perfect for us. So during the last year, we have inflow of the Ukrainians. So the total inflow now in 2019, they are the last data from the fourth quarter, was roughly about all the foreign workers, roughly about 1 million. 83% they are immigration from, there is immigration from Ukraine. But what is very important for us, that many of those Ukrainians, they are working on the same legal standards as Polish peoples. So we use as paying for a social contribution by the Ukrainian workers as a good indicator that they have the same similar situation like the Polish workers. Why this immigration for Poland was beneficial is quite easy. We estimated that it was during the last 4 years the increase of growth of labor force about 4 up to 5% due to immigration from Ukraine, and contribution due to Ukrainians to the GDP was from 0.3 to nearly 1 percentage point. So it's a lot. And we would like to show you how was changed the Polish market for the Ukrainian workers. So they are different type of labor contracts in Poland. This is a regular contract, which is perfect from the point of view of employee, because this is, let's say, good protection to be fired for job. But there are two additional. One is, let's say, labor contract to perform specified activity, and the second one to perform a specified task. Firstly, more Ukrainians were hired for the third options, and it was only to do like a special job, which is in the end of let's say the fixed period finished. The second one is and better one is specified activity. It means that you are a worker until you have delivered, for instance, some type of services. So please believe me that now this violet line performed much better than the yellow. It means that the situation of the Ukrainian workers in Poland from the legal point of view was improved. We should remember that Poland is a member of the European Union, so we don't have, let's say, possibility to be very flexible for the foreign workers because it's for us necessary to obey common European labor market regulations. So this is in the right upper corner information on which status they are Ukrainians in Poland. So a lot of them, they have a special type of visa which give Ukrainian people opportunity to work, not only Poland, but the whole European countries, but is still temporary. So this is much better situation if we take into account the Ukrainian working in Poland, but then arise the question if it's any rank of the bell for the Ukrainian authorities, in the sense that it says any transition in the case of Ukrainian from temporary immigration from Ukraine or permanent. So the last bad experience was this pandemic. Many Ukrainians decided to leave Poland and to come back to Ukraine. So it means that still, in the case of Ukrainian people, this is not a permanent but temporary migration. What kind of lessons we may derive from the Polish example? The first, when we think what it's necessary to obtain for host country, I think that is very important to obtain the status equal rights for migrants workers in the host country. In the context of labor contract, in the context of the participation in the pension scheme, which is important for the both sides, from the home country and the host country as well. And last but not least, basic, really at least basic access to the social benefits. I think, for instance, about health service. So from this point of view, it's necessary to develop any kind of the pattern, common European pattern in this respect. Of course, the good example is EU pattern, but it's another one, for instance, Scandinavian as well. It's necessary to use this pattern not only in the case of the European Union, but in my opinion, it is important to use in the whole Europe, especially taking into account such countries like Belarus, Ukraine, and our eastern neighbors. But I would like to insist that it's a significant division from the point of view of instruments and analysis of migration process when we are talking about temporary migration and permanent migration. In the case of permanent migration, which is like hot potato, hot topic discussed by the European Union, taking into account the situation during the last 2 years. I think that the permanent migration means long-term investment by host country, because this is not the question of economy. This is as well question of culture. This is the question of identity. For instance, in the case of the Ukrainian people in Poland, it's quite easy for them to access to the Polish standards because we have nearly very similar languages, so it's not a language barrier, for instance. But I would like to underline that some journalists underlined that this invasion of the European Union workers to the UK was one of the reasons of the Brexit as well. I don't believe in this story, but I would like to underline that permanent migration is much more complicated and we need to take into account from different point of view. What they are lessons for home country? Take into account the Polish case. I think that this is the question, how to avoid permanent migration, especially in the country which has demographical problems. In my opinion, in some sense, we lost momentum to build the good policy for people to attract them to come back from foreign countries back to Poland. Because we assumed that if we improve economic conditions, this is sufficient argument for them to come back. Now, this is a simple proof of the Polish case that it's not sufficient condition. We need to think about special active policies, how to bring immigrants back home in the context of business, for instance, for them, how they may launch a new business in home country. Then for young people, especially, how to build a career, we need to prepare the career opportunities for Polish people who obtained, for instance, a perfect education abroad. This is not a problem in the commercial sector, but it's a real problem in the case of the public institution, which I know very well, taking into account situation of the Polish Central Bank, for instance. And last but not least, this is the question of the preparation of the social conditions. I give a good example. For instance, different scholar systems. So, for instance, for Polish people to emigrate from UK to Poland, if they have kids who are going to the British schools, this is difficult to accept the Polish school program. It's necessary to take all those elements together and to build the proper migration policy. So for me, it's of course interesting your point of view and any kind of suggestion what we may do to improve this migration policy. Thank you.
Thank you very much. This is very topical, and I hope we'll have an opportunity to discuss it more at the end. And let's move to Julius Sviridenko.
Timothy?
Yes, we can see you.
Yes, Timothy, thank you for giving me a word. Undoubtedly, it's a huge honor for me to participate in discussion with such reputable panelists and shed some light on how Ukrainian markets actually responds the coronavirus challenges and give an outline of its future perspective from the policy maker view. And first of all, I would like to start with a brief overview of the Ukrainian labor market. In fact, we finished 2019 on a quite positive note. Steady economic growth actually give the possibility to get to decrease of unemployment to 8.2%, and with the level of informal employment decreased to 20.9%. And in its turns, the growth of real wages by 9.8% contributes to the narrowing between wage gap of Ukraine and EU countries. However, we should not conceal the fact that Ukraine workers still receive one of the lowest wages, and that's why, of course, its main challenges for Ukrainian economy. And BU Governor Smali talked a lot today about the situation. So today we're actually witnessing of outflow but of workers of completely different quality. So two types of workers in this outflow. So first is a brain drain phenomenon. Of course, it's not begin directly with a qualified employees, but it begins with the potential ones, with the graduates. Graduates leave the country while educated, and the brain drain process doesn't. And this actually graduates, they're not, while leaving the country, they're not having any prospects for returning. And the second type of small extent, and it's the outflow of already established specialists. And this is narrowing of the wage gap between lower skilled labor and highly skilled labor within the country. Because the outflow of the low skilled labor leads to increase the cost of physical labor service in Ukraine. But it's not only challenges we are facing with. I would like to highlight a few more, which we consider as fundamental ones and to which we direct our efforts. First of all, it's a mismatch between supply and demand on labor market. Of course, reasons are different. It's a poor education, it's a low mobility, it's results of military conflicts and huge structural changes in economy. Second, it's a high share of shadow economy and of informal employment. The third one is a low productivity, and the main reason and the top reason is that fact that Ukraine is under investment country, under investment in assets, under investment in technology, in human capital. All these changes together with opening borders and association with EU actually have been pushing the labor migration until recently. And I will give you a quote of NBU Governor Yakov Smolyi, who mentioned today that about 2.5 million Ukrainians, they worked abroad last year in average in each point of time. So what we're going to deal with and what we're trying to do right now. So last year, government initiated the changes of labor legislation. So with the main aim is to create modern and flexibility labor market here in Ukraine. And secondly, we're trying to reload the employment center to increase the quantity of active programs, to add some trainings, so to give opportunity to fulfill this gap by giving the opportunity to get additional skills. But it was all back before the COVID pandemic. Unfortunately, now we are overloading with the response to pandemic, and we are facing new reality, and reality where coronavirus dictates the game rules. So since the start of quarantine on 12th of March, the number of registered unemployment has exceeded 500,000 of people. So it's 67% more in comparison with the same period last year. So in order to mitigate the effect of pandemic and containment measures on labor market and economy in general, the government focus its efforts on following directions. So where supports of employment by businesses, tax exempts for SMEs, partial unemployment schemes for SMEs, and we're trying, actually, I would like to focus your attention on this program because it's rather successful. It gives opportunity for the last 23 days to refund the salary for more than 100,000 people that saved their workplaces. Where simplify the access to loans through interest rate compensation and partial guarantee. Also, with support of unemployed people, we simplified the procedure of registration, and they have permission and just to form one application form by email, and get the fee. So also we launched the government program of creating new jobs. So far, Ukraine behaves more or less well during the crisis in comparison with peers. We believe that we will go smoothly through it, but to successful in the long term, we need to come back to structural reforms, and creation of modern and flexible labor markets is definitely a critical task for Ukrainian government today. Thank you, Timothy.
Thank you very much. Thank you very much, all panelists. We're now going to move to the discussion part of the panel. We have about 15-20 minutes because we started a bit earlier, and then we will need to allocate some time for the presentation about the special issue of the journal for Canvas. I will start with the question from Bart Hopchin. This is the question for Chris, and I will read it right now. You also, if depending on the role you have as a participant, you can raise your hand if you have a question, and I will see you and I will let you actually speak. Or you, here's Bart. Bart, I'm going to unmute you, and you can just ask the question. And everyone else can also ask questions. If you cannot raise the hand, please ask questions in the Q&A. Bart, you should be on. Hold on. Okay, I'll ask the host to unmute you. Yeah, Bart, you should be on.
Thank you, Timothy. Yeah, this is a question for Chris and to some extent also for Yuri, which is that we've worked really long under a inflation targeting, 2% inflation targeting paradigm in central banking, and Yuri has contributed to studies that say 2% is pretty much optimal within the data that we had, say, up till 2010 or 2008. Now we're looking at participation effects being important. We're looking at increasing likelihood to hit the zero lower bound. Does this change the assessment of whether 2% is actually optimal inflation target? Now, this is not a new topic. It was already discussed in after 2008 recession. But is there a reason to reevaluate now that we realize that there's even a bigger left tail to the shock distribution that we face at a higher frequency?
Well, thanks. Am I audible? Good.
Yeah, yes. You're on.
Okay, good. So I think it's a very good question, and I think it's helpful to start by just recalling that even prior to the crisis, many economies that had reached full employment, or indeed even had unemployment fall below estimates of the natural rate, were struggling to bring inflation to target. So this has been a long-standing problem that will be exacerbated by COVID. So with COVID likely to further depress our star, lead to even more muted wage growth, and on top of that, likely to exert very strong deflationary effects arising through the lower oil prices, you've got a confluence of forces that are going to kind of reinforce what we saw even before the crisis emerged. So it's a big challenge. My own view is that it will be important to think about ways of at least temporarily adjusting the inflation target. My own preference would be towards ways that would retain a long-term target of 2%, which I think is most consistent with price stability, but at the same time allow temporary adjustments that might have average inflation, might aim to keep average inflation close to 2. And to do that, as I alluded to in my remarks, the mode of inflation should be perhaps well above 2% to take account of very considerable downside risks. So even abstracting from considerations often raised in models that rely heavily on forward-looking expectations, there's a strong argument for essentially calibrating policy, monetary and indeed fiscal, in a way to try to push the mode of inflation above 2 and hence keep the average closer to 2. And I think that what that'll mean in practice is allow central banks aiming for significant overshoots of the target for a persistent period of time.
Thank you. I actually have a related question with respect to the developing economies. In Ukraine, you have an inflation targeting regime as well, and it's at 5% plus minus 1%. That's the bandwidth, the target. We currently are at 3 to 2% inflation, and the real interest rate is of course at 5-6 because we have 8% the discount rate, and it's after the central bank has cut it down in response to the recent events. Should they, and this is the question to all panelists, I think, because there's also a substantive political economy question. Institutions are weaker in Ukraine, and the cost of moving away from the political cost or institutional cost from moving away from the target of 5% might be huge, because you might open a door to abandoning the entire regime. So should Ukraine or countries like Ukraine think of temporarily changing the targets? And if so, how to avoid, or what should be done to mitigate the potential for the populists, for instance, or political forces using this incident to hijack and discredit the entire idea of inflation targeting, and then move to a more more business as usual, as it's often is the case in the developing countries, because the cost of combating inflation in Ukraine as well as in other countries has been huge. Ukraine had 40% inflation, 60% inflation several years ago. No one would believe that it's possible to come down to 2, but we are now having 2% in the middle of the crisis, where we need, in fact, to maybe go in the other direction. Anyone? Chris, perhaps?
So yeah, I was really speaking primarily to advanced economies in my previous remarks, and there I think they're struggling to boost inflation towards 2. It's likely that inflation will remain significantly below that 2% target for some period of time, and so my prescription really was to be pretty easygoing about allowing inflation to overshoot the 2% target subsequently. So I think the calculus can be quite different in emerging market economies, and I think as you alluded to, many have really fought hard to buttress credibility for achieving low inflation, and so I wouldn't advance a similar prescription in cases where the inflation target is already quite high, and I think there could be a number of downsides to, say, raising the target. I don't want to talk about any particular economy, but just in general, my comments were really mainly aimed at advanced economies struggling with low inflation.
This makes good this makes good sense, and exactly because the remarks might be taken out of the context and interpreted differently, I sort of set this question up in some way. Sergey, perhaps you have a comment or two on this.
Yeah, I'm a free person. I no longer work for international organizations, so I can actually talk about various countries, and I fully support what you, Timothy, said about importance of independence of central bank and importance of sticking to the announced targets. I can give you numerous examples of central banks which unfortunately did not possess independence, and that resulted in macroeconomic meltdown. One of those recent examples would be, say, Turkey, where the president of the country, for some reason, decided that central bank independence is not a great idea, and he knows better than macroeconomics PhDs. He knows better how to bring inflation down. That is, of course, by printing money. And so that unfortunately resulted in a disaster and in a crisis which was conjured from thin air by this attack on monetary policy independence. Now, coming back to Ukraine, indeed, when you have inflation below target, in principle, nothing prevents you from lowering interest rates. That would not signal walking away from inflation target. It would actually be a move back to the inflation target, as Chris said correctly. In advanced economies, central banks fight to increase inflation so it reaches the 2% target. In Ukraine today, the issue is that inflation is below target. And so I think it is possible to say we are sticking to our policy. We want to keep inflation in the band that we announced, and that means we need a lower interest rate. And so that, I think, is completely possible. So I don't see why not. Ukraine is in recession, as the whole world, and this is probably the time to lower interest rates, not because you want to walk away from inflation target, but exactly because inflation is below the target due to the macroeconomic environment. And what Yulia was talking about, the high unemployment, all kinds of challenges, justify softer policy as part of sticking to the inflation targeting framework, not as walking away from inflation targeting framework.
Thank you, Sergey. So basically, don't change the targets. I'll simplify for the audience, but keep the regime and
But the regime today dictates actually raising inflation.
Correct. Good. Andrzej, I have a question for you. In some of the preliminary communications, you raised an intriguing opportunity of a possibility, at least a question, of coordinating of labor policies between the host and home countries. Would you be willing to elaborate on this, maybe using Ukrainian case, Ukrainian-Poland case, or just in general comment? How is it possible at all? Do we have the infrastructure to do it internationally, or is this a kind of, it would be great to have, but not politically or institutionally feasible?
Timo, thank you for this question. In my opinion, the most important is when it's possible to coordinate those migration policies. So in Polish case, in some sense, it was easy because we adopted EU regulation. So from one day to another, we were a member of the common European Union labor market, of course, with limited access for the couple of years. More important is for me the question what to do in the case, for instance, such relations like Ukraine from one side and Poland. So in my opinion, it's necessary to perform any kind of the solution which take into account the situation in Ukraine on one side, on the other side, how to adopt the common European Union policy. And in my opinion, it's one political opportunity. You know that we have this initiative of the cooperation with Eastern Europe of the European Union. And Poland advocated for many years that it's necessary to put this topic on agenda and on this basis to find a solution of the cooperation. One of these elements is the question how to step by step to build the relation of the labor market. It's not possible to make this immediately. So the first step was done in the context of the formal accession to the labor market from non-EU members. I think about these special visa requirements, special possibilities. So first, it's not possible to build immediately. This is obvious for me, but it's possible to make step by step. And now, take into account that we have different problems in European Union, this is not these Eastern-Western relations not on the top of the EU agenda, but sooner or later we come back with this question. Because if we take into account other models, like Scandinavian models, they are very similar economies with a long tradition of the cooperation. So for them to create a common labor market with the same rules was in some sense much more easier than in our case, taking into account a different level of development.
Thank you. Anyone else would like to comment on the issue of coordination of labor policies across internationally? All right. We have a question from Sergei Nikolaichuk. Can we please, unmute him? I think I don't have the rights. We need the host to help us. Yeah, Sergei, you can speak now.
Okay, thank you very much, Timothy. Do you hear me?
Yes, we hear you well.
Okay, thank you very much to all panelists for interesting discussion. Actually, I have the question to all of them about the best strategy to deal with the pandemic effects and containment measures effects on labor market. Actually, I see that different countries nowadays use different approaches. Some of them try to support the employment through different schemes. The most prominent example probably the Germany. Some of them increased sizably the benefits for unemployed in order to stimulate the demand and also to help the people to survive during this period. It seems that Ukrainian government tries to use the combined approach, using both types of support. And in that regard, what kind of strategy do you see as the most effective one? And what is the role of the central bank in general, probably the monetary policy in particular, in supporting these processes, especially in emerging markets?
Thank you, Sergei. Who would like to answer that? Sergei? Sergei Gurev?
Thanks. Well, it's very hard to give a one-size-fits-all solution, but in general, from what I was talking about, this is not a time to be stingy. It's time to be generous. You should remember it's the biggest crisis since 1930s. The good news is governments seem to have learned from the previous problems, and no single government wants to go into austerity mode. Then, as you rightly said, Sergei, different governments have different priorities and set up different packages. Yet all of those measures are actually making sense. So you want to support small businesses who usually don't have liquidity buffers, and especially those who are forced to shut down because of sanitary measures. So these businesses want to keep employment matches. And indeed, some people would say, let's stimulate unemployment so there is a reallocation. And indeed, as this paper by Bloom and co-authors was mentioned today, many of those matches will never continue to exist, and there will be a permanent job reallocation. But I think at least for the couple of months of the lockdown, you want to put this problem on a temporary freeze, and then allow businesses to come back, and those businesses who will be able to reopen should have zero barriers to reopen. So in that sense, I support preserving employment in some way. In the US, you have this policy. In Germany and France, you have this policy. And I think it's the right policy. Now, one thing which is different between advanced economies and emerging markets like Ukraine is a big part of informal employment, informal sector. Now, if you're if employed informally, it's very hard to support you. It's very hard to provide employment protection. However, you may actually lose all your income, and in many of these countries you don't have a lot of savings. So there is a humanitarian issue, social issue, just to help people eat, right? And so you want to reach out to people and help them with social benefits, so they have enough income to just survive these difficult times. And so in country like Ukraine, in all post-Soviet countries, in countries where you have high share of informal employment, I would strongly support handing out cash. In the US, there is conditional cash transfer for households which have incomes below certain level, $75,000 per year. In Ukraine, it's not necessarily easy to identify the most vulnerable households, and so if you can somehow identify them, great. But you really need to think about people who used to have a job. The job was not in the formal sector, so these people are now very much hit. So that may be different between advanced economies and emerging markets. But overall, I would just say, whatever you can do to help small businesses and households, you should do, and whatever fiscal space allows you to do, you should do. Now, and the next step is, of course, banks supporting liquidity and so on. And we talked about interest rates going down, that we've already covered. Thanks.
Thank you, Sergey. Would anyone else like to answer the same question?
So I think just
thank you, Chris.
to complement, I think most of my answer would align very much with Sergey's, and I think I just build on his last point that it's very important to try to not only help protect employer and employee relationships through, for instance, extensive wage subsidies, but to support firms that were certainly solvent prior to the crisis, but have been pushed into what could be insolvency, and hence really could make them face a lot of challenges in financing themselves going forward. And so in that vein, central banks have really stepped up liquidity provision to include even firms that are now essentially below investment grade, but were formerly investment grade firms. And so, for instance, the Bank of England and the Federal Reserve has set up programs to purchase commercial paper and corporate bonds that would include high yield corporate debt and essentially base their purchases on what the rating of these firms was prior to the crisis. So I think, really, to echo Sergey, you want to work on all cylinders to make sure that companies and households can get beyond this very difficult period.
Thank you, Chris. Andrei or Yulia, would you like to add to this? Yes, Andrei, please.
So I agree with this. That's not one pattern for everyone, which may fit to all. So in Polish case, for instance, we have the both strategies. One, of course, to support employers in the form of any kind of the wage subsidy, upon conditions that they would like to prevent reduction of employment. But on the other hand, we have so-called self-employed people, which are by definition lost their work immediately. For instance, if you are hired as a self-employed company, which consists with one person, it means a problem. So I agree with Sergey that then it's not only economic problem, this is a social problem as well. So it's necessary to use the both instruments.
Thank you. I'm going to circle back to migration and to talk with Andrei again. What do you think will be, well, it's a little bit of a guessing question, but what do you think will be the future for the migration between Ukraine and Poland. Do you see that the labor, so the wages in Ukraine are increasing even during this current crisis, you know, months to months? There are multiple explanations to them, but prior to the crisis, the real wages were growing substantially. There have been years where they went up 40% year to year in real terms. And 10%, I think, was the lowest growth over the last several years. So there is some equilibrium effects kicking in, where even in the, and that's what Yulia Sviridenko, I think, alluded to, saying that even though we have essentially high-skilled and low-skilled markets, and they respond very differently to the crisis, even in the wage gap between the low-skilled and high-skilled labor markets in Ukraine is decreasing. Do you think that this force, the equilibrium force, will kick in and essentially migration will stop in the next couple of years, or you don't see that effect?
I think that definitely you are right, that it will stop. This is the question only of time. So this was, for instance, the reason in Polish case that this migration was stopped, but still we observe this migration in specific situation. For instance, I presented this graph when we have opportunity to see the unemployment rate in Poland in 2003 and unemployment now from the regional perspective. So before 2004, before our accession, is very high on the western Polish border. Now it's a very low on the western border, because it means that many Polish people who normally live in Poland, they are working on the second bank of the Odra River in the west. Now even it's a problem for us because the Polish frontiers are closed, and this is difficult for those people to go to work. So in my opinion, in the long run perspective, it's possible that we have this convergence of labor near the border, but not, let's say, such massive immigration from Ukraine to Poland like we observed during the last 3 years.
All right, this is fascinating. Let me check that if there are no questions, because I think we're actually a little bit almost out of time. Are there any more questions? This is the last chance to type them in or raise a hand. Thank you very much, everyone. I thank the panelists and our audience for a fascinating policy panel. And I hope we all become a little bit more informed today as a result of this. Thank you and have a great day.
Thanks very much.
Thank you.
Good evening, good afternoon, or good morning to everyone, depending on your time zone. Here is Dmytro Sologub speaking. I am a Deputy Governor of the National Bank of Ukraine, and I have a privilege to moderate our keynote session today. Before introducing our keynote distinguished speaker today, I have to make an important disclaimer. You know, when the organizing committee of this conference, which include people like Yuri Gorodnichenko and Alexei Krivtsov, was thinking about the topic 9 months ago, we had no any insider information about the forthcoming coronavirus crisis and its implications for labor market, unemployment, and so on. Let me assure you that it was just simply a gut feeling to choose such a relevant topic for the discussion today. And in this respect, I truly believe that there is no better person to address this topic than our keynote speaker today. And therefore, let me introduce Professor Bob Hall, who is currently the Robert and Carol McNeil Joint Senior Fellow at Hoover's Institution at Stanford University and the Professor of Economics at Stanford University. And Professor Hall has a long and successful career in US universities, including MIT and University of California, Berkeley, as well as holding a number of important positions in the leading academic institutions, like a chair of American Economic Association, working in National Bureau of Economic Research, member of National Academy of Sciences, and so on. And also, Professor Hall has a notable contribution on the policy side, advising a number of US government institutions like Department of Justice, US Treasury, Federal Reserve Board, and so on. Business cycles, unemployment, consumption patterns, capital formation as a primary research interest of Professor Hall. And therefore, as I mentioned, we are extremely pleased to have Professor Hall with us today to talk about such a relevant topic. I stopped right here. Please, Professor Hall, the floor is yours, and after your speech, we'll have a Q&A session. Thank you.
Okay, well, it's a great honor and pleasure to be able to give this keynote, not just to the fact that it's 30 in Ukraine, it's only 10:30 here in California. So this is a new experience for me, but let's go ahead. So this is a project that, first of all, joint with Mariana Kudliak, who's watching. I've been working on it since last September, which means that it was begun well before the roof fell in, as we say. Mariana's an employee of the San Francisco Fed, so we're obligated to say it's, as it does in very small script at the bottom of this slide, that the opinions here are hers and mine, and not that of the Federal Reserve Bank. So let's get started. There we go. So this is a book about, this is a, sorry, paper, might be a book sometime, but a paper now, about the US business cycle. And I do want to emphasize that everything we say in this paper is very focused on the US economy. And we're not arguing by any means that other economies work this way. In fact, we're conscious of the fact that many advanced economies don't share this feature that we're calling attention to in this research. We focus on the concept of economic slack. There's two measures that macroeconomists have tended to focus on with respect to slack. One, the one we choose to look at is the unemployment rate, but another is the ratio of GDP to its potential value, sometimes called the GDP gap. And we will show you one slide that may convince you that the GDP gap and the unemployment rate are very close cousins. They're both good measures of slack. We chose unemployment, but you could replicate almost everything we do if you switch to GDP. So what we found in looking at the history of the US economy over the period where we have good measures of slack, which is essentially from 1948 onward, and we discover that two features of its evolution. And one is related to recoveries. We were, of course, focusing on the recovery that's been going on for a decade when we began this project. We found that there's, in this reliable record that's available from essentially the unemployment survey, that the, sorry, let me go back. We found that there's a very consistent record of recovery. Recovery is a process that occurs consistently and reliably in the U.S. economy. We're going to focus on that as an interesting fact. It's to be balanced against the fact that there's great heterogeneity in what causes the recession to begin with. And we suspect that that's true of the recession that's unfolding now, but it's way too early to comment on it. So almost everything we talk about here is going to be in history. And in particular, we'll focus a lot on the recovery that occurred that ended just a few months ago, which was a 10-year, just a remarkably smooth, consistent realization of something that is also true of other recoveries. But if you step outside the research period that we're looking at, which begins in 1948, then you find that there have been episodes in the US, and of course very much so in other countries. The 1930s don't fit the paradigm that we're talking about in the US. There is a very interesting issue of the labor market's absorption of returning soldiers after World War II, which resulted in unemployment never rising very far and declining rapidly, quite the opposite of what happens after a typical recession. And then, of course, the unprecedented job loss of the last 3 months will generate a recovery, and we certainly hope that it'll be faster recovery than the ones we talk about. We don't take a position on that. It'll be way too soon. Other people have applied model building to that question, but in terms of data, it's way too soon to say anything about that. We will, if we have time at the end, say a little bit about what has happened, but not in the context of taking a position on what the recovery. All right, so here's the basic facts that research considers. The unit of observation here is a recovery. We don't follow the National Bureau chronology exactly, although it's very, very close with the National Bureau's efforts. But we develop our own chronology that's based very much on just the unemployment rate, not the other variables that the National Bureau considers. The orange or red bars show the total magnitude of the decrease in unemployment that occurred in each of those recessions that are labeled at the bottom of the graph. But we call attention to the blue line, which is the percentage points of unemployment decline that have occurred per year in these recoveries. Now, the recoveries in the period from 1948 to 1958 occurred somewhat faster. They occurred reliably, but they occurred at more than a percentage point per year. After that, there's pretty uniform performance in the neighborhood of, say, 0.6 of a percentage point of unemployment decline, improvement, and we call attention to the fact that that's very material because the source of the disturbance was quite different in different. The reason the economy went into recession was quite different in each of these episodes, and of course, entirely different in the episode that we're undergoing now. Um, and yet, the way the economy recovers in terms of this key question of closing the gap in slack, that is reducing unemployment, is we thought a remarkable fact that it's not really been studied very much and must tell us something important, especially about the labor market, but really about the macroeconomic equilibrium in general. In some ways, this is the best way to explain the findings. We primarily, so first of all, what is this? This is the unemployment rate only during the periods when it's falling. So these are the recoveries. The far right, you see the most recent recovery from the Great Recession. And what's remarkable is that it's almost a straight line. It's not curving the way every model that we've ever examined, including the ones that we've been working on, as you'll see, it's almost impossible to get away from the fact that a dynamic system, as it approaches its asymptotic ergodic point, move more slowly back to its target. But that's not the way recoveries happen. Recoveries occur almost along straight lines. So they're both consistent, and they don't lose their power in terms of percentage points of unemployment improvement per year, just a tiny amount. But there's way less curvature. We have some striking pictures later that illustrate this. There's way less curvature here than you can convince any model to generate. Even the models that we think are telling can't explain the linearity. So there's two big interesting facts here. Fact one is the consistency of recoveries. You can see a few small hiccups. Say there's a hiccup there, and there's a little hiccup there, but there's a hiccup there. The interesting thing is that the longest recovery, both in months and also in points of unemployment, has no hiccups practically. It's just a continual straight line, really just remarkable. So I think our attack on the consistency issue may be more successful than what we'd like to be able to say about linearity. But linearity is definitely a topic that I think should attract the attention of model builders, because it's not the way most models work. Most models curve into make a glide landing at the target. But here you crash into the target. There's just almost no slowdown. So keep that in mind, but most of what we're going to talk about is the consistency. Okay, so first of all, let's be clear on the vocabulary here. The recession from which the recovery occurs is a contraction in economic activity. And the economy, the US economy and others as well, I believe, tend to collapse quickly and then to recover slowly. And there's a saying that's apt here, and that is that unemployment rises like a rock and declines like a feather. And that's a phrase that's been used for other things, in particular fuel prices typically have that character as well. That's where I first learned about it. I've learned, since I've had this role in determining when the economy is in a recession, that it's easy to tell when the economy is in recession because informed observers say the economy is in free fall. And I've heard that term a lot in the last few months. So there's just some hints now that the free fall is ending in the US economy, which is good to hear, considering how far it's fallen already. But so we are part of a very large existing literature that has emphasized the asymmetry, quick collapse in recession, unemployment jumps upward several percentage points per year. In fact, the main part of the growth of unemployment occurs within a single year typically. Certainly, looks like that's what's happening right now. Okay, but recessions come from different sources, and if you just look at the 5 most recent recessions, including the one that's ongoing now, the pandemic, they each have their own causes, and we have no reason to dispute the notion that there's heterogeneous causes of recessions. Recessions are not the part of, not a feature of the evolution of an inevitable cycle of sudden rises in unemployment and then gradual declines. Rather, the default condition of the U.S. economy is to be in recovery, with unemployment drifting downward, less than a percentage point per year, but reliably. And then at some point that is interrupted by an event which causes a rise in unemployment, a breaking of existing employment relationships, which seem to be easy to break and hard to restore. That's one way of thinking about the findings of this literature. And that, of course, that predates the work that we've done. It's business cycle asymmetry literature is very rich, and we've accumulated hundreds of references that all point in this direction. The contribution of our research to that literature is to call attention to this reliability and linearity of the recovery. And we basically just don't look at the data. We're very focused. We look only at recoveries. And that's what gives rise to this rather interesting picture. If we put in the recession parts, the world would look a lot more complicated. But the recoveries are uncomplicated. They're all the same. They differ in their length, but they're basically otherwise the same. The same slope, the same linearity. Okay, so we're not going to say much about recessions. If time, we'll talk a little bit about the pandemic recession, but otherwise it's just a blank. Some shock occurred. Unemployment's a state variable. We start the story when that state variable is at a high level. We don't ask how it got there. We just say, okay, the economy has had a bad shock, and in particular, it's dislodged a lot of workers from jobs, especially longer-term jobs, very important in this process. And then we're going to follow that through the labor market and try to explain why the recoveries are all the same, recessions are all different. Okay, so we're going to go through a series of steps here. Unfortunately, the titles on my slides don't show. Maybe the audience can see the titles, but I can. The first thing we want to do is have ways of quantifying job loss. What happens during this time when unemployment has just risen? Again, we're going to look at this after when unemployment's reached a cyclical maximum. And then we'd like to know different measures of the amount of job loss, the extra job loss. There's a continuing base level of job loss in the U.S. economy that is quite reliably constant. And then you'll see a spike of extra job loss. And when we talk about extra job loss, it's the height of that spike. Okay, so here's the first measure. This is a measure of layoffs through a survey of employers. Employers are asked, how many workers did you discharge? Sometimes people talk about firing, but firing means with cause, and these discharges are typically not for cause. There isn't enough work for the job for the worker. The worker is laid off. The layoff goes into the data, and you can see a very well-defined big spike that comes back very quickly. In fact, there's no asymmetry. The asymmetry doesn't come from the driving force, which is these occasional big increases in unemployment. The asymmetry comes from the fact that it's basically easy to dislodge workers from jobs, and it's hard to get them back into jobs. And that's what this whole paper is about. The conclusion is that although it's hard to get workers back into jobs, it's actually a reliable process. It's just slow, but it seems like up to now it's been reliable in delivering around 0.6 of a percentage point of unemployment decline. Okay, but right now we're just emphasizing that by this measure, layoffs from the employer survey will spike. And you can see a spike in all those measures. So this is mass layoffs. So mass layoffs are particular events that occur in the labor market that are identified separate survey. And again, you can see that for just the period we show here, which includes the 2001 recession and the Great Recession. Again, you see a spike. It's less clear here than it is, especially in the earlier, but you do see basically a concentrated spike at the time of the financial crisis. It shows up in the data for 2009. If you look at the data in the current population survey, which measures unemployment, then you see a huge spike in new unemployment arising from permanent job loss. So one of the key features, and this has been emphasized in commentary on the Great Recession, you see again a big change in the composition of unemployment in the direction of the loss of what was previously regarded as a permanent job by the worker. And that goes up enormously. Yet, interestingly, and this is important for the way we want to tell the story, it turns out when you look at the workers, then you find that it doesn't, although layoffs from the employer's point of view are a spike that recedes to back to normal very quickly, the same is not true for entry for permanent job loss. And we'll talk some more about that. But that's the whole issue here that we're dealing with is you have this very fast driving force which disturbs labor market relationships, and then a very long endogenous and interesting and complicated process that goes on in the labor market after that. Okay, so there's a survey that's part of the consumer population survey, so the current population survey, which measures what are called displacements. Displacements, again, are an attempt in the statistical system to try to focus on the most destructive job losses. A lot of job loss is routine, seasonal jobs, for example, and then a certain type that's isolated here by focusing just on workers who have at least 3 years of tenure. And then you can see that there are these huge spikes if you focus on that group. So there's the most of the time and during the recovery, you see routine levels of layoffs and sort of routine turnover. And then the recession comes along, there's a big spike. But you have to concentrate it. The big spike's not that impressive unless you ask just who's affected. And then you find that there's much more destruction of long-term relationships during the shock than there is at other times. So one of the important conclusions here is that unemployment is a very heterogeneous phenomenon among workers. Okay, so there's been a lot of interest in looking at applications for unemployment insurance, and again, you see a spike. Interestingly, the spike that occurred in the Great Recession, we don't show the spike. Of course, there's a huge spike in this variable, just in the last few months. We don't show it here, but the Great Recession, which by many measures was much greater than than earlier recessions. The only one that's comparable is the 1981-82 recession, which actually reached the same level. Okay, so that gives you some sense of the value, the situation in the labor market at the conclusion of a bad shock, where we pick up the story, and then we'd like to know what happens. And the first thing we're going to investigate is what happens to the workers, the workers who are exactly the people who lost their jobs. One hypothesis that's of interest and not crazy is that although the recovery can take up to 10 years of gradually reducing unemployment, that arises just for the people who lost jobs in the first place. So you could say maybe it's just two kinds of people in recovery: those who lost a job during one of the spikes, and then it just took them a very long time to get seated properly in the labor market later, but eventually it happens. Well, there's some truth in that, but we'll show in this piece of the research that it's only part of the story. There are other things that result in only slow decline in unemployment and recoveries that occur among workers who were not the victims initially. But this question of just what the role of the initial victims. And again, there's been kind of a fragmentary research on this, but we're trying to unite all these ideas and try to get some picture of the relative position of the original job losers and those whose unemployment wasn't related to job loss in the preceding recession, but what had more trouble finding work for other reasons. We'll go into that. But for now, we want to look at, we'll try to answer this basic question. Okay, so first of all, here's just to get an overall grip on this. The different colors, they're all focused, in this case, around 2009, because we're looking at just one recovery, a very telling, interesting recovery, very typical of the recoveries that we have in mind. So we had the amount of job loss, the number of workers in thousands, so it goes up to, say, 6 million. Sorry, 8 million at its height. So now it's very important to understand that you can't add these different colored lines together. They're different perspectives, but all on the same group of people. And then the black line, the line over here that comes down like this, is what we call extra unemployment, as I talked about before. So this gives you a sense of the fact that, especially the JOLTS layoff excess number, which is the biggest one, the blue bar, is going to be a non-trivial source of the initial unemployment. But it is a question of how long those people remain unemployed. They may cycle through several jobs, but at a certain point, they're going to start settling back into long-term jobs. And you can see that it would be kind of a surprise if the entry numbers to unemployment, the colored bars around 2009, were enough. So this is the first indication that our answer is going to be no. It's not enough to say that a bunch of people lost their jobs and it took a long time for them to recover. We have data, which I'll get to in a second, about how long it takes them. Although it does take them a surprising amount of time, it's not enough to make just these people account. But we need to think about induced unemployment among induced extra unemployment among people who are not victims of the original shock. Okay, so to do that, we go to the to data on lingering unemployment in a survey that's part of the current population survey that's taken every other year. There's some timing issues that have to resolve, but I think we've done a decent job of that. And this basically, the coefficients in the coefficient column tell you what fraction of people who were displaced 1, 2, or 3 years ago are still unemployed or are currently unemployed. They haven't necessarily been unemployed the whole time, but they're unemployed now. So this basically, and this is the only source of this information that we've been able to track down. And it's something that's been resolved, considered speculation about it, and a certain amount of research has been done on the survey, but I think this is the first really quantification of how long it takes for the impact of the job loss shock to be completely removed. And the answer is it's mostly gone in 3 years. Of course, there's going to be some more. The structure of the survey doesn't allow us to look more than 2 years ahead, but that's actually much better than any other data source with respect to unemployment. So again, this points in the direction this is going to be an important phenomenon, but we're going to have to come up with ideas that explain unemployment, the tail of unemployment that is induced and is not direct. So this is the strongest evidence we have that the direct channel matters. It really is the case that the direct channel matters, but it's not the whole story by any means. And here's a picture that gives a sense. So if we said, okay, let's assume that we've got the timing more or less right from that survey, and then we can look at the amount of unemployment that's induced by each of these separate measures. And again, we can't add them together. We don't add them together because basically drawn from the same population. But so you can see that the areas, especially the blue area, is non-trivial. Maybe it's a quarter of the total, but it's only that much. And we have other, so we have a quite strong conclusion, and I think this is novel. I don't think it'd be a surprise to most people who study this, but I think the quantification is novel, and that is the direct channel is only part of maybe a quarter, maybe a third even, but it's certainly not the whole story of lingering extra unemployment. So we need something else. Okay, so we move to the next step, which has to do with trying to understand why it takes so much time for those people, and in particular, there's a very important paper in this literature by that measures or observes that the speed with which a worker who's unemployed finds a job in that spell of unemployment is very fast compared to the implicit speed that comes out in the kind of data we're just looking at. So you get a slow unemployment decline for the original victims, even though if you look at any one of them at any one time, they have job finding rates that may be as 10, 20, 30% per month, in which case over 1 year, just repeated applications of that probability, you get you close the gap completely. Unemployment will be gone in say 6 months. So that's paper by Cole and Rogers in 1999. This inspired me, and I've been thinking about this topic on and off for a long time. And as soon as I read that paper, that's got to be right, and that's really an important fact. And so this research is a contribution to trying to understand. Okay, so we define something called the effective exit rate from unemployment, which is way less than the monthly exit rate that's from unemployment that's been measured by looking at transitions in the population survey. So this involves looking at the experience of workers over the time that we can observe them as if we condition on someone having just lost a job and then ask what happens to that person over the year that's included in the current population survey, then we find that it's all kinds of things happen to them. A phenomenon that so Marianne and I have a paper that we did over the past 2 years that goes into great detail about this topic. So I refer you to that. But the result is that we know that the effective job finding rate is very much smaller. The effective job finding rate is what we could uncover from looking at the experience of regression that we're in. Okay, so the conclusion of this, and this is not new, was work by quite a number of people inspired by the 1999 paper that comes up with similar ideas, but we're on board. Okay, I'll skip that. So we've defined a measure of circling and find that not only is it important, major explanation for low effective job finding rates, but also increases extensions. And that's an important fact to try to come to grips with this issue of why there seems to be a induced increase in unemployment as well as the direct general. Okay, so now let's turn to model building. So we have a very clear objective in the model building part, and that is that we want to explain why the recovery period is one in which there is initially higher unemployment among people who were not victims. So this is induced unemployment, some change that occurs in the labor market that makes it harder for workers to find jobs initially, but gradually disappears over time and results in the unemployment rate and job finding rates in general to be returning, actually to reaching very low levels. I should mention that one of the important ideas in our line of research is that Milton Friedman was wrong in trying to define a natural rate of unemployment. He was right that there's a natural process of unemployment, but what he missed was that if there are no disturbances, as there weren't from 2009 to 2020, then the unemployment rate doesn't. He suggested that in a year, 2 or 3, unemployment reached a constant level, the natural rate. But that's not the way things work. That's not the way recovery's looking at this. Rather, if there isn't some sharp decline, things just get better and better organized, and the unemployment rate goes down and down and down. And we've never actually tested just how far down it can go. We know some pretty surprising numbers. So in 1999, the unemployment rate in the Minneapolis urban area was 0.9%. So way below the 3.5% that was the lowest that was recorded in the most recent expansion. All right, so that's basically the aim of this. Of course, there is the theory of unemployment that absolutely dominates unemployment period today, the PMP model, would be the natural starting point to ask what about the PMP model would enable us to come up with an idea that would explain these findings, in particular the finding that the initial victims, the direct channel, is only a relatively small part of the total. That's what we're aiming at. So we're gonna do this in 3 sub-steps. We're gonna first just remind everybody how the DMP model works and why in its textbook form it doesn't, in its usual calibration, it's way off. That was the basic point of the Kroll and Rogerson paper. We're going to consider a topic that has been very widely explored in unemployment theory recently, congestion externality. But the people who have been looking at that case have aimed at other issues, but they've provided some a channel, a second channel, a channel in which because of congestion caused by the original people laid off causes other people to interference with their ability to find jobs, which is what we're looking for. And the other is to go back to more standard DMP cycle theory and ask whether there was an impaired profitability of employment that's plausible. It fits all these theories, and I think we believe that there is. And it's a realized topic that's gotten lots of attention recently, which is the interaction of credit markets with unemployment. So since we've got low on time, I'll just hit at this. First of all, if you look at the standard phase diagram for the DMP model, and there's no change in the profitability of employment, then which determines tightness. The tightness remains the same, and you move just horizontally to the left very quickly in the standard calibration. Say, Scheimer's famous 2005 paper, which still dominates the way we think about the calibration of the DMP model. Well, each of those dots is a month. It just takes a few months to get to the point on that curving line, which is the locus of stationary unemployment. So this is just a one-page picture of the Kroll and Iverson paper. This is the point they were making. That's really quick, so we've got to change this model substantially. Well, so here's going back to the straight line point. So this is blowing up the recovery from the Great Recession. And again, you see, except for a very small amount of wobbling, it's basically a straight line from 10% to 3.5%. That's what we're aiming at. We would like to alter the DMP model so that we can track that straight line. Well, the red line is what you get from standard calibration and standard DMP model, and it's just couldn't be more different. So again, this is the puzzle that Kroll and Rogerson launched, which has been on my mind ever since. So we know we have to make a major change. This is not going to be a tweak. There's going to be some major change in the model. One possibility is that Scheimer was wrong in his calibration, and the job finding is not as fast as he put it. And we think that's correct, and I think he probably does too. But so if you put in something like the effective unemployment exit rate that you're developing report, you make a major step toward saying, well, it's but again, you've got a lot of curvature. You've got very quick recovery of unemployment initially, in percentage points per year. So there's lots of curvature. In fact, the line is practically straight. And of course, there's not nearly enough persistence of unemployment. And I don't think you can stretch that. So this is another way of saying that it's not just the fact that the Scheimer calibration is wrong. There's something else going on. There's something that it's really true that the unemployment of some people induces higher unemployment of others. And that suggests a congestion explanation. So here's the phase diagram for if you have a congestion, which is modeled here. You can model it various different ways, but if you can model it here as an increase in the vacancy holding cost in the VNP model. And if you make the vacancy holding cost depend itself on the level of unemployment, which is a quick and dirty way of doing it, but it certainly delivers the answer. You can dramatically slow down the process because the initial state variable created by the recession induces major problems in finding jobs for everybody and not just for people who lost their jobs. So, but then if you say, okay, well, let's just see, we really don't know the value of this congestion thing, so it's kind of a free parameter. Let's tweak it to see if we can get it to fit. Well, the answer is you can, but it's still there's curvature. Dynamic systems tend to induce curvature. They're less enthusiastic about moving toward the goal as you get toward the goal. Whereas the linear says, no, just keep on reducing unemployment by the same 0.6 percentage. Okay, and then finally, well, let's go back to let's drop the idea that we've been keeping so far, that the traditional DNP explanation fluctuations in productivity or other measures of the profitability of employment. And so in earlier work, I found a certain credit measure, which I'm going to, is really highly correlated with unemployment. And so if you plug that into the BNP model, and again, pick a parameter value that does the best job, you come a little closer. So maybe some combination of all these ideas are going to solve the problem. I think I'm out of time. Is that right? Is there any communication for someone?
Okay. Yeah, Professor Hall, thanks. I think we have some problem with the sound connection. You hear me well now, right?
Oh, yes. For a while it was.
Okay, yeah. I hope people were able to get most of the speech. Unfortunately, there were some sound issues. Thank you. Thank you for your speech. So at this stage, we have a time for question. And basically, it's open-end time, as it's a last session for today. I don't see for the moment, I think, any questions also let me then ask the question, of course, which might not be a very theoretical one, but I think very important one for not only for policymakers but for everybody. I mean, you have made such deep analysis, thorough analysis on all past recessions in almost 100 years. The question is, okay, the current crisis, whether this time is different. I mean, what's your opinion? I mean, what's your take? What would happen next? Whether we would see the patterns of unemployment and the re-employment similar to the past recessions or not?
Okay, so first of all, one of the themes of our work has been that although
many different ways displace workers in a recession, then the process of getting them back to work is kind of uniform. I think there's some reasons to, but we're not asserting that. And Mariana, in fact, has written put out a paper which is available on her website that I didn't get to, but is on this point. The thing that's different in terms of job loss in the US, and I think in other countries too, is that we measure as unemployment people who have are not currently being paid by their employers, but believe that their job's still there and that they're going to be recalled to that job. Now, that would make all the difference in the world if, in fact, their beliefs are true. That would be a major change, because that's not a situation that existed in any of the recessions that entered our study. So that would be one possible reason to be somewhat more optimistic. I mean, the numbers are pretty bad with if we're about 15 percentage points above normal in unemployment today, and only, our traditional rate of dealing with that issue is less than one. So if it were 1 percentage point, it would still be 15 years before back to normal. So that would be a very pessimistic. Some of the commentary in the press on that paper has said, boy, if you do the math and Hall and Kuliak are right, we're in for a really long, painful period of high and only gradually declining unemployment. Obviously, we hope that's not true. And I think there's some good reasons why it wouldn't be true. But so we're not taking a stand on that issue. I think we'll be very clear about that. Others have been working on it, and very conscious of this fact that this very unusually high fraction of workers think that they're going to be recalled, compared to answers to that question in the survey in previous recessions.
Okay, thank you. We now have few questions, and I think the first question is actually also, I believe, about current crisis and the approach by policymakers in different countries. And the question is, do you think it is better to support unemployed people via direct payments or unemployment benefits, or to support firms, so to provide them with credits or grants on the condition that they would not lay off workers? What's your take on this?
My inclination has been to think that preserving the job-specific human capital that is at risk if the employment relationship is permanently terminated is something that deserves a lot of attention. That would point in the direction not of paying unemployment benefits, which lead to workers at least being put on furlough, but rather to rewarding firms for maintaining the relationships they have, even though they're not being fully employed, not taking complete advantage of having a worker. But that's not. That's the inclination. I think that there's a lot of research going on this topic, and a lot of attention to every month's data. So we don't. Our paper is very careful to stay away from that topic currently, because we recognize the importance of it. And as I mentioned before, Mariana has a paper with another co-author that reads on this empirically.
Okay, thank you. We have also a question in the chat from Moritz Kuhn, and Moritz, I actually can unmute you, that you can ask your question directly.
Okay, wonderful. Hey, Bob, good evening.
Good morning.
Good morning, yeah. I was curious about this recovery period that you showed. So because in the initial graphs, it looked as if the layoff rate is also elevated during the recovery. And you also mentioned that most people who leave unemployment first end up in unstable jobs. So should I conclude from this that like maybe changes in layoff rates over the business cycle are more important for business cycle variations in the unemployment rate than we used to think?
No, first of all, that question hasn't come up because the structure of the research in this paper doesn't address that. We take the initial value of state variable, the unemployment rate, to be whatever it is, however it got there, and then analyze this additional path. The facts about layoffs, though, are basically there's this, as measured in the JOLT survey. First of all, there's differences in measurement that we don't have time to go into, that are complicated. The JOLTS number, I think, is in many ways is indicative, and that's pretty much the story there is pretty simple. JOLTS has only existed since 2001, so we have we're just beginning to get the JOLTS data. It comes out more slowly, so we don't really have a JOLTS answer for the current situation. But so what we've got basically is that there's always a lot of layoffs. There's a lot of turnover in the U.S. labor market, more than in other advanced economies. And there's a burst of additional layoffs, but that's basically it. A burst of additional layoffs concentrated around the negative pulse that caused the recession. But there's not the underlying level of layoffs does not, it has a trend that it has a slight downward trend, but otherwise not much happens to it. It's not an active variable throughout the expansion, the recovery.
Can I follow up on this? Because I guess if the separation rate were elevated also during the recovery period, that should also bring you closer to linearity in terms of the recovery of the unemployment rate. Because then you would have additional people flowing into the unemployment pool, which would push again the strong recovery of the job finding rate.
Yes, okay. So you're getting into an area of describing a dynamic system that has a number of state variables. So it's hard to do justice to it verbally. but separations are, a lot of the separations don't give rise to unemployment. Most separations go either to another job, which is by far the largest number, or out of the labor force. Not number 3 destination is into unemployment. So the whole dynamics of separations is really complicated, governed by a lot of other principles.
Thanks.
Yeah, thank you. So let me see where we have any other questions. I don't see. We have actually Mariana Kudliak, the co-author of Mr. Hall, Professor Hall, also online. Mariana, maybe you'd like also to add something? If I can unmute you if needed. Therefore, I mean, I don't see any don't see any other questions. Okay. So maybe then, if there is no any other questions, thanks again, Professor Hall, for this interesting and insightful lecture. Again, a very timely one. Really would like to thank you. I mean, it's a pity not to have you in Kyiv, let's say, physically. But I think in general, we have been able to go through this very interesting presentation. So at this stage, we do conclude our session today. And the next session starts tomorrow at 3 p.m. Kyiv time. Thank you, and have a nice rest of the day, evening, whatever. Bye.